So the next standard for our discussion is accounting standard 9, sir, which is revenue recognition. So let us discuss accounting standard 9. Predominantly this standard focuses on the timing of revenue recognition. See, when it comes to revenue, what is the basis and timing for recognition of revenue? That is a key aspect. So this standard is going to address that issue. And the standard covers revenue from sale of goods, revenue from rendering of services, and use by others of enterprise resources yielding interest, royalty, dividend. When our organization resources we have given to somebody else or invested in somebody else, in return, whatever the interest, royalty, dividend we are receiving, how we are going to recognize the revenue, that is also covered under this standard. Revenue is one of the important item which is the backbone of any organization. We call this as a top line item. Therefore, appropriate proper principles are required for recognition of revenue in the books of the company, and that's why they brought accounting standard 9. So in this standard they are basically giving you the timing, basis, criteria for recognition of revenue. Especially the major focus is on what the standard covers: revenue from sale of goods, rendering of services, used by others of enterprise resources yielding interest, royalty, dividend. Okay, so if you learn how to recognize revenue from sale of goods, how to recognize revenue from rendering of services, and used by others of enterprise resources yielding interest, royalty, dividend, I think this standard is over. So this is the predominant object of this standard. The main object is to provide the basis, timing, the criteria for recognition of revenue. Okay, sir, when it comes to scope of accounting standard 9, sir, this standard has some exclusions. It does not cover revenue from construction contracts, revenue from leases, lease agreements, hire purchase, any revenue from government grants or similar subsidies, or any revenue for insurance companies from insurance contracts. This standard is not applicable. So there are 4 exclusions from accounting standard 9, because as I told you, if you have any specific accounting standard, generally we'll try to follow specific accounting standard instead of general accounting standard. So revenue from construction contracts, hire purchase, lease agreement, revenue from government grants, subsidies, revenue from insurance contracts by insurance companies. So in all these cases, this standard is not applicable. Now, sir, we are discussing about revenue recognition, right? What is revenue, first of all? See, according to ACE9, revenue is the gross inflow. Understand? Gross inflow. They may coin a question on this. Revenue is the gross inflow of cash, receivables, other consideration, which is arising from sale of goods, rendering of services, or used by others of enterprise resources yielding interest, royalty, dividend. So revenue is what? Gross inflow. Sir, but there are exceptions to it. You need to apply this based on the facts and circumstances. For example, there is a consignee who is working on behalf of consignor. Consignor is the principal. Consignee is the agent. So if any agent receives amount on behalf of principal, so can agent says the gross inflow, whatever I received is my revenue? No. Here the agent revenue is what? Commission, what he earned, not the amount which he collected on behalf of principal. Therefore, there is an exception to this. In agency relationship, principal and agency relationship, revenue is commission earned, not the total inflow. For example, I'm an agency which is booking the tickets for airlines, so on commission basis. So whatever the ticket price I collected from the passengers, that will belongs to airlines. So on whose behalf I am booking the tickets, so I will get the commission per ticket. That is my revenue. So therefore, this definition you cannot apply blindly. You need to see the facts and circumstances of each case. So basically, revenue is gross inflow, but not for everyone gross inflow is the revenue. Okay. So especially in agency relationship, revenue is commission earned, not the total inflow. So understand the definition of revenue in this context, because this standard will stick on to only these aspects, that is revenue from sale of goods, rendering of services, used by others of enterprise resources yielding interest, royalty, dividend. Now, next thing is items not included as revenue. Sir, if you look at the original accounting standard 9, in that accounting standard 9 they have given certain examples. Examples for what? Examples of items which cannot be included in the revenue. So examples of, see this, items not included in the definition of revenue as per AS9. So see this, these are the 5 things you need to remember, sir. They may frame one MCQ based on this. Which items we will not include it as a part of revenue? See, first, Take non-current assets. Non-current assets means PPEs, intangible assets, basically fixed assets in your language. So fixed assets, non-current assets. Now, when non-current assets are disposed, example sale, there may be a gain. Non-current assets may be revalued. So there may be revaluation gain. Both these cases, it cannot be considered as a revenue. So when fixed asset is sold for gain, when fixed asset is revalued and there is a gain, may be unrealized. If there is a sale, may be realized gain. Both cannot be considered as revenue. For example, there is a land and buildings. The book value is 100 lakhs. We revalue to 120 lakhs. So there is a revaluation surplus of 20 lakhs. This revaluation surplus of 20 lakhs cannot be considered as revenue. Second, come to current assets. Increase in current assets or change in value of current assets. Sir, whenever there is a change in the value of current assets, because of that there is a gain which is unrealized, that cannot be considered as revenue. Now come to non-current liabilities, sir. In case of non-current liabilities, either you may settle a liability. When you settle a liability at a discount, that may be a gain for you. It may be a realized gain that cannot be considered as revenue. Or sometimes we will change the value of liabilities. For example, in the books there is a liability, the book value is 10 lakhs. Loan 10 lakhs, but it was revised to 6 lakhs. Okay, the loan liability has been revised to 6 lakhs. It may happen sometimes because of the change in the conditions of the contract and different reasons. There may be revision in the liabilities happens. Now whenever there is a change in liability, because of that there is a gain for us which is unrealized in nature. Can you consider this as a revenue? Answer is no. So therefore understand, when it comes to non-current assets, non-current liabilities, any kind of gain, realized or unrealized, don't consider this as revenue as per AS 9. And also the standard says, any foreign currency transaction you entered, because of the foreign currency transaction as per AS 11, there may be exchange gains. Don't consider it as revenue. And also, if you have any foreign operations outside India, at the end of the year, you need to convert the financial statements into Indian rupees. Now, at the time of conversion, there may be exchange gains that cannot be considered as revenue as per accounting standard 9. And also, any natural increase in herds, agriculture products, forest products, don't consider it as a revenue. See, this example is also exclusively there in the standard AS 9. So any natural increase in herds means animals, group of animals. So any increase in the animals, a natural increase, agriculture products, forest products, agriculture, forest products, if there is a natural increase, so nobody is, growing them. So they are naturally grown, right? So any natural increase in these things cannot be considered as revenue. So remember these examples, these items, generally they are not included in the definition of revenue. Okay. So we understood what is revenue and which items will not include as a part of revenue as per the examples which is given in the accounting standard. Now in the study material of ICAI, there are some examples they have given. Now look at example number 1, sir. In example number 1, sir, entity XY, they have one machinery, sir, 2 lakhs. They are selling it for 1.8 lakhs. So they got a profit of 20,000. Now whether sale of mission is revenue, the answer is no. Just now we discussed non-current assets disposed, realized gain we got. Can we consider this as revenue? No, but we will show it as a gain on sale of mission in the P&L account, but not revenue as per AS 9. This such a gain on sale of 20,000 is recognized as a part of P&L under gain or loss on disposal of asset. Second example, sir. See, there is a company ST Limited, sir, who is real estate developer and builder. Now they are engaged in the business of buying and selling the properties. Now what they have done is they have purchased the land for 150 crores and they sell it for 240 crores. Now can you tell me what is this 240 crores? See, since they are the real estate developers, land is what inventory for them, right? So in the ordinary course of the business, the land bought and sold, this is revenue from sale of goods. So therefore this 240 crores will be revenue from operations. Next, example number 3, this is very good example. There is a company called DL Limited, which is basically a pharma company. But this pharma company, what they have done is they have conducted some research on the new medicine. From the last 2 years, they are doing this research. Now, the entire research they have spent till now 30 crores. Now, this research findings they sold for 50 crores. They sold it for 50 crores to a company called GH Limited. Now you tell me, a pharmaceutical company selling their research findings to its competitor, what is this? Is it revenue from operations or is it other income? Definitely it is not a revenue from operations, because in the ordinary course of the business, is selling research findings is my activity, is my principal activity? No. Therefore in this case, sale of this amount of this 50 crores is not revenue from operations. This is my other income. I will show it in the P&L account. And last example, trip deal. See this example I told you. So in this case, see this, there is a website called Trip Deal. Is a website. Uh, People can book the airline tickets. That means on behalf of airlines, this Trip Deal is booking the tickets. So therefore they will get some commission from the airlines. Okay. Now they are, whatever the amount they are collecting from the passengers on behalf of the airlines. So that is not revenue for them. The ticket amount is not revenue for them. So they need to transfer this amount to the airlines. So whatever the commission they are receiving, that is only revenue for them, right? So that is what they have told here. Next. So in accounting standard 9, sir, there are 3 areas I told you. This standard basically covers revenue from sale of goods, second, revenue from rendering of services, third, using enterprise resources by others, yielding interest, royalty, dividend. Now first discuss recognition of revenue from sale of goods. So when a business enterprise sold goods, when they will recognize revenue? Is it when sale actually happened? Is it when goods transferred? Is it when payment received from the customer? What is the trigger point? What is the basis for recognition of revenue from sale of goods? See, the standard says whenever there is a sale of goods, revenue will be recognized on satisfaction of the following conditions. First, there must be transfer of property. Second, the control must be transferred. Third, certainty in price. Fourth, certainty in collection. Important. 4 conditions must be satisfied. Transfer of property, control, certainty in price, certainty in collection. Now, first, transfer of property. Always remember, sir, transfer of property means transfer of ownership. This transfer of ownership is always coincides with the transfer of significant risks and rewards of the goods. Most of the times, along with the ownership, risks and rewards are also transferred. Sometimes what happens is transfer of ownership may not be coincide with the transfer of risks and rewards. In that situation, you need to recognize revenue only when there is a transfer of significant risks and rewards. Sometimes what happens is because of the buyer request or buyer's mistake, there is no transfer of risks and rewards. In such a situation, as a seller, I can recognize the revenue because risks and rewards are already transferred from my point of view. So therefore, understand, when revenue from sale of goods will be recognized, first of all, there must be transfer of property. So revenue is recognized when property and goods or all significant risks and rewards of ownership have been transferred to the buyer. Okay, say this. So conditions: transfer of property, ownership, which is already always coincide with the transfer of significant risks and rewards of goods. But there may be some exceptions. For example, delay in delivery because of the fault of seller or buyer. Suppose a customer came and he accepted the goods, he paid the amount, but goods are not readily available. Therefore, there is a fault from seller. Therefore, the risk is with seller. Therefore, risks not transferred. Don't recognize revenue. Suppose a buyer came, he has seen the goods, accepted, price also accepted, he make the payment, billing also done. But buyer said to the seller that I will take delivery after 10 days. That means seller point of view, the risk is already transferred. There is a fault from buyer point of view. He is not accepting the delivery. Or he said I will take delivery after 10 days. Now in such a situation, the risk is with the buyer. Therefore, risk has been already transferred from seller point of view. Therefore, I can recognize revenue. So therefore, see, transfer of properties always coincide with the transfer of significant risks and rewards. If it is not coinciding, then you recognize revenue only when there is a transfer of risks and rewards, because this is very, very important. In respect of the goods, the transfer of risks and rewards must be transferred. That will be the trigger point to say to recognize the revenue, provided other conditions are also satisfied. And sometimes, sir, there is a contractual terms which between the seller and buyer, which clearly specifies that we will transfer the ownership, but the risks and rewards will be transferred later on. Then in such a situation, you have to wait till the transfer of risks and rewards and you have to recognize the revenue. So tell me, whenever there is a sale of goods. When you are going to recognize the revenue, first condition is transfer of property. Transfer of property means what? Transfer of ownership, which is always coincide with the transfer of risk and rewards. But there are certain situations they may not coincide. In such a situation, will you recognize revenue? No, you have to wait till the transfer of significant risks and rewards. And I told you, whenever there is a default, whenever there is a fault from the seller point of view, he has to wait till the risk and rewards are transferred. Whenever there is a fault from buyer point of view, so we can recognize the revenue immediately. So okay, this is the first condition. Second condition, control. Sir, if you understand the definition of asset in the framework chapter, they said asset is what? A resource controlled by an enterprise. So to become any resource as our asset, we should have control over the future economic benefits of that asset. That means if I am transferring goods to you as a seller, I cannot retain any effective control usually associated with the ownership of the goods. So that's why they said control. The seller must retain no effective control of goods usually associated with ownership. Usually, to become, if I am a owner of something, suppose for example, I'm the owner of this laptop. That means I can control the future economic benefits from this laptop. If I want, I can give it for rental purpose. If I want, I can exchange it, I can sell it to somebody. Whatever I want, I can do, because that is usually associated with ownership. So when I'm selling the goods, that kind of control I should not have as a seller. So I cannot retain any effective control of the goods. That is the second condition. Of course, when I transfer significant risks and rewards, obviously the control will also be transferred, but they have mentioned separately that the seller must not retain any effective control of the goods usually associated with the ownership. Next one, certainty in price. Sir, when I sell the goods, there must be certainty in the price. I can't say I'm selling goods to you, you pay whatever amount you like, or you pay some amount. So in future, so after for example, your business is prosperous, or your business is increase, your sales increases, then you pay like that. There should not be any uncertainty. There must be certainty in the price. There should be no uncertainty in the price charged for the goods, and certainty in collection. This is one of the important aspects for recognition of revenue. There, as a seller, when I'm selling goods to the buyer, if I want to recognize the revenue, so there should not be any uncertainty in collection. The standard says if there is any uncertainty in the collection, don't recognize revenue. Postpone it till the certainty comes. And sir, after recognition of revenue, if uncertainty arises, generally we don't cancel the revenue. Rather, we try to create a provision based on the past experience. But certainty in collection must be there at the time of recognition of revenue. So all these four conditions must be satisfied for recognition of revenue from sale of goods. Okay. Now, sir, there are some special situations, sir. So this revenue recognition with delivery delays. First, delayed delivery at buyer's request. Now, whenever there is a delay in delivery because of buyer's request, as a seller, when I can recognize revenue? See, in this case, revenue can be recognized immediately, provided the goods are in seller's possession, identified, ready for delivery. Then I can recognize revenue, and buyer already accepted the goods and billing. So therefore, this is one case, sir. As a seller, I sold the goods, but buyer said I will take the delivery after some period of time. So as a seller, what I can do is, so I can recognize revenue immediately, provided the goods must be in my possession, they are identified, ready for delivery, and buyer accepted the billing and goods. See this. If delivery is delayed at buyer's request, revenue is recognized when goods are in the seller's possession, identified, ready for delivery. Buyer accepts the billing. Next. Sometimes we have sold the goods with conditions. Suppose revenue recognition with conditions. For example, installation and inspection. Sir, when goods are sold subject to installation and inspection, then when to recognize revenue? Simple. When the installation and inspection is completed and accepted by the customer, then you can recognize the revenue. So in this case, revenue is recognized. Goods are installed at the buyer's place to his satisfaction, and goods are inspected and accepted by the buyer. Now here I will tell you one important point, sir. When I sold the goods, if the installation is very simple for those goods, then I may not wait till the installation and inspection is completed, because the installation is a simple process. I can recognize the revenue immediately. If the goods I sold, the installation requires the professional services, then I have to wait till the completion of installation and inspection to recognize the revenue. Next, sale on approval basis. Sometimes goods are sold on approval basis, sir. In such a situation, when I need to recognize the revenue. See, generally, when I send any goods on approval basis, if I specify any time limit, I will wait till that time limit. Suppose if the time limit expired, but the buyer side there is no confirmation, then I can assume that he has accepted the goods. Suppose I have given 3 months time. Within that 3 months he has communicated to me, so that is actual acceptance. I can recognize the revenue. Suppose if I doesn't provide any time limit, then I will wait for reasonable period of time. Then I will say after that. So I will assume that the sale has been completed. That means either there can be actual acceptance. Actually, the buyer has communicated to the seller that I am accepting the goods. Then I can recognize the revenue. Or there may be implied acceptance. Suppose whatever the goods I sent, the buyer started using them in his production. Therefore, this is implied acceptance. Through his actions, he confirmed that he is accepting the goods. And the time period for rejection expires or no rejection occurs. Suppose for example I have given the goods, no time limit has been mentioned, therefore I will wait reasonable period of time. Within that reasonable period of time, no confirmation, that means deemed acceptance. Suppose I have given 6 months time, within that 6 months he has not communicated anything, that means I will say the goods has been accepted and I can recognize the revenue. Next one, sir, consignment sales. Sir, in case of consignment sales, as a consignor, when I will recognize revenue, sir? Not when goods sent to consignee, but when consignee sold goods to outsiders, I will recognize the revenue. Because I am the principal, consignor is principal. Now consignee is my agent. I am selling goods, I am sending goods to my agent is not my revenue. That is not the point. When my agent sold goods to third party, then I can recognize the revenue. So when goods are sold to third parties. Now cash on delivery sales. So these days, these companies are offering cash on delivery basis, so many e-commerce platform and all. Simple, when goods are sold on cash on delivery basis, subject to cash on delivery, only when the cash is collected by the seller or his agent, revenue can be recognized. Next, other revenue recognition rules. Okay. Next, installments payments. See, this is not normal installments, important installment payments. That is, payments made over a period of time, but delivery of goods takes place after all installments payment. See, first customer will make the payments. After all installments paid by the customer, the seller will deliver the goods. So in practice, these kind of sales are there. Yes, you go to jewelry, big jewelry shops. Now GRT, all these jewelry shops, they will offer you the gold schemes, right? Monthly you need to pay some amount. Now once the 12 months is over, with that amount you can purchase the jewelry items, right? This is what, nothing but you are making the payment in installments over a period of time. Once you make the payment of all the installments, then you can select the ornament and they will make the delivery. Now point is here, when they will recognize revenue, see, when they will recognize revenue is when all installments are received and goods are delivered to the customer. When goods are delivered to the customer, that is the point they will recognize the revenue. Meanwhile, whatever the installments they are collecting every month, that will be treated as advance from the customers. So in this case, revenue is recognized when goods are delivered, or if the significant portion of installments is received, and based on the past experience, the seller can say that this is definitely the customer is going to pay the remaining amounts also, and the sale is going to be consummated, it is going to be completed, then he can recognize the revenue. So when that happened, when that event happened, so usually in this case, when goods are delivered, the revenue will be recognized. Next, special orders and shipments. Special orders and shipment is nothing but where payment is received for goods, but they are not presently held in stock, are still to be manufactured. Sir, I am the manufacturer, I received the payment, but the goods for which I have received the payment, not yet manufactured, they are not with me. So then can I recognize revenue? The answer is no. I have to wait till the goods are manufactured, identified, ready for delivery to recognize the revenue. So in this case, revenue is not recognized until the goods are manufactured, identified and ready for delivery. Next, sale repurchase agreement. I will sell the goods same upon the condition that the same goods again I will purchase back. So this is not a sale transaction, revenue transaction. It is a kind of financial arrangement. For example, I want 10 lakhs loan. So what I will do is I will show in my books as I sold goods to you. So when I sold goods to you, you due me 10 lakh rupees. Now after 6 months, again I will write a purchase entry as if the same goods I am purchasing from you with interest. So for example, 10 lakhs loan, another interest 1 lakh for 6 months. For example, 11 lakhs is my purchasing price. So it is a kind of a financial arrangement between the parties. It is not a revenue transaction. No revenue will be recognized in this case. Because why you sell the goods and the same goods again you will purchase back at a higher price? So it doesn't make any sense, right? So if the seller agrees to repurchase goods later, it is considered as a financing agreement, not a sale. Therefore, this is not counted as revenue. Next, normal installment sales. See, last one is installment payments. This is different. Here, customer is making the installment payments over a period of time. Once all the payments is made, the seller will deliver the goods. That is different kind. This is a normal installment sale. For example, I purchased any item on installment basis. You know, in installment sale, immediately when you enter an installment agreement, they will deliver the goods to you. You will get the possession and you can start using it while paying the installments. So in this case, the person, the entity which is selling the goods on installment basis, when they will recognize revenue? Immediately they will recognize the revenue, right? But what price? Sale price excluding interest component is recognized on sale date. That is the agreement date. And the interest is recognized proportionately on the unpaid balance. You know, interest will be recognized on time proportionate basis every year based on the unpaid balance. Now come to the last one, trade discounts and volume rebates. Sir, tell me, sir, when you purchase goods, maybe the supplier, the seller is giving you some discount, right? Trade discounts and volume rebates. If you purchase goods above the particular volume, they will give you discount, right? Whether the trade discount or volume rebates can be considered as revenue? No, it is not revenue. Why? Because when you receive any trade discount, what you are doing? You are reducing from the cost of purchases. Therefore, it is not a revenue. Okay, so it represents reduction from the cost, not revenue. So trade discounts and volume rebates are not included in the revenue as they represent reduction of cost. Suppose you have given a discount. So when you give a discount, it will be deducted from the revenue. So therefore, this is the revenue from sale of goods. So we have completed all the cases respect of sale of goods. Next, recognition of revenue from rendering of services. Sir, suppose I am a service provider. So when I will recognize revenue? See, in case of a service provider, the recognition of revenue is based on performance of service. As and when the service is performed and when there is no uncertainty in collection, then I can recognize the revenue. But this performance of service, to measure the performance of service, there are two methods. One is completed service contract method. Another one is proportionate completion method. Because the services the service provider will provide may involve only one activity or maybe multiple activities, but one single sole main activity will be there. Or there are multiple activities which are each one is significant involved in the service, right? So suppose for example, I'm providing a service to you and the service is installation services. That means this service is a one activity involved in it. Only when that activity is completed, I can recognize the revenue. So completed service contract means basically a service involves a single act or maybe a multiple acts with one being the main act. For example, I booked a ticket from one place to another place. Now the airline's point of view, the service involves one activity, that is transportation of the customers. Particular journey must be performed, then only service is performed. Then if there is no uncertainty in collection, then they will recognize the revenue. In this case, revenue is recognized after the service is fully or mostly completed and no significant uncertainty exists about the collection. Okay, and comes to proportionate completion method. Sir, in case of proportionate completion method, when I will recognize the revenue? If the service involves execution of more than one act, then I need to measure the performance of the service proportionately based on the contract value, maybe based on the associated cost, maybe based on the number of activities or any other suitable basis, and proportionately I will start recognizing the revenue provided there is no significant uncertainties exist about the collection. Okay, so in case of service provider, when revenue will be recognized, sir? When service is performed. And when we say the service is performed, sir, so that we need to see the type of service. So there are two methods to measure the performance of service. Based on that, you will recognize the revenue. Either completed service contract method or proportionate completion method. Some services involves single act or maybe multiple acts with one being the main act. But some services involves execution of more than one act. For example, I'm an event manager. Maybe for an event manager, number of activities will be there in my service, right? So I need to measure my performance of services based on the activities I have completed, and that performance can be measured either based on the contract value or associated cost or number of acts, any other suitable basis. Or for example, you take a hospital. Now a patient has been joined. Now pre surgery consultation, surgery, after surgery, post surgery, take care. So they have given a package. So first medical consultation, preliminary examination, then surgery, after that post surgery care. So like that they have three activities are there in the services. Now they will also follow proportionate completion method. So how much service we have completed, how many activities we have completed, proportionately we will recognize the revenue. Now there are some special cases in case of revenue recognition, sir. First one, installation fees. For example, I am a service provider providing installation services. So there is a AC installation service provider. When he will recognize revenue? Simple. When the particular installation is completed and accepted by the client. So when the installation is completed and accepted by the client. Now advertising commission. See, important, sir. Sir, advertising commission, when they will recognize the revenue, sir, when that particular advertisement appears before the public. See, in this case, revenue is recognized when the advertisement appears before the public. So, for example, sir, there is a advertisement agency who brought the business to the TVs, right? Now, on behalf of the companies, now whatever the commission they received for the business they brought, now that is advertisement commission. This advertisement commission, when they will recognize revenue, when that particular advertisement appears before the public. Okay, not only here, sir, even you take any magazine, newspaper. So the person who brought the business to these agencies, to these companies, when he will recognize advertisement commission as his revenue means when that particular advertisement appears before the public, not when the actual payment is received. Important. Now suppose insurance agency commission. See, basically insurance is an agency business, right? Now when the insurance agent brought any business to the insurance company will pay some commission, right? When he will recognize that commission? On the effective commencement or renewal of policies. The effective date of policies, commencement or renewal date of the policy, he will recognize the revenue. Next, any admission fees. Suppose we are conducting any program, any artistic performance, any banquets, dinners, so charity programs we are conducting. So and we are charging some admission fees. So when we will recognize revenue? When that particular event takes place. When that particular event takes place. So they are conducting one event, sir. So whatever be the purpose of that event, so they, some amount they are collecting as an admission fees. So when they will recognize? When that particular event takes place. Tuition fees, for example, coaching fees, tuition fees, when we will recognize? Over the period of coaching, over the period of instruction. For example, 6 months coaching, so we have collected 60,000. So 60,000 will be recognized over the period of construction, over the period of instruction. Next, entrance and membership fees. Sir, these clubs, societies will be there, na sir. So they will collect entrance and membership fees. Important, sir. Suppose there is a club, sir. Now this club, if I want to join the club, initially they will collect what? Entrance fees. This entrance fees is like a capital amount for them. So they will capitalize. Generally, they will capitalize. And every year they will charge membership fees. Now this membership fees, what they can do is, they can recognize as a revenue over the period, based on the nature of services they are providing for this membership fees. So membership fees are recognized on systematic and rational basis considering the timing and nature of services. So basically entrance fees is capitalized, sir, because it's a one-time fees they will collect. So appropriately it will be capitalized. But membership fees every year they are collect now. So this membership fees, how much revenue they will recognize in this, that depends upon the nature of services, the timing of the services they provide. Depending upon that, they will apportion this membership fees as a revenue over a period of time. And next one, sir, recognition of revenue from use by others of enterprise resources yielding interest, royalty, dividend. Sir, for a first is revenue from interest. What is first of all interest, sir? Simple, sir. Interest is a charge for using my money or my resources. If you use my money, in return I will charge something. So that is called interest. Now the standard says when interest will be recognized as a revenue. See, interest will be recognized as a revenue on time proportionate basis based on the outstanding balances, right? So interest is basically charge for using the money or for amounts due to business. And revenue from interest is recognized on which basis? Time proportion basis based on the outstanding amount and the applicable rate. Royalties. What is royalties, sir? Royalty is nothing but the charge for using my intellectual property rights. For example, I have some manufacturing rights, I have given that rights to you. Now by using my manufacturing rights, by using my patents, for example, I have a patent formula, I have given the formula to you. By using that patent, you are started manufacturing the goods. Maybe on each good manufactured or each good sold, I will collect some amount from you. That is called royalty. Now these royalties are for using my assets like patents, trademarks, copyrights, know-how, etc. Now, when I will recognize as a revenue, on what basis? Generally, royalties will be recognized on accrual basis. So, as per the terms of the agreement. So, they will be recognized on which basis? Accrual basis as per the terms of agreement. Next, dividend, revenue from dividends. So, when company invested in other company equity shares, we will get what? Dividend, right? So, it is nothing but reward for investment in shares. Now, when this dividend will be recognized as revenue? Simple. When the right to receive the dividend is established. When the right to receive the dividend is established. So reward is the reward from holding the investment, and revenue is recognized when the owner's right to receive the payment is established. Owner's right to receive the payment is established. When your owner's right to receive the dividend is established, when the company declare the dividend. So definitely when the company declares a dividend, if your name is there in the register of members, generally you will get the right to receive the payment. Therefore, you can recognize the revenue. And remember guys, in all the cases, whether it is revenue from sale of goods, revenue from sale of services, or used by others of enterprise resources used by others in yielding interest, royalty, dividend. In all these cases, one of the common conditions to satisfy is there should not be any uncertainty regarding collection of revenue. Okay. Now, what is the effect of uncertainties on revenue recognition? As I told you, if there is any uncertainty at the time of recognition of revenue, don't recognize it. Postpone the recognition of revenue till the certainty came. Suppose if there is any uncertainty arises after revenue recognition, then make a appropriate provision. Don't adjust the recognized revenue. So if there is uncertainty in collecting revenue at the time of recognition, don't recognize the revenue. Postpone until it is reasonably certain that collection will occur. Suppose uncertainty arises after recognition. If uncertainty in collection arises after revenue recognition, make appropriate provision. Don't adjust the recognized revenue. And when it comes to disclosures, AS9 says what are the, if any revenue is postponed, during there we have not recognized any revenue, why, what are the circumstances causing the postponement must be disclosed. That's it, sir. This is accounting standard 9. So this is a standard. I revised it so you see it properly. Okay. The next accounting standard we are going to revise is accounting standard 16, sir. Accounting standard 16 deals with borrowing cost. Whether borrowing cost will be treated as normal expenses and charged to P&L account, or in any case these borrowing cost will be capitalized to the cost of the asset. That is what predominantly this standard is going to address, sir. Sir, when any business enterprise has taken any borrowings, these borrowings come up with some costs, sir. Whether the cost which we are incurring on the borrowings, will they be treated as normal expenses and charged to P&L account, or whether these costs will be capitalized in any case. After learning this standard, you must be in a position to judge this, whether I will capitalize the borrowing cost or whether I will charge the borrowing cost to the P&L account. Actually, sir, this entire accounting standard 16 is based on one core idea, sir. The core principle is this. You need to remember. This is very, very important, sir. So this standard says borrowing cost directly related to acquisition, construction or production. Either acquisition or construction or production of qualifying asset capitalize. Borrowing cost directly related to either the acquisition of qualifying asset or production of qualifying asset or construction of qualifying asset capitalize. Suppose if asset is other than qualifying asset, treated as revenue expenditure. That means charged to P&L account. So therefore, we need to understand, sir, what is borrowing cost? Second thing is qualifying asset. If the borrowing cost is directly related to qualifying asset, capitalize. Otherwise, charged to P&L account. That's the main idea. Now let us try to understand what is borrowing cost. Sir, on the borrowings, what is the common borrowing cost, sir? Interest. But the standard says not only interest, any other cost which is incurred by the enterprise in connection with the borrowing of funds is also borrowing cost. So borrowing cost includes interest and any other cost which is incurred by the enterprise in connection with the borrowing of funds. In connection with the borrowing of funds. Like for example, application fees, loan processing fees, guarantee fees, any agency, commission fees, consultancy fees, or maybe any commitment charges. See, when you are going for borrowings, na sir, it is not just interest, sir. You are going to incur a lot of other cost which is in connection with the borrowings. They will also be considered as borrowing cost as per accounting standard 16, sir. And this standard is exclusively provided, sir. Borrowing cost may include, like that they have given 5 elements, sir. Important, sir. So borrowing cost may include these 5. What are those, sir? So the standard says borrowing cost may include, first one, sir, interest and commitment charges on borrowings. Interest, we know, definitely it's a borrowing cost. Any commitment charges is a kind of a fees which is levied by the lender on the borrower for the unused credit. See, I am providing you a line of credit. Now for that I will levy some fees if required. That is called commitment charges. So when you see any commitment charges, so you should consider them as a part of borrowing cost. The standard says borrowing cost include interest and commitment charges. Second, borrowing cost includes any discount or premium on borrowings, amortization of discount or premium on borrowings. Best example is debentures, sir. Sir, when a company issues debentures, no, sir, at a discount. So that discount, when company redeeming debentures at a premium, that premium, both will be considered as a part of borrowing cost, sir. Suppose a company issued 10% debentures, sir. The face value of the debentures is 10 lakhs, sir. But the issue price is 9 lakhs. So what is the discount, sir? 1 lakh. This discount generally will be amortized over the life of debentures. That will be considered as borrowing cost. Similarly, suppose as per the terms, company said we are going to redeem debentures at 10% premium. Therefore, 1 lakh premium you are paying now, that will also be considered as borrowing cost. So any discount or premium on borrowings is also considered as borrowing cost. And also any ancillary cost, amortization of ancillary cost means incidental other costs relating to the borrowings. As I told you now, loan processing fees, application fees, guarantee fees, any stamp duty on legal documents, any commission, brokerage, consultancy fees, all these are what? Amortization of ancillary costs relating to borrowings. They are also considered as borrowing cost. And also the standard says borrowing cost includes if any asset is taken on lease, and if the lease is which lease? Finance lease. Now in respect of that lease, you are going to pay lease rentals now. Now in that lease rent, there are 2 elements. One is principal, another one is interest. That interest is called finance charges. That finance charges in the lease, that lease must be finance lease, is also considered as borrowing cost. So when you take any asset on lease basis, and if the lease is finance lease, now in respect of that lease, whatever the lease charges you are paying, in that whatever the interest portion is there, that is also considered as borrowing cost. So borrowing cost includes interest and commitment charges. Second, amortization of premium and discount on borrowings. Next, amortization of ancillary cost. Next, finance charges included in the lease payment in respect of which lease? Finance lease. And the last one, the most important one, which has the capability to ask as a separate question, is this one. The standard says borrowing cost includes any exchange difference arising from foreign currency borrowings. Arising from which borrowings? Foreign currency borrowings, to the extent they are regarded as adjustment to interest cost. So exchange difference arising from foreign currency borrowings, to the extent they are regarded as adjustment to interest cost, is also considered as borrowing cost. Sir, actually, if you see accounting standard 11, scope of the AS 11, sir, there they said this standard is not applicable to this. Any exchange difference arising from foreign currency borrowings, to the extent they are regarded as adjustment to interest cost, this standard is not applicable. Because this is subject to AS 16. That's why AS 11 excluded it from the scope. Now, what is this, sir? See, generally, sir, you are an Indian company. If you take any loan from foreign country, on this loan, if there is any exchange difference arises, okay, out of that exchange difference, certain portion will be considered as borrowing cost. Sir, what is this, sir? See, I have taken one example, sir. Exactly same kind of examples they will ask in the question, sir. In the material also, this example is there. Okay, very important. Okay, now listen to me carefully. The idea is very simple. I'm an Indian company, sir. First of all, I'm an Indian company. Now, on 1/4/2011, I have taken foreign currency loan. $10,000 I have taken from the foreign currency. On that day, $1 is equal to 45 rupees, sir. Okay. That means $10,000 into 45, 4,50,000 I will record in Indian company books. Now at the end, I need to pay interest on this loan. The interest rate is 5% they given in the question. So on 31st March 2012, the interest is nothing but $10,000 into 5%, $500 we need to pay. And at the end, $1 has become 48 rupees, sir. So in the beginning, $1 45, at the end, $1 is called 48. So what will be the interest cost, sir? $500 into 48. So 24,000 is my interest cost. Correct? 24,000 is my interest cost. Suppose, imagine, if this loan is utilized for qualifying asset, what A16 says, borrowing cost, that is 24,000, directly related to qualifying asset will be capitalized. So therefore 24,000 I will capitalize. But here the standard says, as an Indian company, you are on the losing side. Why you are on the losing side? See, suppose if the same loan you have taken in India on 1st April 2011, tell me how much amount you take in Indian currency, 4,50,000. Because $10,000 in the beginning, $1 is equal to 45 rupees. So in India, if the same loan is taken, you might have taken 4,50,000, right? Now on this 4,50,000, suppose in India the interest rate is 11%, which is given in the question, 11%. You might pay 49,500. The interest cost is 49,500. Since you have taken loan from outside India, your interest cost is less. That's why I went for borrowings outside India. See, in India, if the interest cost is so cheap, why I will go foreign currency loan, sir? Because my interest cost is low in foreign country. That's why I enter there. Now, but you are an Indian company. If the same loan is taken in India, you might pay 49,500. And if these borrowings you might have utilized for qualifying asset, how much amount will be capitalized? 49,500. Because you are taking loan from outside India, you are capitalizing only 24,000. That means you are losing the benefit of capitalization. Now we will give you that benefit of capitalization also. Sir, how you are going to give? We will see what is the difference. If the loan is taken in India, you pay 49,500. The same loan is taken outside India, you pay how much? 24,000. So what is the difference? 25,500. Now what we will do is, on this foreign currency loan, whatever the exchange difference arises now, on that exchange difference, this difference, that is the difference between the interest if the loan is taken in India, loan is taken outside India, that we will allow this, that in the from the exchange difference to the extent of the difference, we will give you as a borrowing cost. We will treat you as a borrowing cost. So you can add to the qualifying. So therefore, in this case, you see, sir, $10,000, sir. As per AS11, all foreign currency monetary items, we will restate them at their closing rate. What is the closing rate, sir? 48. At the time of loan it is 45. So therefore 3 rupees is the difference, right? Exchange difference. So $10,000 into 3 rupees. So 30,000 is the exchange difference. Now generally this exchange difference, what we will do, as per accounting standard 11, they will be charged to P&L account. But A16 says, on this foreign currency loan, there is an exchange difference of 30,000. In this 30,000, to the extent of difference between interest, to the extent they are regarded as adjustment to interest. What is regarded as adjustment to interest? Nothing but the interest in Indian rupees minus interest in American dollars, foreign currency loan. The difference out of this exchange difference, we will treat it as borrowing cost. So that your borrowing cost will be 24,000 direct plus from the exchange difference 25,500, total 49,500. As if you are an Indian enterprise, really, as if the loan is taken in India, we are giving you 49,500, the benefit of capitalization. Sir, that means out of this exchange difference of 30, 25,500 we will treat it as borrowing cost, remaining 4,500, normal treatment as per AS11. This is an exchange difference, we will transfer to P&L account. So you understand, sir? So whenever there is a foreign currency borrowings, in these foreign currency borrowings, to the extent the difference between the interest, to the extent they are regarded as adjustment to interest cost, we will treat it as borrowing cost. Because you are an Indian enterprise, sir, we can't deny you the benefit of capitalization simply because you have taken a loan outside India. If the same loan is taken in India, you might have paid 49,500. And if you are utilizing for qualifying asset, you might have capitalized 49,500 now. And now you are capitalizing only 24. That's why from the exchange difference, this interest, this difference also we will allow as a borrowing cost. Therefore, only remaining 4,500 you can transfer to P&L account. Sir, okay. Suppose in India the interest rate is not 11, it is 13%. Then so 4,50,000 into 13%. See this. If the interest in India is 13%, the interest cost is 59,500, and the foreign currency loan 24 interest. So therefore, what is the difference in interest? 34,500. But your exchange difference is only 30 now. Then what to do? Entire exchange difference will be treated as borrowing cost. nothing will be remaining. Understand? So if the difference in interest cost is more than the exchange difference, only to the extent of exchange difference, you treat it as a borrowing cost. Remaining, you treat it as nil. Okay. So these are the 5 elements the standard says borrowing cost includes. So out of this, the last one is very, very important. I explained with example. So we understood what is borrowing cost. Now let us try to understand qualifying asset, because this standard says borrowing cost directly related to qualifying asset will be capitalized. Sir, what is qualifying asset? Sir, this standard says qualifying asset is an asset which takes substantial period of time to get ready for its intended use or sale. Qualifying asset is what? An asset which takes substantial period of time to get ready for intended use or sale. Either you will make that asset for use, or you are make that asset for sale, like inventory. So anything which takes substantial period of time will become a qualifying asset. Substantial period of time means, actually, sir, they have not prescribed what is substantial period of time. The standard says substantial period of time depends on facts and circumstances of each case. But ordinarily, we can assume 12 months as a substantial period of time. But of course, even less than 12 months can also be considered substantial period of time depending upon the facts and circumstances of each case. That means this 12 months is a rebuttable presumption. Rebuttable presumption means something which we can prove otherwise also. So therefore, each case to case we need to evaluate, sir, whether this asset will take substantial period of time to get ready for intended use or sale. Substantial period of time, ordinarily 12 months, sir. Sir, but sometimes even less than 12 months can also be justified based on facts and circumstances of each case. Sir, why standard has not prescribed any time limit? Suppose they might have said like this: substantial period of time means a period which takes substantial period of time means 12 months. Can I say like that? Why they have not prescribed time limit? Because they know if they have prescribed time limit, the company started prolong the construction of any asset and say this is qualifying asset because it has taken 12 months time for get ready for intended use or sale. So for the benefit of capitalization, they unnecessarily prolong the construction of the qualifying asset. So therefore, standard doesn't want this. That's why the standard says what is substantial period of time? It will take necessarily it must take substantial period of time. That to get ready for intended user sale, get ready for intended user sale. See this substantial period of time depends on facts and circumstances of each case. Ordinarily 12 months is considered substantial unless shorter or longer period can be justified. Suppose a company is constructing a factory, sir. Now because of the latest technology, the construction period is only 9 months. Will you say will you allow this as a substantial period of time? The answer is yes. Simply because the company utilized the latest technology and the period is only 9 months, you cannot deny the benefit of capitalization. That's what the intention of the standard. The intention of the standard is even less than 12 months can also be justified. So you have to see the facts and circumstances of each case. Simply you cannot say it is less than 12 months, so it is not a substantial period of time, therefore it is not a qualifying asset, therefore we will not allow capitalization. That is not correct, sir. So it's a rebuttable presumption of period of 12 months is considered substantial period of time. Rebuttable presumption means something which you can prove otherwise also. Even less than 12 months can also be considered substantial period of time depending on facts and circumstances of each case. Okay. So the estimated period should consider the time needed for the asset to be technological and commercially ready for use or sale. The asset must be ready for its technological or commercial use. So that is substantial period of time. So therefore we understood the key things in core idea of accounting standard 16, sir. We understood what is borrowing cost. We understood what is qualifying asset. So what is qualifying asset? An asset which takes substantial period of time. What is substantial period of time? Depends on facts and circumstances of each case. Okay. Ordinarily 12 months can be substantial period of time, something which we can prove otherwise also. So depending on the facts and circumstances of each case, you need to take the decision. For example, you see PP, property, plant, equipment. Generally, can it be called as qualifying asset? Maybe yes, if it takes substantial period of time. Intangible assets, maybe. Investment properties, investment property means investment in land or building, not for the purpose of occupying in the business, using for the business, but for the purpose of earning income. Yes, it can be a qualifying asset if it takes substantial period of time. What about inventory? Inventory can also be qualifying asset provided it will take substantial period of time to get ready for intended sale. For example, wine. To manufacture wine, it will take substantial period of time to get ready. Therefore, wine can be considered as what qualifying asset. What about investment, sir? Financial asset. Last time they have asked this in the exam, sir, for 2 marks MCQ. A company invested in shares of other company and company want to treat this as a qualifying asset. Is it allowed? Answer is no. Because what is qualifying asset? an asset which must take substantial period of time to get ready for intended use or sale. Here, this is a ready-made asset. For example, a company purchased a car. Car means it is readily available, readily usable. Therefore, it is not a qualifying asset. Okay. Now, one more thing, sir. Scope of the standard. This is also important, sir. Sir, this standard does not cover any cost, actual or imputed cost incurred on the equity, including preference share capital not classified as liability. Sir, any cost incurred, whether actual cost or imputed cost, that means opportunity cost on the equity, including preference share capital. Generally, preference share capital, we don't consider it as a liability. So as long as you are not considering it as a liability, any cost you are incurring on the equity as well as preference share capital, this standard is not applicable, sir. So this standard does not deal with the actual or imputed cost of owner's equity, including preference share capital not classified as liability. Okay. Now, so we understood the core idea of this standard, sir. Now the next thing is, okay, sir, this standard says borrowing cost, that is interest and all other costs relating to borrowings, directly related to either acquisition of qualifying asset, production of qualifying asset, or construction of qualifying asset, we will capitalize. Okay. Now the question is, sir, when you are going to start capitalize, sir, and when you are going to stop capitalization, sir, and in between, is there any brief period you are going to suspend the capitalization, sir? So three things we need to understand now. When we are going to commence capitalization of borrowing cost, when we are going to suspend capitalization of borrowing cost, when we are going to cease capitalization of borrowing cost. So these are the three things we need to understand, and we need to finally learn the amount of capitalization. Listen to me carefully, sir. Sir, when you are going to commence capitalization of borrowing cost, sir, the standard says three conditions must be satisfied to commence capitalization of borrowing cost, the starting point. First condition is borrowing cost being incurred, sir. Second is expenditure being incurred on the qualifying asset. First, borrowing cost being incurred. Second, expenditure being incurred on qualifying asset. Third, activities must be in progress. Which activities? The activities which are necessary to make the asset, qualifying asset, ready for its intended use or sale must be in progress. If these three conditions are satisfied, na sir, we can commence capitalization of borrowing cost. So the standard says first borrowing cost being incurred. That means we must take the loan. When the loan taken, obviously borrowing cost being incurred, because interest is a period cost, time cost. So as and when the time progresses, interest cost will generate. So borrowing cost being incurred. Second, expenditure for the asset being incurred, expenditure on the qualifying asset being incurred. Third, activities necessary to prepare the asset for intended use or sale are in progress. So if these three conditions are satisfied, sir, we can capitalize the borrowing cost. See this, expenditure being incurred, borrowing cost being incurred, activities in progress. Sir, which activities? When we say activities are in progress, the activities which are necessary for its intended use or sale, necessary to make the qualifying asset ready for its intended use or sale. So the standard says activities in progress can be divided into two categories. Either physical construction of the asset must be going on, or technical and administrative work must be going on before physical construction. So they may frame a question on this. Activities in progress means the activities which are necessary activities, sir. Necessary activities for what? To make the qualifying asset ready for its intended use or sale must be going on. Then we say activities are in progress. Then only borrowing cost calculation will be started. And activities in progress will be two types. Either physical construction must be going on. Suppose we are constructing a building. The building construction must be going on. Or before physical construction, at least technical and administrative work must be going on. For example, there is a land, sir. On that land, I want to construct a building. Now, so before construction of this building, I need to obtain the permission from the local government. So suppose I already applied for permission. Now that means activities in progress. That is technical work, technical and administrative work before physical construction is going on. Therefore, third condition is satisfied, activities in progress. Or maybe designing the asset. For example, I want to construct a factory. I approach the engineer. Now, engineer is designing the plan. That means technical and administrative work is going on. That means any legal approval. So, even before physical construction, sir, before physical construction, any technical and administrative work is going on. That is also activities in progress. So if all the three conditions are satisfied, sir, then we need to capitalize the borrowing cost. Okay. Now see this. One more important point, sir. Suppose, sir, we purchase a land, sir, and on that land, development activities are going on. That means we are readying the land for its construction. That means activities are in progress. So if remaining two conditions are also satisfied, then it will be eligible for capitalization. Suppose you purchased the land, sir. Just you purchase the land. No development activities going on the land. That means no activities are in progress. No capitalization is allowed. So to start capitalization, sir, you need to see all the three conditions must be satisfied. And this one is very, very important, sir. Activities must be in progress. Which activities, sir? The activities which are necessary to make the asset ready for intended use or sale must be in progress. Those can be either physical construction of the asset must be going on, sir, or technical and administrative work is going on, sir. That is also activities in progress. For example, see this example, sir. X Limited is starting a construction project, sir. So basically it is financed by borrowing, so it's a qualifying asset. Construction, okay. The key dates given, sir. 15th May, loan interest related to the project started incurring. 2nd June, sir, technical site planning begins. Technical. 19th June 2011, expenditure on the project started incurring. 18th July, construction work begins. Now tell me, what is the commencement date? 3. First, borrowing cost being incurred. When borrowing cost being incurred? Borrowing cost being incurred. This one, first, borrowing cost being incurred. First condition. Second, expenditure on qualifying asset being incurred. When we have started incurring expenditure on the project? 19th June. So expenditure on qualifying asset. Third, activities in progress. Activities in progress means either physical construction or this one, technical and administrative work. Actually, construction work begins on 18 July. Technical work begins 2nd July itself, 2nd June itself. So therefore, this is the third condition. That is activities in progress. Now important, sir. So borrowing cost being incurred when, sir? 15th May. And expenditure on qualifying assets 19th June. And next one, sir, activities in progress. Will you consider 18th July or 2nd June? Activities in progress means either physical construction or even before physical construction, any technical work is going on. That is also activities in progress. That is 2nd June. So all the three conditions, when they satisfy, tell me. 15th May, 2 June, 2nd June, 19th June. So therefore 19th June is the date on which all the conditions are satisfied. So therefore company can commence capitalization from 19th June. See this, three conditions. So 19th June. So this is commencement of capitalization of borrowing cost. Next is, sir, suspension of capitalization. Important, sir. Sir, what is suspension? Sir, once you start capitalizing the borrowing cost to the qualifying asset, if the active development of the qualifying asset is interrupted, the standard says the period for which the active development is interrupted, for that period, whatever the interest cost is there, borrowing cost, don't capitalize, charge it to P&L account. But there are two exceptions here. If the active development is interrupted because of technical and administrative reasons, then no problem, you can continue the capitalization. Second, if the delay is necessary and if the delay is very normal, then also you can continue the capitalization of borrowing cost. No need to suspend the capitalization of borrowing cost. So the standard says when you are going to suspend the capitalization of borrowing cost, sir. So when the active development is interrupted, see this, capitalization of borrowing cost is suspended during extended period when active development is interrupted. And in the when the active development is interrupted, for that period, whatever the interest cost on borrowings, that will be charged to P&L. We will not capitalize. But there are two exceptions. That means we don't suspend, even though there is no active development. We will continue the capitalization. Two exceptions. When technical and administrative work is going on. Sir, when technical and administrative work is going on, sir, even the active development is stopped, no problem. You can continue the capitalization. Second, when the delay is very normal, sir. Sir, when the delay is normal and necessary part of development, and that is necessary also. The delay is necessary for the next stage of production. And when the delay is normal, then also you can continue the capitalization. For example, sir, we are constructing a bridge, sir. And because of the high water levels, because of the seasonal delay, in that season, there will be high water levels. So therefore, everybody knows that because of, in that particular season, we are constructing a building, we are constructing a bridge, sir. Now, because of the monsoons, heavy rains in that particular area, in that particular time, so high water levels, we stopped construction for 2 months. That means this delay is very normal, sir. Seasonal delay, like high water levels, which is affecting the bridge construction. So we will not stop capitalization. We will continue the capitalization if the delay is normal. And sometimes the delay is necessary part of development. For example, we are manufacturing inventory, sir. Example, genetically modified inventory seeds, like for example hybrid seeds we are manufacturing. Sir, when you are manufacturing hybrid seeds, you need to prescribe them in the prescribed conditions. You need to, it will take some time to get ready. So sometimes it will take more time than you expect. That means there is a temporary delay which is necessary part of development. In that case also, no need to stop capitalization. You can suspend the capitalization of borrowing cost. Here I have given two examples. For example, a construction suspended from October to January due to heavy equipment being moved to another site. So heavy equipment is there in the construction site, sir, and we move to another site. Now, in this case, capitalization of borrowing cost must be suspended since the active development was interrupted. And is that the interruption is technical and administrative work going on? No. Is that interruption is normal? No. Is it necessary for next stage of production? No. Then if it is not fit into any of the exceptions, then just suspend the calculation of borrowing cost. Suppose there is a temporary delay of 20 days during the completion of construction due to technical reasons. Technical reasons allowed. Technical and administrative reasons allowed. So calculation of borrowing cost shall continue during this temporary delay. For example, sir, we are constructing a building, sir. Labor strike happened 3 months. No active development. Now tell me, is labor strike is necessary? Normal? No. Therefore, for this 3 months, interest cost will be capitalized. Sorry, it will be charged to P&L account, which will not be capitalized. Okay. So the next one, stopping. Sir, when you are going to stop capitalization of borrowing cost? So the standard says, when substantially all activities necessary to prepare the qualifying asset for its intended use or sale are completed, then we will cease the capitalization of borrowing cost. Standard says capitalization of borrowing cost will cease when substantially, remember the words, substantially all activities necessary to prepare the qualifying asset for intended use or sale are completed. Even though some routine administrative work is pending, for example, painting pending, some decoration pending, doesn't mean, even though some routine administrative work is pending, we say substantially completed, then we need to stop the calculation of borrowing cost. Because the idea is we don't allow over capitalization. We don't want unnecessarily the asset will be increased. We will allow capitalization till the date the asset is substantially all necessary activities to make the asset ready for its intended use or sale are completed. Sir, sometimes, sir, can it be allowed to cease the capitalization of borrowing cost part-wise? Part-wise can I cease? Sometimes assets can be constructed part-wise. The standard says, if you are able to construct the asset part-wise and each completed part can be used separately, then you can cease the calculation of borrowing cost part-wise also. For example, sir, I am constructing one building, sir. See this. I am constructing one building. And this building has 5 floors. Okay. That means it's a qualifying asset. And it is capable of being completed in part-wise. First floor, second floor, third floor, fourth, fifth. Each part can be completed. Now the question is whether this completed part can I use separately? Answer is yes. Suppose first portion completed, first part, I can use it while construction for other parts are going on. Second part completed, I can use it separately while construction for other parts are going on. So therefore, if the qualifying asset is being capable of being completed in parts and each completed part can be used separately, then standard says you can cease capitalization of borrowing costs relating to that part, provided all substantial necessary activities to make that part ready for its intended use or sale are completed while construction for other parts are going on. Sometimes, sir, you may be able to complete the qualifying asset part-wise, but it cannot be used separately. For example, we are constructing a steel plant or cement plant or maybe a chemical plant. Now, one part is completed, but I can't use this completed part because it is like a processing missions. These are processing missions. One is connected with another. Therefore, only when the entire asset is completed, na, sir, I can use it. Now, in that situation, the standard says you don't cease capitalization part-wise. You have to wait till the entire asset is completed. That means only when substantially all necessary activities to make the asset ready for its intended use are completed, then you cease the calculation of borrowing cost. Therefore, very simple, sir. When you are going to cease calculation of borrowing cost, sir, when substantially all necessary activities to make the asset ready for intended use or sale are completed. And when you are going to cease the calculation of borrowing cost part-wise, sir, sometimes you may construct an asset part-wise. Each completed part you can use separately. Then you can cease calculation of borrowing cost part-wise also, provided substantially all activities necessary to make that part ready for intended use or sale are completed. Sometimes you may construct the qualifying asset part-wise, but you cannot use it separately, cannot use them separately. And in such situation, you have to wait till the completion of entire asset, then only you will cease the calculation of borrowing cost. And even some routine administrative work is pending, doesn't make any difference. You have to cease the calculation of borrowing cost because the painting, the decoration doesn't make the asset It doesn't change the character of the asset. The asset is substantially completed. Okay, so that's it, sir. So we completed when to start, when to suspend, when to cease. Now the last one is amount of capitalization. Okay, sir, how much amount you are going to capitalize? Sir, for the purpose of calculating the amount of borrowing cost to be capitalized, sir, first of all, understand borrowings are divided into two categories, sir. One is specific borrowings, another one is general borrowings. What is specific borrowings, sir? Specific borrowings means borrowings exclusively made for that qualifying assets. So borrowings exclusively for a particular qualifying asset, that is called specific borrowing. What is general borrowing, sir? See, general borrowings means they can be used for any purpose, not particularly for this qualifying asset. So borrowings which are not for specific qualifying asset. So whenever you want to calculate the amount of borrowing cost, sir, in the question first you see, is there any specific borrowings? Is there any general borrowings? Specific borrowings means they will clearly mention in the question that these borrowings are exclusively made for this qualifying asset. Now, in case of specific borrowings, how to calculate the borrowing cost? Very simple, sir. Total interest on the specific borrowings you take for that year minus any income from temporary investment of those borrowings. Important, sir. Any income from temporary investment of those borrowings. For example, you have taken 100 lakhs for construction of plant and machinery, sir. Will you use total 100 lakhs at a time? Not possible, na? You will use part wise. So meanwhile, the remaining funds, what you do? Ideal funds you will invest, na? From that you get any income, na? That is called income from temporary investment. Now the standard says from the borrowing cost on specific borrowings, you minus this income from temporary investment. Only remaining cost will be capitalized to the qualifying asset. Okay. This is in respect of specific borrowings. Now come to the general borrowings. Sir, when for the construction of qualifying asset, if you use any general borrowings, multiple borrowings, not for this qualifying asset, they have borrowed for different purposes. They can be used for multiple purposes. Like that, some borrowings, general borrowings, you have used it for this qualifying asset also. Then what to do? Standard says, in respect of the general borrowings, you need to find out one common capitalization rate. So we need to find out the weighted average cost of capital. That is nothing but you need to find out the common capitalization rate. Suppose there are 3 or 4 borrowings, general borrowings, and from each borrowings you used some amount for this qualifying asset. Therefore, first you need to find out the one common borrowing rate, that is called capitalization rate. This capitalization rate you will apply on the amount which is used from the general borrowings. Then you will get the borrowing cost. Okay. So this you will understand better, sir, when we solve some questions, sir. So, but first understand, sir, how much amount of the borrowing cost to be capitalized. That depends on two things: specific borrowings, sir, general borrowings. In case of specific borrowings, sir, whatever the interest cost incurred, from that any income from temporary investment you deduct, sir. In case of general borrowings, sir, you find out one common capitalization rate, sir. That common capitalization rate you apply on the amount what we have spent. Then you will get the borrowing cost. Okay. Now let us solve some questions relating to it, sir, so that you will understand it better. I'm going to solve some questions for you. Illustration number 2. Important questions I will solve, sir. Illustration number 2, you see. Illustration number 2. The illustration number 2, sir. X Limited began construction of new building on January 1st, 2011, sir. It obtained 1 lakh special loan to finance the construction of the building. So it is specific borrowings. It is specific borrowings. On 1st January 2011 at an interest rate of 10%. The company's other outstanding 2 non-specific loans, that means general borrowings. So 2 non-specific loans, sir, 11% 5 lakhs, 13% 9 lakhs. So they are constructing one new building, sir, which is a qualifying asset. And the construction started on January 1st, 2011, sir. With a specific borrowings of 1 lakh, non-specific borrowings also given, sir. Now the expenditure that were made on the building project was as follows. So January 2 lakhs we spent, sir. April 2 lakh 50. July 4 lakh 50. December 1 lakh 20, sir. Building was completed by 31st December. So 12 months it has taken, sir. So it's a qualifying asset. Following the principles prescribed in A16 borrowing cost, calculate the amount of interest to be capitalized and pass journal entry for capitalizing the cost of borrowing cost in respect of building. So they are asking how much interest cost will be capitalized in this case, sir. So how you are going to calculate the interest cost in this case? See, very simple, sir. First of all, sir, to calculate interest, what is the basic formula, sir? Amount into, right, rate of interest into period, right? This is interest calculation. So in this case, sir, they are constructing one building and they have incurred expenditure on different dates: January, April, July, December. So January, April, July, December. Now tell me how much amount they spent. 2 lakhs, 2 lakh 50, 4 lakh 50, 1 lakh 20. 2 lakhs, 2 lakh 50, 4 lakh 50, 1 lakh 20. This is what they spent, correct? 2 lakh 50, 4 lakh 50, 1 lakh 20. Now listen to me carefully. So I know the amount and I know the period when from which they have incurred. So therefore 2 lakhs into 12 by 12, because this expenditure is incurred from January. So January to December. But this expenditure incurred on April. So that means January, February, March, this is not there. Only 9 months. Into, this is incurred on July. July to December, 6 months. Next December, 1 month. Because amount into period, sir. Amount, period. So because see, different dates the amount was incurred. Suppose for building construction, first they incurred how much? 2 lakhs. Generally what happens now? From specific borrowings, they spend 1 lakh here. Remaining they spend from general borrowings. So from the beginning. And next on, always we make an assumption that in the beginning, whatever the expenditure you spend on the qualifying, it is spent from specific borrowings. Okay. And April, July, December, these are all general borrowings. Generally. Because specific borrowings entirely exhausted, entirely used. So therefore, amount into period. Now I need to multiply it with rate of interest. Now, if I find out the average cumulative expenses in this case, so 2 lakhs into 12 by 12 will be 2 lakhs. 2 lakh 50,000 into 9 by 12. It will be 1 lakh 87,500, correct? 4 lakh 50,000 into 6 by 12. 2 lakhs 25,000. 1 lakh 20,000 into 1 by 12, 10,000. So therefore the total amount what we have incurred, average cumulative expenses based on time, 2 lakhs 187,500, 2 lakh 25 plus 10,000. So it is 6 lakhs 22,500, sir. But see, in the 6 lakhs 22,500, what is the specific borrowings? 1 lakh. How much amount you spend from general borrowings average, which is eligible for capitalization of interest? Because to calculate interest, amount into period into rate of interest, we already multiplied with the period. So from this 6 lakhs 22,500, if I reduce 1 lakh, 5 lakh 22,500 they spend from the general borrowings. So therefore, what will be the borrowing cost? That is interest on specific borrowings, sir. 1 lakh into specific rate of interest. What is the specific rate of interest? So 10%. So take 10% directly. So therefore 10,000 is the borrowing cost in respect of specific borrowings. Now in respect of general borrowings, 5,22,500 average cumulative expenses which is eligible for capitalization of borrowing cost to calculate the interest. Now tell me which rate you will apply, sir. I told you in theory, when you are calculating the general borrowings, in respect of borrowing cost of general borrowings, you need to find out what capitalization rate. Here there are two types of general borrowings. What are those? 11%, 5 lakhs, 13%, 9 lakhs. So 11%, 13%, 5 lakhs, 9 lakhs. So what is the borrowing cost? Can you tell me how to find out the capitalization rate? 5 lakhs into 11%. 55,000. 9 lakhs into 13%. 1 lakh 17,000. So therefore here 55,000 plus 117. It will be 1 lakh 72,000, sir. 1 lakh 72. So therefore 1 lakh 72,000 divided by total borrowings 14 lakhs. 14 lakhs. So if you find out the average rate of borrowing cost, average interest rate. So that is 12.28 57. So 12.286. 12.286. This is the average rate. 12.285 approximately. So therefore I will apply here 12.285%. So 5,22,500 into 12.285. So 64,189.125. Therefore the total borrowing cost to be capitalized is 74,189.125. That's it. And what is the entry here? Asset billing account debit. Billing to bank account. So billing to bank, nothing but interest borrowing cost we are capitalizing. 74,189.125. This is the borrowing cost plus original cost we incurred on the building is how much? All this expenditure. 2 lakh, 2 lakh 50, 4 lakh 50, 4 lakh 50 plus 4 lakh 50, 9 lakh, 9 lakhs plus 1 lakh 20, 10 lakh 20. So 10 lakh 20. So 10 lakh 20 plus 74,189. That is the total cost of the building. This 10,94,189. This is how you need to calculate the interest cost. So always find out what capitalization rate. How to find out capitalization rate? The borrowing cost divided by the borrowings. General borrowing cost, total borrowing cost. In this case, 1,72,000 divided by general borrowings. You will get the one rate, common rate. So that rate you apply on the general borrowings. Okay. And also, sir, I will show you one recent examination question. Yeah, this question, sir. Zebra Limited question. This question asked in May 2022. See this question. The Zebra Limited, sir, began construction of the new plant on 1st April 2021, sir, and obtained a special loan of 20 lakhs. So specific borrowings and finance. The rate of interest of the loan is 10%. The expenditure that was incurred on the construction of the plant, April 10 lakhs they have incurred. 1st August 24 lakhs. 1st January 4 lakhs. Okay. The company's other outstanding non-specific loan is how much, sir? 46 lakhs. Interest rate 12%. Now calculate the amount of interest to be calculated. Simple question, similar to the last question we have solved, sir. See in this question, but one important thing, sir. See this. In this question also, company constructing what? A building, right? New plant. Sorry, plant they are constructing, sir. And they have incurred expenditure on April, August, January. So April, August, January. First of April, 1st of August, 1st of January. Correct? Okay. Now, how much they incurred? 10 lakhs, 24 lakhs, 4 lakhs. See, 10 lakhs, 24 lakhs. And the last one is 4 lakhs. Now, important thing is, first, how much is the specific borrowings? 20 lakhs. See, on April 1st, we incurred 10 lakhs, na, sir. First, it is incurred from the specific borrowings. So, from the specific borrowings of 20 lakhs, we spend 1 lakh. Still in the specific borrowings, how much is there? 10 lakhs. That we will incurred on August 1st. And remaining 14 lakhs, sir, general borrowings. Important, sir. General borrowings. Because, sir, on 1st April, we incurred 10 lakhs, sir. I told you the assumption is first we need to spend from the specific borrowings. And second, we incurred 24 lakhs, na, sir. This 24 lakhs, sir, first we spend from the remaining specific borrowings of 10 lakhs. Remaining we will spend from the general borrowings. And last one, entirely from general borrowings. Right? So therefore, if I calculate the average cumulative expenses like last one, 12 by 12 I will take. And in these two things I will take. For the first 10 lakhs, since it is relating to specific borrowings, sir, I will take for the entire 12 months because the standard says in respect of specific borrowings, the total interest cost we need to be capitalized to qualifying asset. Therefore, specific borrowings, it is whatever what is there from the beginning of the year, we need to consider total 12 months interest. Even though this 10 lakhs is spent from the August month, but in respect of general borrowings of 14 lakhs, you consider from August, September, October, November, December, January, February, March. So 9 months I will take. August to correct? So I mean April, May, June, July. So 4 months you need to wait. You need to, I think 8 months, sir. August, September, October, November, December, January, February, March. 8, sir. Not 9. Please take here 8. And also this one, sir, 4 lakhs when you spend January. So 4 lakhs entirely from general borrowings. So 4 lakhs into 3 by 12. Important, sir. So you understand this. Because second time you spend 24 lakhs. first you spend from the specific borrowings. Specific borrowings, entire interest will be considered. So therefore, if I consider here, it will be 10 lakhs. It will be 10 lakhs. And this one, 14 lakhs into 8 by 12. It will be 9 lakhs 33,333. And this is 4 lakhs into 3 by 12. It is 1 lakh. So total it will be 10 lakhs plus 10 lakhs plus 9 lakh 33,333 plus 1 lakh. So total it will be 30 lakhs 33,333. Okay. 30 lakh 33,333. And you know, in this specific borrowings is 20 lakhs. On this 20 lakhs, 10% interest. So entire 2 lakhs will be borrowing cost to be capitalized. Remaining out of 30 lakh 33,333, 20 lakhs you remove. So general borrowings, how much you spend? 10 lakhs 33,333 into the capitalization rate. But here there are no multiple borrowings, only one. The interest is 12. So take 12% directly. So 10 lakh 33,333 into 12%. So it will be 1 lakh 24,000. So therefore the total borrowing cost to be capitalized 2 lakhs plus 1 lakh 24. Total 3 lakhs 24,000. So the answer is 3 lakh 24,000. Correct? Yes. See this 3 lakh 24,000 is the total interest cost to be capitalized. Very, very important question. Okay. That's it. Now in this chapter, sir, last topic is excess of carrying amount over recoverable amount. Very simple, sir. Sir, when you add the borrowing cost, because of the adding of borrowing cost, if the qualifying asset, the value of the asset exceeds its recoverable amount, market value, more than market value, then whatever the excess, we need to write it down, sir. So we need to write it down as per either, if it is inventory, if the qualifying asset is inventory, as per AS2, sir. If it is other asset, maybe as per AS28. So after capitalization of the borrowing cost, if the cost of the assets exceeds the market value, see that suppose building cost is 10 lakhs. Now I capitalize the borrowing cost as per A16. Now it becomes 15, but the market value is only 13. This standard says it cannot happen. Because of the capitalization of borrowing cost, your cost of asset cannot exceed the market value. Therefore, whatever the excess is there, you should please write it down. So that is called excess of carrying amount over recoverable value. And disclosures, you need to make what is the amount of borrowing cost capitalized, what is the accounting policy adopted by the company for borrowing cost. So you please solve all the questions. Very simple questions. These are all, whether it is a qualifying asset or not. By looking at it, you can say. So, and I clearly told you when it is become a qualifying asset, please try to apply all the points I have explained. And this revision is exclusively for examination purpose, sir. Please understand. The next accounting standard for our discussion is Accounting Standard 20, sir. Accounting Standard 20 is about earning per share. See, this standard provides you the methodology for computation of earning per share. You know, earning per share is one of the key financial tool for any organization. Now, if I want to know the performance of the entity over the last few years when compared with the last few years, how the performance of the company is, generally I need to make analysis of the financial statements. Is there any indicator which gives me a quick glance over the performance of the entity when I compared with the previous years? Maybe EPS is that kind of a tool, financial tool, which will give you a quick idea about how the company is performing when you comparing with the previous years. So suppose for example, 21-22, the EPS of the company is 10 rupees. That means one share earned a profit of 10 rupees. The same share in the year 22-23 earned 15 rupees. Next year 20, next year 25. So if I look at the EPS, it is keep on increasing. That means this company may be performing better. So of course there can be an exceptions also, but prima facie, if the EPS is keep on increasing, we can say the company is performing better. And also one more important thing, sir, when you are preparing the financial statements of the company as per schedule 3, when you prepare P&L account of the company, incomes we will show, expenses we will show, we will get PBT. After that we reduce the tax expenses, then you will get PAT. Now after that, if you observe, sir, one more item we need to disclose, that is EPS. So basic as well as diluted EPS, both the EPSs we need to show in the P&L accounts. So understand the prominence of EPS. It is directly shown in the face of the P&L account. Therefore, people are using this EPS to know the performance of the entity. to compare with the previous years, what will be the performance of the entity? Maybe they are using EPS as a tool, okay, to know the performance. So therefore, isn't it necessary to have proper principles for calculation of EPS? Otherwise, what happens? Every company will calculate EPS in such a manner that it is keep on increasing, and they will show to the world that we are performing better when compared with last year. That's why our institute has come up with a separate standard for EPS. And in this standard, they will provide you the methodology for computation of EPS. They will give you the formulas to compute the EPS. They will give you what are the necessary adjustments you need to consider for calculation of EPS. So see this, the method to calculate the basic and diluted EPS is provided in accounting standard 20. Now in this standard, sir, EPS basically two parts. One is basic, another one is diluted EPS. Now first we are going to discuss the basic EPS, then we are going to discuss the diluted EPS. Let us start what is basic EPS. Sir, basic EPS, understand the formula. The formula is what is the net profit or loss attributable to the equity shareholders during the period. Equity shareholders. What is the net profit or loss for the period which is attributable to the equity shareholders during the period divided by weighted average number of equity shares outstanding during the period. Weighted average number of equity shares outstanding during the period. So numerator, denominator. One aspect I want for calculation of basic EPS is net profit or loss which is attributable to equity shareholders. Sir, how to get net profit or loss which is attributable to equity shareholders? PAT minus preference dividend. Profit after tax you will get from the P&L account. From that you reduce preference dividend. Then whatever the profit left out, that is nothing but net profit or loss which is attributable to the equity shareholders during the period. Or if you start from PBT minus tax expenses minus preference dividend, you will get the net profit or loss attributable to the equity shareholders. And understand here, PAT minus preference dividend if I do, I will get the net profit or loss attributable to the equity shareholders. Or if I start from the PBT, profit before tax minus tax expenses minus preference dividend, I will get the net profit or loss attributable to the equity shareholders. Now when it comes to preference dividends here, we can have non-cumulative preference shares, we can have cumulative preference shares. In case of cumulative preference shares, what happens is dividend will keep on accumulate unless you paid, unless you paid. Therefore, in case of cumulative preference shares, whether it is provided or not, we need to consider, we need to deduct preference dividend. Even if it is not provided in the books, no problem. If the shares, preference shares are cumulative, we need to deduct preference dividend from the PAT, or we need to deduct preference dividend from the PBT to arrive the net profit or loss attributable to equity shareholders. Now, in case of non-cumulative preference shares, so dividend will not accumulate. Therefore, only if it is provided in the books that the dividend has been paid or dividend has been declared, then reduce the preference dividend. So this is about the one aspect of the basic earnings per share. So basic EPS. See this, net profit or loss attributable for the period attributable to the equity shareholders. So how to calculate net profit or loss attributable to the equity shareholders? See this, income suppose 100, expenses 40. This is profit before exceptional items, extraordinary items. Then exceptional items, extraordinary items I will adjust. Then I will get profit before tax. From that I will reduce the tax expenses. I will get profit after tax. Now from that I need to reduce preference dividend. Then I will get, so this is the net profit or loss for the period which is attributable to the equity shareholders. Now how to calculate the net profit or loss which is attributable to the equity shareholders, sir? Either PAT minus preference dividend. Preference dividend. In case of cumulative preference shares, consider preference dividend even if it is not provided in the books. In case of non-cumulative, consider preference dividend only if it is provided, given in the books. Okay, or else you can find out the net profit or loss attributable to the equity shareholders by PBT minus tax minus preference dividend. So this is one aspect, sir, we have discussed. The next aspect, which is the most important aspect, is weighted average number of equity shares outstanding during the period. Sir, how to calculate the weighted average number of equity shares outstanding during the period? Sir, take the opening outstanding shares. For that, add any shares issued during the year, add, minus any shares bought back and cancelled, minus buyback. Because opening shares, any shares you issued will be added. because my number of shares will increase, minus buyback, because of buyback my shares will decrease. Most important thing is when you are calculating the weighted average number of equity shares, number of shares are multiplied with the time weight factor. You need to multiply with the time weight factor. So see this, the weighted average number of equity shares is based on shares outstanding at the beginning of the period, adjusted for buybacks and issuances, any fresh issue or maybe buyback adjustment, multiplied by time weight factor. So time weight factor you need to consider, because sir, the idea is very simple sir. It is not the shares at the end of the period, it is how much shares are outstanding during the period. So from which date that particular type of shares come into the effective, from that date till the year end, we need to consider the time weight factor. Okay, for calculation of weighted average number of equity shares. See this. So the weighted average number of equity shares outstanding during the period is number of shares outstanding at the beginning of the period, adjusted by the number of equity shares bought back or issued during the period, multiplied by time weight factor. For example, I will show you the first question, illustration number 1. You see in this illustration sir, so in the beginning we have 1800 shares. On 31st May, company issued shares for cash 600. Now on 1st November, company bought back 300 shares. Calculate the weighted average number of shares. How to calculate weighted average number of shares here? Weighted average number of equity shares is equal to opening how many shares? 1800, and they are there from the beginning. So into 12 by 12 plus how many shares we issued on 31st May? 600. So when they have issued 31st May, that means they are outstanding for how many months? So January to May, 5 months. January, February, March, April, May, they are not there. So therefore they are there for the remaining 7 months. Sir, here they are following calendar year, sir, because January to 31st December. So we need to consider for 7 months. And next buyback happens, sir. Sir, because of buyback, your shares will reduce. So minus how many shares are bought back? 300. And November, December, 2 months they are not there in the business. So 2 months time weight factor will be deducted. So therefore 1800 plus 600 into 7 by 12, 350 minus 300 into 2 by 12, 50. So therefore 1800 plus 350 minus 50. It is 2100. This is the weighted average number of equity shares. 2100 is the weighted average number of equity shares. This is one way to calculate the weighted average number of equity shares. There is another way also to calculate the weighted average number of shares, sir. Like for example, in this case, in the beginning, how many shares are there? 1800. So when was the last time? Next time the change happened 31st May. That means first 5 months only 1800 shares. Now next for this 1800 another 600 is added. That means 2400. And this 2400 shares are outstanding for the next change. That is 1st November there is a buyback. So June, July, August, September, October. So 5 months. And after that in the company, from 2400, 300 shares were bought back and cancelled. So now 2100 shares will be there for the next 2 months, November, December. So therefore 1800 into 5 by 12, 750 plus 2400 into 5 by 12, 1000 plus 2100 into 2 by 12, 350. So total 750 plus 1000 plus 350. You will get the same answer, 2100. So either you can calculate individually or you can calculate like this. So weighted average number of shares can be calculated any one of these manners depending upon the information given in the question. But the suggested way is this one. Suggested way is individually if you calculate, there will not be any confusion. So understand, when you are calculating the weighted average number of equity shares, you need to multiply with the time weight factor, because we are calculating earning per share now. That means these shares are eligible to participate in the profits from which date. So that's why the time plays an important role. Because see, I purchased the shares at the beginning of the year. That means I am contributing to the company's capital from the beginning of the period. So therefore, I may eligible to participate in the profits from the beginning. Suppose if I purchase shares from the middle of the year, maybe I introduced the capital in the middle of the year. Therefore, maybe I am eligible to participate in the profits of the company only for the 6 months. That's why the standard says when you are calculating the earning per share, you need to multiply number of shares with the time weight factor. Time is also very, very important date. So, okay, sir, you said you need to multiply number of shares with the time weight factor. So, from which date onwards these shares are coming into effect? The effective date for inclusion in weighted average number of equity shares are also given in the standard. Important. Suppose if the shares are issued for cash, date cash is receivable. The date on which the cash is receivable, from that day onwards we need to consider them for calculation of weighted average number of equity shares. Suppose shares are issued for debt conversion. Suppose any convertible debentures are converted into equity shares, any convertible bonds are converted into shares. So from which date onwards these shares will be considered? So date of conversion. Suppose if any shares are issued for interest or principal settlement. So to settle any interest portion, to settle any principal portion, if you have issued any shares, so these shares are coming into effect from the date the interest ceases to accrue, date on which the interest ceases to accrue on those financial instruments. Next, shares issued for liability settlement. Sir, to settle any liability if you have issued shares, so the date the settlement becomes effective, from that day onwards these shares are considered for weighted average number of equity shares. Now, shares issued for asset acquisition. Suppose if you acquire any asset by issue of the shares, so the date the asset is recognized, from that day we need to consider. Suppose if shares are issued for any services rendered, now the date the services is rendered, from that day the shares will be considered. Next, suppose if shares are issued for amalgamation and the amalgamation is in the nature of purchase, then date of acquisition date, important. Suppose there is an amalgamation and the amalgamation is in the nature of merger, then we need to consider the shares issue date is beginning of the reporting period. Why, sir? See, in amalgamation, I told you there are two categories: amalgamation in the nature of purchase, amalgamation in the nature of merger. There are 5 conditions. If all 5 satisfied, we call it as a merger. All assets and liabilities of transfer must be transferred to transferee company. All must be transferred at book value, and transferor company business must be carried on by transferee company. Shareholders holding not less than 90% face value of equity shares of transferor company must be agreed, must become the equity shareholders of transferee company. The purchase consideration will be discharged wholly in the equity shares. These are the 5 conditions. I told you why this is called merger, because there is a genuine pooling of resources. The entire transferor company balance sheet is simply merged into the balance sheet of the transferee company, as if this combined entity is there from the beginning of the period. So because there is a genuine pooling of interest, in case any shares are issued by transferee company to the transferor company and the amalgamation is in the nature of merger, you need to consider the shares from the beginning of the reporting period, because I am not selectively taking the transferor company assets and liabilities. I am whole balance sheet of the transfer company, whole financial statements of transfer company, I'm merging into my business. Therefore, it is amalgamation in the nature of merger. You need to consider the effective date for issue of the shares is beginning of the reporting period. They may frame one question on this. Please see carefully. Next, sir, when you are calculating the weighted average number of equity shares, sir, there are different situations arise. There are 4 situations, sir. One is partly paid up shares. Another one is shares with different nominal values. Third one is bonus shares, share split, reverse share split. Last one is right issue. These are the 4 situations, sir. Very, very important. Please see one by one. First, partly paid up shares, sir. Suppose the face value of the share is 10 rupees, sir, and paid is 5 rupees. Now, basically, this is called partly paid up share. Now, if at all in any company there are partly paid up shares, how you are going to consider them for calculation of weighted average number of equity shares? Sir, the standard says whenever there is a partly paid up shares, you need to treat them as a fraction of an equity share to the extent they were entitled to participate in the dividend relative to the total fully paid up value of the share. That means total face value 10 rupees. You paid 5. So that means in proportion to this you take, provided they are eligible to participate in the dividend only to the extent of the capital they contributed. Sir, suppose for example, if they are not eligible to participate in the dividend in respect of the partly paid amount, then don't consider them in calculation of weighted average number of equity shares. They may be considered for calculation of diluted EPS. Why? Because they are not entitled to participate in the dividend. When they are not entitled to participate in the dividend, how can you calculate EPS for them? Earning per share. Earnings is nothing but profits. Dividend is given from profits only. When you are not eligible to participate in the dividends of the company, how can EPS is applicable to you? So therefore, the point here you need to understand is, if there are partly paid up shares, we need to take the fraction of an equity share to the extent they were entitled to participate in the dividend relative to the fully paid up equity shares. Sir, in relative to the fully paid up equity share, fully paid up share is 10. How much you paid, sir? 5. Are you eligible to participate in the dividend to the extent they were entitled to participate in dividend? For example, 5 rupees you paid and you are entitled to participate in the dividend only to the extent of the amount you paid, 5. So take proportionately 5 by 10. Therefore, number of equity shares, for example, 1000 equity shares into time weight factor. Suppose these shares are issued from the middle of the year, so 6 by 12 into this one, that is partly paid up shares. What is the face value? 10. This is a fully paid up amount. How much you paid? 5. And if you are eligible to participate to the extent of the amount you paid up, take proportionately. Therefore, 1000 into 6 by 12 into 5 by 10. So therefore, 250 is the number of shares we need to consider. Important. If at all partly paid up shares are given, you need to consider them proportionately to the extent they are entitled to participate in the dividend, sir. Okay, I will show you. See, this is the question. You see this question. So in this question, on January 1st, sir, not this question, partly paid up shares. Wait. Partly paid up shares. See this question, I think partly paid up shares. Suppose the balance of the shares at the beginning, January 1st, 2023, 2000 shares, sir. Nominal value 10, paid 10. That means fully paid. Next, on 1st July, see this company issued 800 shares, nominal value 10, but amount paid is 4. So how to calculate weighted average number of equity shares in this case? Very simple. So in this case, the weighted average number of equity shares is equal to opening how many shares? 2000. So 2000 into time weight factor. They are there from the beginning. So 12 by 12 plus they are fully paid up. And then next, how many shares issued? 800. They are issued on 1st July. That means 6 months we need to consider effective date into they are partly paid up. So we will consider to the extent their amount eligible to participate in the dividend, 4 rupees out of 10. So 4 by 10 we need to take. So therefore, see here I calculated 2000 into 12 by 12, 800 shares. They are partly paid up shares. So first time weight factor, then amount weight factor. That means out of the face value of 10, they paid 4. So to the extent of that, proportionately we need to consider. Therefore, 2160 is the weighted average number of equity shares for the calculation of EPS. Okay. So this is the first different situations. First situation. Second, sir, there is another situation called different nominal values. Sir, sometimes company will issue shares, different class of shares with different nominal values. Like for example, the face value is 10 rupees. Next time, another one is the face value is 5 rupees. So then in such a situation, how to calculate the weighted average number of equity shares? Simple. Find out the equivalent number of shares having the same nominal value. Find out the equivalent number of shares having the same nominal value. So when an enterprise has equity shares for different nominal values, but the same dividend rights. Sir, what is the meaning of same dividend rate? Suppose for example, company issued equity shares, nominal value 10 rupees. And these shareholders who purchased this, they are entitled to participate in the 100% dividends. And similarly, the company issued equity shares with the nominal value 5. These shareholders are also eligible to participate in the dividend 100%. Therefore, they are called, they may have different nominal values, but with the same dividend rights. Then in such a situation, the number of equity shares is calculated by converting all such equity shares into equivalent number of shares of the same nominal value. Equivalent number of shares of the same nominal value. So convert them into shares of equivalent nominal value. See this. Illustration number 2. For example, there is a company, sir. In the beginning of the year, 1800 shares are there. Face value 10, paid up value 10. Next on 31st October, they have issued 600 shares. 10 rupees face value. Oh, wait, sir. Not this one. Yeah. So see this. There is a company, Bright Futures Limited. They have the following 2 classes of shares at the beginning of the financial year. And there are no other transactions in share capital. The profit earned by the company during the period 3,60,000, sir. Okay. So see this. On 1st January, the number of shares in the beginning is 2,400. Face value 10. Paid up also 10. On 1st January 2024, they have issued another shares, 1,200 shares. But look at the face value 5. So paid up is 5. So understand the difference here. Shares with different nominal values. So whenever there is a shares with different nominal values, find out the equivalent number of shares having same nominal value. That means 2,400. See this, 2,400 into they are there from the beginning 12 by 12 plus we have issued 1,200 shares. They are also there from the beginning. But the important thing is we need to find out the shares of equal and nominal value. So 10 rupees is the face value. I will convert every shares, but they have paid 5. So that means 1200 into 5 divided by 10, sir. I will get equivalent number of shares. 1200 into 5 divided by 10. So I will get 600 shares. I will get 600 shares. So 600 is the equivalent number of shares. So simply the 5 rupees. 5 rupees is what, sir? 5 rupees is the old face value. 10 rupees is what, the new face value, which you want to convert, which you want to find out the equivalent number of shares having same nominal value. Therefore, in this case, the weighted average number of equity shares is this much. See this, 2400 into 12 by 12 plus 1200 into 12 by 12 into 5 by 10. So you will get 3000 shares. And in this question, sir, they have given profits also 3,60,000. Now see this, 3,60,000 is the net profit or loss. Weighted average number of equity shares is how much? 3000, right? So 3,60,000 divided by 3000. So 120 is the EPS. This 120 is for face value 10. If the face value is 10, the EPS is 120. Now if the face value is 5, what will be the EPS? Exactly half, 60. So this is how you need to find out EPS in case of shares with different nominal values. So whenever there are shares with different nominal values are given, find out equivalent number of shares having the same nominal value. Next concept, sir, bonus issue, share split, reverse share split. Understand. First I am going to talk about the bonus issue. Sir, what is bonus shares, sir? Bonus shares means the shares which is given by the company freely to the existing shareholders. Now, because of the bonus issue, is there any funds flow to the entity? No new funds flow to the entity. Correct? Yes. But because of bonus issue, what happens is the number of shares will increase. My number of shares are increasing, sir, but there is no inflow of funds. That means we are not receiving any amount by issue of equity shares. Bonus shares. That means it does not have the capability to affect my profit. That means numerator part, that is net profit or loss attributable to equity shareholders, will not be affected by bonus shares. But my denominator, that is number of shares outstanding during the period, are increasing. Suppose in the company there are 1000 shares. Company issued another 1000, so 2000 shares. Now what happens is, look at this. Suppose there is a company. This company, current year 2024, sir, previous year 2023. Suppose net profit I considered, last year net profit 10 lakhs, this year also 10 lakhs. That means net profit is same. But look at the number of shares. Last year 1 lakh shares, and during the year company issued bonus shares, 1:1 ratio. Therefore the number of shares has become 2 lakhs. So previous year number of shares 1 lakh, this year 2 lakhs. Now why it has become 2 lakhs? Because of bonus issue. So therefore what will be the basic EPS? Net profit divided by number of shares. 10 lakhs divided by 1 lakh. 10 rupees is the EPS. When it comes to current year, 10 lakhs divided by 2 lakh shares. So it will be 5. Now tell me, if you are users of financial statements, you will see the current year EPS. What is the current year EPS? 5. What is the last year EPS? 10. So what is your observation? You feel that this company EPS has been decreased. That means the company is not performing well. Whereas that is not the real picture. Whatever the profits earned by the last year, the same profits earned in the current year also. But EPS was decreased. That means here users may mislead it by looking at the decrease in EPS. Users may be misled. So we need to revise this position. We need to give true and correct position to the users of financial statements. So that's why the standard says, in case of shares, bonus shares or share split, what is happening is no new funds are coming to the organization. That means there is no impact on the profits, but there is an impact on the weighted average number of shares. That's why the average EPS is decreasing. So obviously when your profits are constantly same, and your number of shares increasing na, sir, obviously average EPS per share will decrease na, average profits per share will decrease na. Yes, but that is not the scenario here. So these bonus shares does not have the impact to impact my profit, because no new funds are coming to the organization. That means no capital. If there is no capital, means that cannot be invested in the business. So therefore it does not affect my profit. But in the current year there is a bonus issue. Because of that my number of shares are increasing and my EPS is decreasing. So users might be misled. That's why the standard says, in case of bonus issue or share split. Share split also same. Just number of shares are increasing without having any corresponding effect on the profits. Therefore, in these two situations, what the standard says is you do one thing. You restate the previous year EPS, assuming that these bonus shares or these splitted shares, these increase of the shares is there from the beginning of the last year. So in this case, if I assume the bonus issue of 1 lakh shares is also there in the last year, the last year number of shares will be 2 lakhs. Last year net profit is 10 lakhs. So 10 lakhs divided by 2 lakhs, 10 rupees, 5 rupees. So see this, I need to restate the EPS of 2023. So if I restate the EPS by assuming that this bonus shares is also there from the beginning of the last year, my restated EPS is 5. My restated EPS is 5. So this is the concept of bonus issue. So once again, I'm explaining the concept of bonus issue, sir. Very simple. Sir, if at all there is any bonus issue in the company during the period, so because of the bonus issue, number of shares are increasing, but there is no new funds to the entity. That means literally does not have any impact on the profits. It is having only impact on the number of shares. So it has the capability to reduce my average earning per share. So users might get misled by looking at this. Even though this issue of shares does not have the capability to affect my profits, but my EPS has been decreasing. So therefore, I need to revise this situation. Therefore, what standard says is whenever there is a bonus shares, you do one thing. You restate the previous year EPS by assuming that this bonus is there from the beginning of the last year. Therefore, we need to disclose the current year EPS, last year EPS, and also restated EPS of the previous year. Therefore, users will compare the current year EPS with the last year restated EPS, and then they will get the clarity. Suppose the restated EPS is 5. Current year EPS is 5. That means when the users look at this, so they thought, yes, the company performance does not affected, which is reflecting from the net profit also. Now, same happens with what? Share split also. What is share split? For example, 10,000 shares of 10 each is there in the company, 1 lakh total share capital. Now, the company has divided each 10 rupees share into 5 shares of rupees 2 rupees each. Therefore, the number of shares will be 50,000. So, 50,000 equity shares of 2 each. Same capital, 1 lakh. Now, see, in this case, no inflow of funds, but the number of shares are increasing now. So, number of shares are increasing. Same as bonus issue. Just number of shares are increasing without having any impact on the profits. So, therefore, what happens to my average earning per share? It will decrease. Average EPS per share is decrease. So, therefore, I need to assume that these shares are there from the beginning of the last year, and accordingly, I need to restate the last year EPS. And there is a concept of reverse share split. So, reverse share split means number of shares will decrease. For example, 50,000 shares of 2 each, sir. Now, they have converted 10,000 shares of 10 each. So, number of shares decreased, but no inflow of funds. So, therefore, in this case also, we need to assume that this decrease is there from the beginning of the last year, and accordingly, we need to restate the last year EPS. Otherwise, users might get misled. So, understand the concept of bonus, share split, reverse share split. See, most of the students here confusing. I don't know why. So, I have given a simple clarification. So, understand if there is a bonus issue, if there is a share split, number of shares are increasing without having any impact on my profits. Therefore, because of that, my EPS is decreasing. In fact, even though my performance is same when compared with last year, but my EPS is decreasing. So therefore, isn't it misleading to the users of financial statements to state that last year I earned 10 lakhs, this year also 10 lakhs I earned. And because of the increase in the number of shares, my EPS is decreased. That too, which increase? Is it the real issue? Which is shares are issued for cash? No, bonus issue. That means the existing profits only diverted into capital, right? So therefore, you need to assume that this bonus issue is there from the beginning of the last year, and accordingly we need to restate the last year EPS. Same happens with share split. Same happens with reverse share split. So this is the concept of bonus issue. Okay. So relating to this, I think we have one question also. See this. In this question, so net profit for the year 2011 is 18 lakhs. Net profit for the year 2012 is 60 lakhs. And the number of shares outstanding until 30th September is 20 lakhs. Bonus issue happened 1st October 2012 was 2 equity shares for each equity share outstanding at 30th September 2012. Calculate the basic earning per share. So very simple here. Current year 2012, sir. So 2012 basic EPS is equal to net profit 60 lakhs given divided by number of equity shares. Sir, before bonus issue, how many shares are there? 20 lakhs. 20. Take it. And they are there from the beginning. 12 by 12. plus bonus issue. How many bonus shares are given, sir? 2 equity shares for each bonus shares. Correct? 2 equity shares for each equity share. That means 40 lakhs bonus shares. And in case of bonus issue, the assumption is it is there from the beginning of the last year. That means it is there from the beginning of the current year also. So 12 by 12. Don't consider from 1st October, because in case of bonus issue, the assumption it is there from the beginning of the last year. Okay. So if the bonus issue is there from the beginning of the last year, because bonus is nothing but converting the existing profits into share capital. So obviously it is there in the beginning. So in order to make sure that users might not get influenced, might not get distracted by looking at the EPS. So we need to restate the last year EPS. So the current year, it will be 60 lakhs divided by 60 lakhs. So therefore, I think EPS is 1 rupee, sir, basic EPS. And come to 2011, sir, last year EPS, basic EPS of the last year 18 lakhs, sir, divided by number of shares of the last year is 20. So 18 divided by 20. So it will be 0.9. So last year EPS is 0.9. But one more thing, sir, whenever there is a bonus issue in the current year, what we need to do? We need to restate the last year EPS. So therefore, the restated EPS is equal to last year 18 lakhs profit divided by number of shares, last year 20, and if the bonus is also there from the beginning of the last year, it will be 60 lakhs. So 18 divided by 60, it will be 0.3. So this is the restated EPS. So therefore, current year EPS 1, previous year basic EPS 0.9, restated EPS of the last year 0.3, assuming this bonus is there from the beginning of the last year. Therefore, now users will compare with this. See this, 0.3 is compared with 1. Suppose if I compare 1 with 0.9, I may not get true performance. If you observe, sir, 2011 my profit is 18, but 2012 it has become 60. Therefore, how much increase, sir? In this case, 42 lakhs, correct? 42 lakhs increase. So if I convert this 42 into 18%, 18 lakhs last year, how much increase? It will be 233% increase, sir, approximately. But if I compare 1 with previous year basic EPS 0.9, what will be the increase it is showing? 1 has become 0.9. That means the increase is 0.1 in the EPS. So 0.1 divided by 0.9 into 100. It will be 11.11 it is showing. So look at this. So if I compare basic EPS of the current year with the basic EPS of the last year, my EPS is increasing 11.11. But actually if you observe, the increase when compared with the last year is 233.33. Therefore, I need to compare what? Current year basic EPS with the restated EPS. Restated EPS is 0.3. So 0.7 will come. So 0.7 divided by 0.3. So this 0.7 divided by 0.3 into 100. So it will be 233.33%. So this is the increase, actual increase. Now you see, if I compare the basic EPS with the restated EPS, now my performance is reflecting the actual increase in the profits. That's why the standard says you do one thing, because of the bonus issue your shares are increasing without having any corresponding increase in the numerator, that is net profit. So therefore you make an assumption that this bonus is there from the beginning of the last year, and accordingly restate the last year EPS, and that restated EPS you compare with the current year EPS. Then users might not get misleaded and they will know the correct position of the organization. Okay, that's it. And the next important situation is right issue, which is most important, sir. In examination, they're asking this right issue. Understand what is right issue. Sir, when company wants to issue shares to the existing shareholders, so yet not freely, sir, but at a concessional price, those are called right shares. Basically, what is right shares? Right shares are nothing but the additional shares offered by the company to its existing shareholders at a concessional price. At a concessional price. For example, the market price is 20, company is offering at 15. So there is a concession of 5. Now the important point this standard says is, in case of right issue, you are issuing shares at a concessional price. So there is a bonus element in right issue. Whenever there is a bonus element in right issue, Like in case of bonus issue, what we have done? In case of bonus issue, we assumed that this bonus issue has the impact of only number of shares. It does not have any impact on the net profit. Therefore, just it is decreasing, just it is increasing the number of shares. Because of that, my EPS is decreasing. In fact, that is not the case. That's why we assumed that this is there from the beginning of the last year. Similarly, in case of right issue, there is a bonus element. So we need to calculate the bonus element in the right issue. Like in case of bonus shares, entire thing is bonus, entire shares whatever we are giving is bonus. But in case of right issue, there is a concession, so therefore there is a bonus element in right issue. So that bonus element we need to find out, and this bonus element we assume it is there from the beginning of the last year, and accordingly last year EPS is also restated. So the predominant thing in case of right issue is finding the bonus element in the right issue, because that bonus is assumed to be there from the beginning of the last year. Sir, how to find out the bonus element or bonus factor or adjustment factor? So this standard has given a formula to calculate the bonus element or adjustment factor. The formula is, what is the fair value of the share immediately prior to the exercising of the rights? Immediately before the right issue, what is the fair value of the share? Divided by theoretical ex-right fair value per share. Theoretical ex-right means after right issue, what is the fair value per share? That, see, first one, this fair value per share immediately prior to the exercising of the rights, they will give in the question generally. But this one you need to work it out. What is that? Theoretical ex-right fair value per share. This theoretical ex-right fair value per share is nothing but the average book value of the share after the right issue. How to find out this theoretical ex-right fair value per share? The formula is this. That is, fair value of the share immediately before the right issue plus what is the amount received by the company from issue of the rights. Two things you need to consider. In the numerator, you need to consider what is the fair value of the shares immediately before the right issue plus what is the amount we collected by right issue divided by number of shares after the right issue. Then you will get the theoretical ex-right fair value per share. So if you, and first you take the fair value of the share immediately before the right issue, then you take the theoretical ex-right fair value. The ratio is nothing but the bonus element. The ratio is nothing but bonus element. You see this. For example, I have calculated. Suppose in a company there are 10 shares. Okay. The fair value per share is 20. The fair value per share is 20. Now, for each one share, company is giving 2 shares as right shares. So the amount received by the company is 20 shares into each share is given at a 15 rupees concessional price. And the number of shares after right issue is 10 plus 20, 30. So therefore, theoretical ex-right fair value per share is 16.67. Understand, sir? Before right issue, the fair value per share given, sir, 20. Fair value per share 20. So 20 into number of shares. Fair value per share immediately before the right issue. I am finding the theoretical ex-right fair value per share. Plus what is the amount collected by issue of rights? We have issued 20 shares, right shares. Each share is given at 15. Divided by existing shares 10 plus right shares 20. So therefore, the average price, theoretical ex-right fair value per share is 16.67. Now, what is the fair value per share, sir? 20 before right issue. What is the fair value after right issue? 16.67. So 20 divided by 16.67. This is the bonus element. Now understand. Suppose, sir, the number of shares before right issue, how much, sir? 10. 10 shares. Into what is the fair value before right issue? 20. Now, after right issue, it is 16.67. Therefore, 10 shares before right issue, each one 20 rupees. Now it is 16.67. Therefore, it has become 12. You see, 12 approximately. That means 10 has become 12. That means 2 rupees is the bonus shares. 2 shares is the bonus shares. Bonus element. 2 shares is the bonus element in these 12 shares. So we need to multiply this bonus factor with the number of shares before right issue. Before right issue, the number of shares is 10. Multiply with bonus factor. So because in the right issue, there is a bonus element. So how much is the bonus element? So the bonus element is nothing but the fair value per share immediately before the right issue divided by theoretical ex-right fair value per share. Okay. So then you will get this one. So in this case, 10 into 20 divided by 16.67, that is 2 shares will be the bonus shares. Now this bonus element is there from the beginning of the last year, and accordingly we need to restate the last year EPS. So see this, I think I will solve one question, sir. So this question very, very important. See this question. Illustration number 4, sir. Suppose last year 2011 net profit 11 lakhs. 2012 net profit 15 lakhs. Okay. Number of shares outstanding prior to right issue 5 lakhs. During there is a right issue. Before right issue, number of shares 5 lakhs. Right issue price 15, sir. Last day to exercise right 1st March 2012, sir. Right issue is 1 new share for each 5 outstanding. 1 lakh shares, right shares, sir. Fair value of 1 equity share immediately prior to exercising of rights on 31st March 2012 is 21. So immediately before right issue, the fair value per share is 21. Compute basic earning per share. So we need to compute the basic earnings per share. So how to compute basic earning per share? I require 2 things. One is net profit or loss attributable to equity shareholders. In the current year, it is 15. One thing. Second, I want to know the weighted average number of equity shares. So before right issue, how many shares are there? 5 lakhs. And then company issued 1 lakh shares as bonus shares. So when right shares. Whenever there is a right shares, there is a bonus element in the right shares. So we need to calculate the bonus element. So if I calculate the bonus element, how to calculate the bonus element? What is the fair value per share immediately before right issue? 21 divided by what is theoretical X rate fair value per share? What is the fair value of the share immediately before right issue? 5 lakh shares into 21 plus 1 lakh shares we are issuing as right issue at 15. So the amount received from right issue divided by number of shares before right issue 5 lakhs plus right shares 1 lakh. So 5 lakhs into 21, 1 lakh into 15. So 5 into 21, sir. 1 into 15, sir. So total 120 divided by 6. So it will be 20, sir. So 20 is the fair value, theoretical X rate fair value per share. So 21 divided by 20. 21 divided by 20. So it will be 1.05 is the bonus element. 1.05 is the bonus element. That means, literally speaking, before right issue 5 lakh shares are there. If I multiply this with 1.05 bonus element, 5 into 1.05, it will be 5.25 lakhs. That means 5 lakhs 25,000 shares. So therefore 25,000 shares is what's the bonus element in the right issue. Bonus element in the right issue. Actually right shares are 1 lakh. In that 25,000 shares are the bonus. So therefore shares issued for full consideration is 75,000. Because we are giving each share at concessional price. So to that concessional price, what will be the bonus element? Because the assumption is in case of bonus element, only it is impacting my number of shares. It is not impacting my profit. Therefore, my EPS has been decreased in the current year. Therefore, in order to make sure that users are might not get misled, we assume this bonus is there from the beginning of the last year. Therefore, this bonus element we ascertained, sir. So there is a formula to calculate this bonus element, that is fair value per share immediately before right issue divided by what is the theoretical X rate fair value per share. So 21 divided by 20, that is 1.05 is the bonus element. So now once I got the bonus element in the current year, what I have to do? So I need to find out the basic EPS, right? Basic EPS is equal to current year 15 lakhs is the net profit or loss attributable divided by before right issue how many shares? 5 lakh shares, but bonus is there from the beginning of the year. So 5 lakh 25,000 shares for 12 months I will consider, plus 75,000 shares in the right issue, and the right issue happened from 1st March. So I will consider them for 10 months, 1st March to 31st December, because here calendar year they are following. So therefore 5 lakhs 25, this one 75,000 into 10 by 2. 62,500 plus 5 lakh 25. So 5 lakh 87,500, sir. 15 lakhs divided by 5 lakhs 87,500. So 15 divided by 587,500. It will be 2.55. This is the basic EPS of the current year. So basic EPS of the current year is 2.55. Okay. And the last year EPS, sir, last year 11 lakhs, sir. So 11 lakhs divided by 5 lakhs. Last year basic EPS. This is the basic EPS for the year 2012. So if I calculate the basic EPS of the current year, basic EPS of the previous year, sorry, it will be 11 lakhs divided by 5 lakhs. 11 divided by 5. So it will be 2.22. See this 2.22 is the last year, previous year EPS. Now I need to find out one more thing, that is restated EPS. Restated EPS of previous year. Why we need to calculate restated EPS? Because in the current year there is a right issue. In the right issue there is a bonus element. That bonus is there from the beginning of the last year. Therefore, last year your net profit 11 lakhs divided by number of shares 5 lakhs, bonus 5 lakh 25,000. So total 5 lakh 25,000. So therefore 11 lakhs divided by 5 lakhs 25. So it will be 2.095. 2.095. I think approximately 2.1. So 2.1 is the restated EPS. Say this. So this is how you need to find out the bonus element, the calculation of EPS in case of right issue. So very, very important. So whenever there is a right issue in the current year, in the right issue, there is a bonus element. There is a bonus element, and that bonus element is ascertained by fair value per share immediately before right issue divided by theoretical X-rate fair value per share. And this bonus is there from the beginning of the last year. Accordingly, last year EPS will be restated. Okay. That's it. So we calculated the basic EPS. Now come to diluted EPS. Sir, when we are going to calculate the diluted EPS? See, in the company, if there are any potential equity shares, that too having dilution nature, then we need to calculate the diluted EPS. Potential equity shares means maybe convertible debentures, convertible bonds, maybe share options. These are potential equity shares. That means right now they are not equity shares, but they may get converted into equity shares in the future. So if at all there are any potential equity shares in the company, if these potential equity shares really converted into equity shares, and after considering the effect, so what will be the net profit, what will be the weighted average number of shares, and you calculate the EPS. If my EPS is decreasing after considering the effect of potential equity shares, then we say those are diluted potential equity shares, and that is called diluted earning per share. Basically, diluted means reduction, reduce. So see this diluted EPS. What is the formula? The formula is net profit or loss attributable to equity shareholders after giving the effect of potentially dilutive equity shares. See this potentially dilutive equity shares. That means those potential equity shares have the capability to reduce my basic EPS. Sir, instead of EPS decreasing, it is increasing, sir. That means they are anti-dilutive. Ignore, don't calculate, don't consider them for diluted EPS. So net profit or loss attributable to equity shareholders after giving effect of potentially dilutive equity shares divided by weighted average number of shares after giving the effect of potentially dilutive equity shares. So the most important thing you need to remember is after giving the effect of potentially dilutive equity shares, after giving the effect of potentially dilutive equity shares. Sir, suppose for example convertible debentures. If convertible debentures are converted into equity shares, convertible debentures are potential equity shares. Now, if these convertible debentures are really get converted into equity shares, what happens? Tell me. Interest cost will be saved. So to the extent my net profit will increase, add. And to that extent, I need to pay tax to the government. Whatever the increase on that, I apply tax rate, then there will be tax expenses. That will also be adjusted. Then divide by weighted average number of shares. Number of shares will increase if I convert convertible debentures into shares. That will also be adjusted in the denominator part. Then you calculate the EPS. So if there are any potential equity shares, if they really get converted into equity shares, what will be the impact on my numerator? What will be the impact on my denominator? And after that, if I calculate the EPS, and if it is less than the basic EPS, generally that is called diluted EPS. And there are treatment of special cases. One point is there, very important, sir. Suppose share application money pending allotment, sir. Sir, company issued the shares, public subscribed, application money received, sir, but allotment is still pending, sir. Will you consider them in calculation of diluted EPS? See, generally, sir, share application money pending allotment not yet done. Therefore, legitimately, they are not considered as shares. So they will not be considered when you are calculating the basic EPS, weighted average number of equity shares. But will you consider the shares in respect of which application money received pending allotment as a potential equity shares? Because next they may get allotted. See, the standard says when this money, application money, they have not separated, but they already started using for the business, then you have to include them in the potential equity shares and you have to consider them while calculating the diluted earning per share. See this, if the money is not kept separately and used in the business. If application money is already used in the business, that means allotment is just a formality. That means in future company is definitely going to allot it. So when the company allots, the number of shares will increase. That means these are potential equity shares. Right now allotment not yet done. Therefore, they will not be considered. See, when you are calculating the basic EPS, you require weighted average number of shares. There you will not consider them because no allotment has been done. But when you calculate the diluted EPS, so whenever there is a potential equity shares, you need to calculate diluted EPS. Now, for calculating diluted EPS, you require weighted average number of shares. Now, in that you may consider them provided that money is already used in the business. Then allotment is just a formality. Next, partly paid up shares. Sir, already we discussed it, sir. If at all there is a partly paid up shares and to the extent they are eligible to participate in the dividends, we will include. Suppose, sir, on partly paid up shares you are not eligible to dividend, then don't include them in the weighted average number of equity shares for basic EPS calculation. But when you are considering for diluted EPS calculation in the weighted average number of equity shares, you include it. Why? Because when the shares are fully paid, they may be eligible for payment of dividend. That means they will get eligibility in the earnings per share. Therefore, they will be considered in the diluted EPS and they will not be considered in basic EPS calculation, weighted average number of shares, because they are not entitled to dividends. So that's it, sir. So, and because and one more important point, sir, because of the potential equity shares, if their conversion decreases the EPS, then only they are dilutive. Then you can include them in the calculation of diluted EPS. Suppose instead of decrease in EPS, if the EPS is increasing, na sir, then anti-dilutive, don't consider it. Suppose if there is a loss because of this conversion of potential equity shares into equity shares, if the EPS, if the loss per share is increasing, further the loss is increased, then they are dilutive. Consider them in the diluted EPS calculation. Suppose if the loss per share is decreasing after conversion into equity shares, anti-dilutive, don't consider them. Okay. So this is the predominant thing about accounting standard 20, sir. So I think basic EPS calculation, very, very important. So that's it. Now the next standard for our discussion is accounting standard 24, discontinuing operations. Sir, basically accounting standard 24 is a disclosure based accounting standard, sir. Like accounting standard 17, the disclosure requirements from the standard is predominant when you are preparing the financial statements of a company. So whenever any business wants to discontinue any of its existing operations, what disclosures we need to make in the financial statements, that is the central point of this standard, sir. Understand, sir, not everything which is discontinued by the company is a discontinuing operation as per AS24. In order to become a discontinuing operation, first of all, it must fit into the definition of discontinuing operations which is prescribed in this standard. I think that is the most important thing. So understand, sir, I will give you one real life example. Suppose ITC Limited. Now this ITC Limited is doing hotels business, tobacco business, FMCG, fast moving consumer goods, and also paper related business. Of course, these are the predominant businesses. Now imagine if ITC Limited wants to discontinue tobacco business from the existing businesses. Now if they decided to discontinue this tobacco business, definitely users of financial statements must know the information relating to this business. And discontinuing operations is not just one day affair. So it will take some number of years, sir. Especially when you take a big companies, if they want to discontinue something, first of all, there must be a proper plan and there must be how they want to discontinue this business. So it will take number of years, right? So during this discontinuing period, what kind of disclosures we need to make? Generally from this tobacco business, what will be the revenue, what will be the expenses, what will be the profit, what will be the assets, what will be the liabilities, we need to disclose relating to this discontinuing business. And hotels, FMCG, papers, these are continuing businesses. So relating to the continuing businesses, we need to disclose the information. Relating to the discontinuing business, we need to disclose the information. Now if you disclose the information separately for continuing and discontinuing operations, what happens is it will enhance the users understandability of the financial statements, and also users can make the better projection of the company's earning capacity and also the cash flows generating capacity and also the financial position, they will understand better. So I can say that AS24 ultimately increasing the understandability of the users of financial statements by making mandatory for every company when they are discontinuing something, any operations they want to discontinue, they need to make some disclosures as per this standard. Okay, so what is the object of AS24? The object of AS24 is to prescribe the principles for reporting the information about discontinuing operation. So this standard basically will provide you the principles for reporting information about discontinuing operations. Now what happens if you disclose information separately relating to discontinuing operations? It will enhance the ability of users of financial statements to make projections of enterprise cash flows, earnings generating capacity, financial position. Now suppose if I am the shareholder of ITC Limited, if ITC Limited wants to discontinue this tobacco business, then in future what will be the position of ITC Limited? What will be the earnings generating capacity of ITC Limited? What will be the cash flows generating capacity of ITC Limited? What will be the future financial position? See, all these things I will know when I know separately how much this business is contributing, how much tobacco business is contributing when compared with other businesses. So that will be the main thing, main objective of accounting standard 24, sir. So this is the object. So what is the object of AS24? The object of AS24 is to enhance the ability of users of financial statements to make better projections about the enterprise cash flows, earnings generating capacity and financial position by segregating information about discontinuing operations from information about the continuing operation. Okay. Then the scope of the standard, sir. Sir, this standard is applicable for all discontinuing operations of the enterprise. So whenever a company discontinuing any of its operations, so this standard will be applicable. And understand here, not everything which is discontinued by the business will be considered as discontinuing operations. In order to become the discontinuing operation, first of all, it must fit into the definition of discontinuing operations. That is very, very important here. So this standard is applicable to all discontinuing operations of the enterprise. Okay. Now the main thing in this standard is the definition of discontinuing operation. So the standard has given a definition. There are 3 points in this definition, sir. If all the 3 points are satisfied, okay, that is called discontinuing operation. All 3 must be satisfied. And first we will see, I will give the plain reading of the definition, then we'll try to understand the each point separately. First of all, what is discontinuing operation? This standard says discontinuing operation is a component of an enterprise that the enterprise pursuant to a single plan is disposing substantially in its entirety, such as selling the component in a single transaction or by demerger or split off of the ownership of the component to the enterprise shareholders, or disposing of piecemeal, such as selling the component's asset and settling its liabilities individually, or terminating through abandonment. And that component represents a separate major line of business or geographical area of operations, and that can be distinguished operationally and for financial reporting purposes. So see the definition, very, very important. So what is discontinuing operation? It's a component of an enterprise. That means it is part of an enterprise. And what enterprise will do with that component? That the enterprise pursuant to a single plan, in accordance with a single plan, what they want to do? Disposing of substantially in its entirety. That entire component they want to dispose. How? What are the ways? By selling the component in a single transaction. So the entire business they want to sell. For example, ITC Limited, tobacco business, they want to sell. Disposing substantially in its entirety, such as selling the component in a single transaction. Or by demerger. So demerger means what? Splitting any of the existing business from the company. For example, in ITC Limited, tobacco business is one of the existing business. Now they want to form this. They want to separate this tobacco business. So they want to form this as a separate company. So maybe that is called demerger. Or spin-off of ownership of the component to the enterprise shareholders. This spin-off is also a kind of demerger, sir. But the thing is that, suppose in our example, say this tobacco business. Suppose ITC Limited decided that they want to form a separate company, Tobacco ITC Limited. And after forming tobacco business as a separate company, now they have given the ownership, some shares of this company to the ITC Limited shareholders. Because originally the shareholders of ITC Limited, now they will get the shares in the newly formed company, I mean Tobacco ITC Limited. This is called spin-off of the ownership of the enterprise, the spin-off of the ownership of the component to the enterprise shareholders. Spin-off of the ownership of the component to the enterprise shareholders. Enterprise means original company, ITC Limited. Now, actually, the shareholders of ITC Limited will get the shares of newly formed company, ITC, Tobacco ITC Limited. So, this is also accepted. So, therefore, the first condition to become discontinuing operation is an organization in accordance with a plan. So, they want to dispose the entire component. And here, how disposal can be done? By selling the component in a single transaction, or by demerger, just separate this existing business from the existing business, or spin-off of ownership of the component to the enterprise shareholder. Just this business which you want to discontinue, so transfer the ownership to the existing enterprise shareholders. So anything happens can be called as disposing substantial in its entirety, or disposing of piecemeal. This is the second method of disposal which is allowed to become a discontinuing operation. Either you dispose the component entirely or you dispose it piecemeal. What is piecemeal? For example, this tobacco business, whatever the assets and liabilities are there in this tobacco business, individually the company decided to sell each and every asset individually and settle liabilities one by one individually. This is called piecemeal. So disposing of piecemeal, such as selling the component assets and settling liabilities individually one after another, that is also allowed. And the last one is terminating through abandonment. So just we have put an end by not using it, just we abandoned it, we are not using that. For example, there is a factory, so that factory we have abandoned, we are not using it. Of course, we are not planning to sell it, but we just not using it anymore. So terminating through abandonment. So understand, if you read this definition properly, you can understand here that to become a discontinuing operation, there are three modes of disposal allowed. Either you dispose the component totally, okay, or you dispose piecemeal, or just you abandon that business. If any one of these three things happen, first condition is satisfied. And if you want to dispose the component entirely, here three ways they told. One is sell the component. ITC Limited may sell the entire tobacco business, or demerge it, separate it from the existing company, or spin off of the ownership to the enterprise shareholders, shift the ownership of this component to the enterprise shareholders. So then we call it as disposing substantial in its entirety. Second one, disposing of piecemeal. See, even piecemeal disposal is also allowed. So such as selling the component assets and settling liabilities individually one after another, or just abandon it, terminating through abandon it. So any one of these three happen, first condition is satisfied. So therefore, what are the methods of discontinuance allowed as per AS 24(3)? Selling substantial in total, piecemeal disposal, abandonment of operation. So any one of these three things happen, then we say first condition is satisfied. That component may become a discontinuing operation, provided other two conditions are also satisfied. Right? Now, see the second condition, sir. That means that component represents a separate major line of business or geographical area of operation. Sir, that component, if it want to become a discontinuing operation, that component must represent a separate major line of business or geographical area of operation. So the key word here is separate major line, because we don't want waste our time focusing more on the immaterial business, not major business. Therefore, when discontinuing operation will be called, the thing is that business must be major. You want to discontinue from the existing business, So that represents a major line of business or geographical area of operation. Like for example, ITC Limited wants to discontinue tobacco business. Now out of the total revenue of ITC Limited, tobacco business is contributing nearly 30 to 40% of the revenue. Imagine example. So that means it is definitely major line of business. So therefore second condition is satisfied. So it must be major line of business or geographical area of operations. And if you remember, sir, we have discussed accounting standard 17. As per AS 17, there are two types of segments: business, geographical segment. So as per AS 17, the segment can be business or geographical segment. Now, this component you want to discontinue, either it can be a business segment or it can be a geographical segment, but it must be major. It must represent a major line of business or geographical area of operation. And how can you decide whether it is major or not? Depending upon the revenue it contributes to the organization. Mostly based on that, we will say whether it is major business or not, or is it representing major geographical area of operations or not. For example, ITC Limited wants to dispose entire tobacco business in India. That means it is representing major line of geographical area of operations. Now here, I would like to tell you one important point, sir. Sir, in AS 17, we have discussed the concept called reportable segment. A business segment or a geographical segment can be called as reportable segment. If you remember, there is a criteria: segment asset criteria, segment revenue criteria, segment result criteria, external revenue criteria. If any one of the criteria is satisfied, then we say it's a reportable segment. Now, if it is a reportable segment as per A17, then we can say it is representing separate major line of business or geographical area of operations straight away. If it is reportable as per A17, then it representing separate major line of business. But sometimes, sir, even though it is not reportable as per A17, still we can say it is representing major line of business or geographical area of operations. So if you want to test whether the discontinuance of any operation is discontinuance of operations as per AS 24, the second condition is that operation you want to discontinue, whether it is representing major line of business or geographical area of operations or not. Now, if it is so, then second condition is satisfied. And the last condition, that component can be distinguished operationally and for financial reporting purposes. Sir, what is distinguished operationally and for financial reporting purposes? Very simple, sir. You must be able to identify what will be the operating assets, what will be the operating liabilities, what will be the operating revenue from that particular segment, but from that particular component. For example, ITC Limited wants to discontinue tobacco business. Now from this tobacco business, what will be the operating assets, what will be the operating liabilities, what will be the revenue directly attributable to tobacco business, what will be the total operating expenses of tobacco business. The company must be in a position to tell them separately. Then we say it is distinguished operationally and for financial reporting purposes. That means we should able to maintain separate records for that particular component. Then obviously this condition will be satisfied, because you must be able to distinguish it operationally as far as financial reporting purposes. Financial reporting purposes means you need to report revenues, expenses, assets, liabilities. So you must be in a position to tell what will be the operating assets, liabilities, revenue of this business you want to discontinue. Then condition number 3 is satisfied. Suppose if I am unable to tell how much will be the revenue, how much will be the expenses, how much will be the assets and liabilities of the particular business I am discontinuing, then what's the point? You tell me, sir. Because the ultimate object of this standard is what? To disclose information relating to discontinuing operation. So when I am unable to disclose anything, if I am unable to identify any information relating to discontinuing operations, there is no point now, because the ultimate object of the standard itself is to disclose information relating to discontinuing operations. So that's why this condition says it can be distinguished operationally and for financial reporting purposes. When we say a component is distinguished operationally and financial purposes, if all the following conditions are satisfied. That is, the operating assets and liabilities of the component can be directly attributed to it. Operating assets, liabilities, I must be able to identify it. Revenue can be directly attributed, and majority of the operating expenses are directly attributed. That means I am in a position to identify the operating assets, operating liabilities, revenue, and then operating expense. Okay, so this is discontinuing operation. So tell me, to become a discontinuing operation, how many conditions? 3 conditions. All 3 must be satisfied. First condition, there must be disposal. How many methods of disposal? 3. Substantial in its entirety, disposing of piecemeal, terminating through abandonment. Disposing substantial in its entirety, selling the component, demerger or spin-off of the component ownership to the enterprise shareholders. Piecemeal means selling the assets, settling the liabilities individually. Terminating through abandonment, we are not planning to sell, just we have left it, we are not using it. So, and that component must represent a major line of business or geographical area of operations, and the last one that can be distinguished operationally and for financial reporting purposes. And next is here, in study material you see some examples are there, very important. They may ask these examples as an MCQ or maybe as a question. Suppose there is a company XY, sir. They are having a restaurant chain. Now they want to decided to sell one of their restaurants, which contributes only 5% of the total revenue. So, and the company no plans to sell any other restaurant. Can you tell me, is it a discontinuing operations? So they have chain of restaurants. Out of this chain of restaurants, they want to sell one restaurant which is contributing only 5% of the total revenue. Is it a discontinuing operation? Now tell me, to become a discontinuing operation, what is condition number 2, sir? It must represent a major line of business. Now, when I'm selling a restaurant which is contributing only 5% of the total revenue, that is not representing any major line of business. So therefore, it is not a discontinuing operation. Second one, suppose there is a company MN, sir. They are operating multiple industries like ITC, hotel business, airlines business, software business. Now they decided to sell the airlines business. Okay. And how they want to sell it? See, it started selling aircraft and repaying related liabilities. That means they want to dispose piecemeal. Piecemeal method is also accepted. And it sells 5 out of 50 aircraft. Okay. Now the airline business is contributing 25% of the total revenue. That means it is major line of business. Therefore, it can be called as discontinuing operation provided other two conditions are satisfied, like piecemeal distribution. That means condition number 1 is satisfied. Second condition, it is representing major line of business. And third condition, it can be distinguished operational and financial reporting purposes. Obviously, when you're able to identify the revenue separately, it is third condition is also satisfied. So in this case, we can say there is a discontinuing of operations. And come to example number 3, sir. So there is a company RT, sir, which is operating in a single state, 3 products X, Y, Z. Now the financial details given, sir. Total sales 35 lakhs for this company, sir. Product Y sales you see 14 lakhs. That means 40% of the total. That means it is representing major line of business. So therefore it can be a discontinuing operation. Now they want to sell product Y business to another entity. Since product Y is a major product, the sale may be considered as discontinuing operation. So hope these examples will ensure that this discontinuing operation definition, you understand it properly. So to become a discontinuing operation, 3 conditions. Now, sir, para 9, very important, sir. This one, listen to me carefully. Sir, what is this para 9? See, I have the habit of, referring the original standard. If you read the original standard, sir, they call every point as a para. So if you read AS24, in that there is one point, para 9. Okay, in that para 9 they have given these examples. So I have referred here, para 9. So para 9 means para 9 of the original standard, please understand. Now what this para 9 is giving is, they are giving some examples. Sir, examples of what? Examples of activities that do not necessarily satisfy criteria A of discontinuing operations. That do not necessarily satisfy criteria A of discontinuing operation. What is criteria A of discontinuing operation? Disposals. Disposing substantial in its entirety, disposing of piecemeal, or terminating through abandonment. Okay. So that is missing here. That do not necessarily satisfy criteria A of discontinuing operation. That means criteria A is missing, means these are examples of what? These are examples of not a discontinuing operation. Because to become a discontinuing operation, all 3 conditions must be satisfied. But in these activities, these are examples of activities that do not necessarily satisfy criteria A, but that might do so in combination with other circumstances. Basically, predominantly, prima facie, they are not satisfying criteria A, but if they are combined with other circumstances, they may satisfy criteria A and they may become discontinuing operations. So therefore, what are those examples? See this: gradual or evaluationary phasing out of a product line or class of services. So any company, gradually they want to phase out any product line or class of services. That is not a discontinuing. This is an example of activity that do not necessarily satisfy criteria A of paragraph, discontinuing operations. That means there is no disposal here. When you gradually phase out any product or product line or class of services, where is the disposal, sir? Are you disposing anything substantial in its entirety, or are you disposing it piecemeal, or are you terminating through abandonment? No. For example, Tata Motors has gradually phased out to nano car, right? So because of lack of demand. So can you call it as a discontinuing operation? So is there any disposal substantial in its entirety, or is it disposal by piecemeal, or is it terminating through abandonment? Prima facie, in case of gradual or evaluationary phasing out of a product line or class of service, that cannot be called as discontinuing operation because there is no disposal there. Similarly, suppose we are manufacturer of TVs. Now we have decided to gradually reduce the production of black and white TVs because of lack of demand. Now can I say the gradual phasing out, gradual reduction in the production of black and white TVs cannot be called as discontinuing operation because there is no disposal there. So as per the criteria A of discontinuing operations. Similarly, second example, discontinuing even if relatively abruptly several products in an ongoing line of business. Suppose a company abruptly, that means suddenly, they want to discontinue some of their products. There are some ongoing line of businesses. They decided that they don't want to produce them, or they stopped it. That is also not a discontinuing operation because there is no disposal there. For example, you know Hindustan Unilever Limited, they have a water purifier brand called Purit. So they stopped it. So suddenly, abruptly, they took a decision that they don't want to continue. Maybe whatever be the reasons. So even from the ongoing line of business, if any product is relatively abruptly stopped by the company, discontinued by the company, that basically cannot be called as discontinuing operation because criteria A is missing. There is no disposal. Of course, see, these are all examples that do not necessarily satisfy, but maybe if you combine them with other circumstances, they may satisfy. But prima facie, there is no criteria A here. That means they are not generally called as discontinuing operations. Next, third point is shifting of some production or marketing activities for a particular line of business from one location to another. Sir, any company has shifted its production or marketing activities for a particular line of business from one location to another. I think Maruti Suzuki has shifted its small cars manufacturing from Haryana to Gujarat. So I think way back they shifted some of their production facilities from Haryana to Gujarat, sir. So can we call that as a discontinuing operation? No, because there is no disposal there. So therefore that is one activity. And then closing of a facility to achieve productivity improvements or other cost savings. So in order to achieve cost savings or productivity improvements, company closes any of its facilities. I think BSNL, MTNL, I think they have closed so many of their offices. Okay, closed the facilities. Why? Because productivity improvements, cost savings. There is so much competition from the private players like Jio, Airtel. So therefore BSNL and MTML has to face that competition, and obviously to save some cost, they have shut down some of their facilities, closing of a facility. Now that cannot be called as discontinuing operation. Generally prima facie criteria is missing. That means there is no disposal there. And see, these are the four examples you need to remember. Four examples of activities that do not necessarily satisfy criteria A. One is gradual decrease of any product or class of services. Next, discontinuing even if relatively abruptly several products in an ongoing line of business. And then shifting of some production or marketing activities of a particular line of business from one location to another location, and closing a facility to achieve productivity improvement or other cost savings. And the last one, sir, this is applicable in case of consolidated financial statements. So as a parent company, when you prepare consolidated financial statement, you are selling a subsidiary whose activities are similar to that of the parent or other subsidiary. So that is also example of activity that do not necessarily satisfy criteria A of paragraph of discontinuing operations. So see this, an example in relation to consolidated financial statement is selling a subsidiary whose activities are similar to those of the parent or other subsidiary. So it is just a case of disposing the investment in a subsidiary. For example, sir, see here, H Limited is a parent company. It has two subsidiaries, A Limited, B Limited. There are two subsidiaries. Now, parent company is involved in cement manufacturing. A Limited is doing textiles business. B Limited is also doing textile business. Now, suppose parent company H Limited wants to dispose B Limited. Is it a discontinuing operation? When you are preparing consolidated financial statements, the answer is no. It is just treated as disposing investment in subsidiary. Because if you see the group point of view, still even though B Limited is sold, another subsidiary A Limited is still carrying the same activity, textile business. So therefore, within the group, that activity is already there. So it cannot be called as discontinuing operation. Or for example, B Limited is doing textiles, cement business. B Limited is doing cement business. So selling a subsidiary whose activities are similar to that of the parent, similar to those of the parent or other subsidiary. So this is an example in relation to consolidated financial statements as far as para 9 is concerned. So these are the examples of activities that do not necessarily satisfy criteria A. Now, initial disclosure event. Sir, what is this initial disclosure event? Sir, I told you we need to disclose information relating to discontinuing operations. Sir, from which year onwards you will start disclosing the information? That means from which year financial statements you start disclosing the information relating to discontinuing operations? The year in which this initial disclosure event happened. Now, when the initial disclosure event happened, immediately after that, if you are preparing the financial statements, from that financial statements, you need to disclose information relating to discontinuing operations. So basically, initial disclosure event is the event on happening of which after that, immediately preceding on happening of which, so whatever the financial statements you are preparing, you need to start disclosing the information relating to discontinuing operations. But the standard says initial disclosure event is earlier of the following. One is the date on which you entered an agreement to dispose the assets of the discontinuing operation, if it is there, or the date on which board of directors approved and announced the discontinuance plan, whichever comes earlier. See, this initial disclosure event, very, very important, sir. So they may ask a question on this. What is initial disclosure event? From which year onwards you start disclosing the information relating to discontinuing operation. So information about planned discontinuance must be disclosed in the first set of financial statements immediately after the initial disclosure. Immediately after the initial disclosure event. Actually, you need to add here event. What is initial disclosure event? Initial disclosure event is the event out of these two, whichever occurs earlier. What is that? Entering into an agreement to sell substantially all the assets of the discontinuing operation. So the date of agreement and the date of approval and announcement of the discontinuance plan by the board of directors. So whichever comes earlier. For example, date of agreement 1st January 2025. Approval and announcement. Board of directors approved the plan of discontinuance on 1st February 25, but they announced it on 1st March 25. So see here, both things must happen. Approval, announcing, both must happen, not just approval. So if you see the second one, approval and announcement later, 1st March you need to consider. So therefore 1st March 2025 and the date of agreement January 1st 2025, whichever occurs earlier, that is January 1st 2025. That means 24-25 financial year. So from this year financial statements, you need to start disclosing information about discontinuing operations. Okay, so you understand what is initial disclosure event. So date of agreement and the date on which financial statement, discontinuance plan is approved, announced by the board of directors. Approval and announcement, both things must happen. Sir, generally in discontinuance plans, what items will be there in the plan? Simple. What are the major assets to be disposed? How much time it will take to dispose? And how these assets will be sold? What will be the estimated time required for completion of the sale? And because of this discontinuance, what are the principal locations will be affected? And stating the location, function, number of employees to receive termination compensation because of the discontinuance of operations. If any of the employees will be removed from the organization, how much compensation they will get, and what will be the estimated proceedings or salvage we are expecting from disposal. So all these points we need to include it. Now the most important thing is disclosures. Sir, as I told you, in respect of discontinuing operations, we need to make a separate information. We need to be disclosed in the notes to accounts from the year in which the initial disclosure event happened, right? From the financial statements of the year immediately after happening of initial disclosure event. So relating to discontinuing operations, what information we need to disclose? See here, 8 points they told. So maybe they may ask a theory question that explain the disclosure requirements as per AS 24 in respect of discontinuing operation. So I will tell you the simple trick to remember. First thing is give details of discontinuing operations. So suppose ITC company is discontinuing tobacco business. Give details of this tobacco business you want to discontinue. Now second, is it a business or geographical segment as per AS 17? Please note it as per AS 17. Is it business segment you want to discontinue or is it a geographical segment you want to discontinue? Second thing is, what is the date and nature of initial disclosure event? When initial disclosure event happened, what is the date and what is the nature? Nature means either agreement, I told you now, initial disclosure event is the date of agreement and the date approval and announcement of the discontinuance plan, whichever occurs here. So that will be the date, nature you need to mention. And the date or period for completion. Sir, how much time it will take to complete the entire discontinuance plan? Okay. Now the first 4 points are general points, sir. First point, give the details of discontinuing operation. Second one, is it a business or geographical segment as per A17? Third one, what is the date and nature of the initial disclosure event? And what will be the date or period for completion? Now, next point, fifth point is relating to balance sheet. Sir, in generally balance sheet, what items will be there? Assets and liabilities. So you need to disclose the assets and liabilities of the discontinuing operation. What are the total assets to be disposed and total liabilities to be stated as of the balance sheet date in respect of discontinuing operation? Next, once balance sheet items is over, next P&L account items. Generally in P&L account we have what? Incomes and expenses, right? So please mention what will be the amounts from ordinary activities of discontinuing operation. Here the ordinary activities from the discontinuing operations is nothing but incomes and expenses. So from the discontinuance business, discontinuing operation, what will be the incomes, what will be the expenses? You need to disclose it. Okay, incomes, expenses. And also from the discontinuing operations, what will be the profit or loss? That is before tax. Before tax, what will be the profit or loss and what will be the related income tax? So therefore these two items together, P&L account items relating to discontinuing operations. And the next one, cash flow statement, cash flows. So from the discontinuing operations, what will be the cash flows from operating activities, investing activities, financing activities? Just disclose it. So that's it. So therefore, relating to discontinuance operations, discontinuance business, you need to disclose what will be the assets to be disposed, what will be the liabilities to be settled. You need to disclose what will be the incomes, what will be the expenses during the year in respect of the discontinuing operations, and also what will be the profit before tax and what will be the income tax expense. That means we are clearly giving the separate information relating to discontinuing operation. And what will be the operating, investing, financing cash flows from discontinuing operations we need to disclose. So these are the 8 points. So what will be the disclosure requirements? First, details about discontinuing operations. Second, is it a business or geographical segment as per A17? Third, date and nature of the initial disclosure event. And the fourth, date and period for completion. And then total assets to be disposed and the total liabilities to be settled. Next, what will be the incomes and expenses from the discontinuing operations, and what will be the tax, profit or loss before tax, and what will be the income tax expenses, what will be the cash flows from operating, investing, financing activities relating to discontinuing operations. So these are all the disclosures we need to make in the financial statements relating to discontinuing operations. Basically, we are providing a separate disclosures for discontinuance operations. Now, after that, what will be the additional disclosures? See, if there are any gain or loss from disposal of the assets, settlement of liabilities, and related income tax, if you pay any income tax, all these details you need to disclose later on. And also sale price for the net assets under binding sale agreement and expected timing, and also carrying value of the assets to be disclosed. And sir, what will be the disclosures in interim financial reports? Suppose last year discontinuance happened, and last year financial statements, annual financial statements, you disclose the information. Next year again we will prepare annual financial statements. In between, suppose any interim financial reporting is done as per AS25, then what we need to disclose is what will be the significant activities and events relating to discontinuing operations since the last annual report we need to disclose. So very important, sir. Already when you are preparing the annual financial statements of the last year, you have given the disclosure as per AS24 relating to discontinuing operations. Now suppose for example, if you are a listed company, every quarter you need to prepare the interim financial reporting as per AS25. Then what are the, if there is any significant activities and events happen relating to this discontinuing operation since the last annual report, disclose it. And also what will be the major changes in the amount or timing of cash flows relating to assets being disposed or liabilities being settled should also be disclosed. Any major changes in the amount or timing of cash flows relating to assets. So the assets which we want to sell relating to discontinuing operations, if there is any significant changes in the amount or timing of cash flows, that also try to disclose in the interim financial report. So that's it, sir. This is accounting standard 24. So sir, if at all there is a question, there is a they can ask a question from para 9, sir. Examples of activities that do not necessarily satisfy criteria A. So try to remember these 4 examples. These cases basically criteria A is missing, so they are not discontinuing operations, and try to remember the discontinuing operation definition. Okay, so this standard will not take much time, sir. Around 30 to 35 minutes you can complete this. And this video, if you're watching for the first time, I think I will make sure that definitely you will understand this standard. And please don't skip it. If at all there is a question from the standard, the easy question will come, and you can use this 35 minutes to get the marks from accounting standard 24. And in the study material, if you see, I think there are only 2 questions are there, 1 or 2 questions are there. So immediately after, listen to this 35-40 minutes, go and solve the sums, so that the entire standard will be over. The next accounting standard we are going to revise is accounting standard 22, sir. Sir, basically accounting standard 22 deals with accounting for taxes on income. Taxes on income is nothing but income tax, sir. So this standard provides the accounting treatment for income taxes. Sir, how to approach accounting standard 22? The first thing you need to understand in accounting standard 22 is the definition of tax expenses, sir. So when you look at the definitions given in accounting standard 22, sir, one of the main definition is tax expenses. See, the standard says tax expenses means current tax plus deferred tax. So this standard has divided the tax expenses into 2 categories. One is current tax, another one is deferred tax. And this current tax and deferred tax, both concepts, accounting treatment is given by accounting standard 22. Of course, the major focus is on the deferred tax concept. Okay. Now, already, sir, this current tax and deferred tax we came across, we got the reference in financial statements of company chapter itself, sir. As per schedule 3, when you prepare the P&L account of the company, incomes minus expenses, you will get profit before tax. Next, we need to adjust the tax expenses by categorize them into current tax and deferred tax. There we got the reference. And also, sir, when you are preparing the balance sheet as per schedule 3, liability side, non-current liabilities, we have deferred tax liabilities. Asset side, non-current assets, we have deferred tax assets. So the concept of deferred tax and current tax, the reference we got in the financial statements, sir, now we need to understand in detail as per AS 22. Okay. Before understanding the concept of current and deferred tax, sir, we need to understand the meaning of some important key terms, sir. Very, very important, sir. See, the first thing is there is accounting income. There is accounting income. There is taxable income. So you need to understand this properly. Accounting income, taxable income. What is accounting income, sir? Net profit or loss before tax from P&L account. Net profit or loss before tax. This is from P&L account. See, we will prepare P&L account and we will get net profit or loss before tax. So that will be considered as accounting income. And generally, you know, when you are preparing the P&L account, you follow the accounting principles, generally accepted accounting principles as well as accounting standard provisions. We will prepare the P&L account. So from this P&L account, whatever the net profit or loss before tax we got, that is considered as accounting income. And there is taxable income. Taxable income. You know, in order to understand this standard better, sir, you should have the basic knowledge of the provisions of the Income Tax Act. So first go and check the provisions of income tax, at least PCBP provisions. If you don't have the basic idea about the provisions of income tax, I don't think so you will understand this standard effectively. So those who are watching this standard, if you don't know the basic provisions of income tax, so please go and check the provisions of income tax, at least PCBP provisions. Okay. What is taxable income? You know, in India, we have Income Tax Act. Now, every year, how much tax I need to pay to the government, for that I need to determine the taxable income by following the provisions of income tax. So taxable income is nothing but the income computed by following the provisions of income tax. Based on that, I need to pay the tax to the government. So income tax, taxable income is nothing but income computed as per tax laws on which tax is payable. So accounting income, taxable income. Accounting income, net profit or loss from the P&L account. Taxable income means income computed as per tax laws. Now, what is tax expenses? Just now we have seen current tax plus deferred tax. Now, next, current tax. Sir, what is current tax? Current tax is nothing but tax payable based on taxable income. We calculated taxable income, sir. On the taxable income, if you apply the tax rate, you will get the current tax. So current tax is nothing but tax payable on taxable income for the period. You know, by following the provisions of income tax, we will calculate taxable income. And on the taxable income, we will apply the tax rate. Then you will get the tax payable for the current year. So that is called current tax. Now the next is deferred tax. So the standard says here, deferred tax means tax effect of timing differences. So what is this concept of deferred tax? I will explain. Wait. So but what is current tax? You understood? Very simple. Tax payable in the current year based on taxable income is called current tax. So we understood what is current tax. Now let us try to understand the concept of deferred tax. Okay. Sir, in order to understand the concept of deferred tax, two things you should know first. Accounting income, taxable income, which just now I have clarified. Accounting income means net profit or loss before tax from P&L account. Taxable income means what, sir? Income which is determined by following the provisions of tax laws. And based on the taxable income, we will compute the tax liability. Okay. Now, I am going to take one example, sir. With this example, I will explain you the concept of deferred tax. Carefully observe. Suppose there is a company X Limited, sir. I am preparing the P&L account of X Limited for the year ending 31st March 2024. Okay. Revenue 100 I have taken minus expenses. In expenses, I have taken interest on loan 20, other expenses 20. So therefore profit before tax 60, which is nothing but accounting income. Accounting income is nothing but net profit or loss from P&L account, which is 60. Okay. Now once we got the PBT, we will show tax expenses. And we know tax expenses as per schedule 3, current tax, deferred tax. Now understand. I need current tax. How to compute current tax? I need to follow the income tax provisions and I need to calculate the current tax. Okay. So in the income tax, you might already have an idea how to calculate the taxable income. Okay. Now see, first I will take the PBT from P&L account 60. And see, when I am arriving the 60 in the P&L account, sir, I deducted interest on loan. Suppose this interest on loan is not allowed as per the Income Tax Act because it is section 43B. Section 43B says interest is allowed only when it is actually paid as per the Income Tax Act. But this interest we have recognized in the P&L account on accrual basis, not yet paid. Therefore, it was disallowed in the income tax. Sir, when you are computing the taxable income, you need to follow the income tax provisions, right? So therefore, this 20 was not allowed this year. Why? Because it is not yet paid, which is income taxes. We don't allow interest on loan if you have not paid. We will allow in the year of payment. Therefore, your taxable income is 80. Now understand, very, very important. Sir, my taxable income is 80. My accounting income is 60. Sir, why there is a difference, sir? Because of the provisions of Income Tax Act. Income Tax Act says this interest on loan we won't allow this year. Why you don't allow? Because we will allow it on payment basis. Oh, of course. That means in the income tax also this 20 allowed. But as of now it is not allowed. Yes. In the books, obviously it is allowed on accrual basis. No restriction. That means this 20, which is the difference between accounting income and taxable income, which is not allowed in the Income Tax Act, but it is going to allow in the future years when I actually paid it. Now see, on this taxable income, I calculated the tax liability, 30% tax rate, suppose 24K. Correct? So what is your current tax? Current tax means tax payable to the government in the current year, 24. So I have considered current tax 24. Current tax 24 I have considered, sir. Now the problem is, see, my accounting income is 60, but my tax expense is 24. Sir, what is this tax expenses? Current tax. What is the entry I will write? P&L to current tax. I will debit to P&L account because it is my expenses, current tax expenses. See this, P&L to current tax. So that's why from profits I am reducing this. I will debit to P&L account. So current tax is 24. See, the problem is, sir, my accounting income is 60. If I apply 30% on this, it will be how much? 60 into 30%. It will be 18, sir. 18. But you are showing tax expenses 24. They are not matching. My accounting income and tax expenses are not matching. Sir, why accounting standard 22 came now? To match the accounting income with the tax expenses. Here they are not matching. Why they are not matching? The standard says understand why they are not matching. Why your accounting income is 60 but your tax expenses are 24? If I apply 30% on 60, it is coming only 18 na? But you are showing tax expenses 24. That means your accounting income is not matching with the taxes. Why they are not matching? Because of the difference between accounting income and taxable income. The standard says analyze this difference. Is this difference a permanent difference or temporary timing difference? Temporary timing difference means this difference arises only this year, which is capable of being reversal in the coming years. That means this 20 interest on loan, it is not allowed in the Income Tax Act this year, but it is allowed in the coming years when you actually pay. That means the difference between the accounting and tax is only timing difference. In the accounts we allowed in this year, but in the tax we don't allow this year. Maybe next year if I pay, it is allowed. That means if it is allowed in the next year, suppose if it is allowed in the next year, to the extent of 20 lakhs my taxable income will down. To the extent of that I will save some tax liability. Therefore on this 20, say this 20 into 30%, 6 I can save tax in future. Therefore it is my deferred tax liability. So what is deferred tax, sir? Deferred means postponement, sir. Your tax benefit postponed, sir. In this case, on 20, this interest on loan we are not allowing. That means 20 into 30%. You are paying tax on this 20. You are paying tax current year. That means your benefit has been postponed to the coming years. Therefore, this tax what you suffered today is going to be savings in future, because it's a timing difference. It's a matter of time only. We don't allow this year, but maybe we allow in the next year, right? So next year when we allow 20 as per the Income Tax Act, your taxable income will come down by 20. Therefore, your tax liability will be come down by 20 into 30%, 6. That means this 6, why can't you recognize in the current year as a deferred tax asset? So this is the concept of deferred tax. So deferred tax concept is very simple. It is the tax effect of timing differences between accounting income and taxable. Accounting income, taxable income. See, ultimately we will allow this 20 under both in the books, in the income tax, but only the difference is a time. So if it is because of the timing this difference arises now, why can't you anticipate and recognize in the current year and try to match your accounting income with the tax expenses? Because your tax benefit was postponed to the coming years. This 20 we are not allowing, we will allow in the coming years. So therefore there will be savings in tax. So therefore you recognize deferred tax asset. So therefore, suppose on this 20, 30% means 6. So I will recognize this 6 in the current year itself as a deferred tax asset. So what is the entry? Deferred tax asset to P&L account. I will credit to P&L account because it's an asset. Deferred tax asset to P&L account. Or else you can write like this: deferred tax asset to deferred taxes to P&L. Whatever. P&L account will be created by 6. And current tax P&L account is debited by 24. See, P&L account debited 24, credited 6. So net 18 debited to P&L account. Therefore, now you see 60 into 30%. It will be 18. My tax expense also 18. Now this standard has matched the accounting income with the tax expenses. That is the predominant object of this standard. So therefore, in the first year, what is the current tax 24? What is the deferred tax 6? Why deferred tax has been recognized? Because I know in my books it is allowed, but as per income tax it is not allowed. And I know in the income tax it is allowed in the coming years. Therefore, on this 20, there will be tax savings of 6. Therefore, the tax savings is my asset. That's why it is deferred tax asset. So deferred means postponed. Your tax benefit postponed, sir. Asset means savings in tax. Liability means you need to incur tax. Your tax liability postponed, deferred tax liability. Your tax benefit postponed, deferred tax asset. So in the current year, I suffered tax. So there will be savings in future. In the current year, I enjoyed the tax benefit. In future years, you need to pay the tax. So therefore, this deferred tax concept is very simple, sir. You pay now, save later. If you are paying now, you are going to save later. So it's a DTA. If you save now, you are going to pay later. DTL. Because the difference is anyway is only timing difference now. Anyway, as per the books, as per the income tax, it has to be allowed. Therefore, the difference is only the timing. This is temporary difference. Therefore, if you are suffering now, you are going to enjoy later. If you are enjoying now, you are going to pay later. So what is asset? Deferred tax asset. You are paying now, so there will be tax savings in future. Deferred tax asset. If you are save now, you are going to pay later. DTL. So therefore, very simple concept, sir. So therefore, understand, sir, what is deferred tax? tax effect of which difference? Timing difference. What is timing difference, sir? The difference between accounting income and taxable income that originate in one period and reverses in the future years. Reverses in the future years. Suppose the difference that originate and do not reverse, that is permanent difference. In respect of permanent difference, ignore. There is no concept of deferred tax. For example, any fine for late payment of tax. I don't think so it is allowed as per the Income Tax Act. But we will allow in the P&L account. So there is a difference between accounting income and taxable income. That is fine for late payment of tax. Since it is never allowed in the Income Tax Act, how it will become a timing difference? Timing difference means the difference must come. It is reverses in the coming years. Therefore, we are anticipating the liability or the asset. That we are calling it as deferred tax asset or liability. But if the difference is permanent, which is not going to reverse, so ignore. We cannot recognize any deferred tax. Okay. So in this case, sir, next year, suppose for example, sir, when we actually pay as per the income tax, this 20 is allowed, no, sir. Therefore, your taxable income is reduces by 20. When your taxable income reduces by 20, to that extent, there will be savings in tax. So 6. So in the first year itself, you recognize deferred tax asset. In the next year, if the timing difference reverses, na, sir, you also reverse the same entry, P&L to deferred tax asset, because this asset has been realized in the form of tax. So P&L to deferred tax asset. So therefore, in the year of origination, you create DTA or DTL. When it is reverses, to that extent, you reverse the liability or asset. Now in this case, there is a deferred tax asset, you reverse it. And I can tell you in another way, sir. Because most of the students, no, sir, they will try to, they don't understand even after explaining this much depth. So they may not understand the concept of deferred tax. But see, simple. Taxable income is greater than accounting income. When taxable income is greater than accounting income, that means you suffered more tax. Correct? Your taxable income is more than accounting income means you suffered more tax. So since you are suffering more tax, that means your benefit has been postponed to the coming years. So DTA. Your taxable income is less than accounting income. That means you suffered less tax. That means you enjoyed the tax benefit. There will be DTL. So simple. DTA when taxable income is greater than accounting income. DTA because taxable income more than accounting income means you paid more tax. Because the difference is timing. First of all, the difference should be timing difference. Understand? Only timing difference will give you deferred tax. And if the taxable income is less than accounting income, that means you enjoyed the tax benefit. There will be DTL. Okay, sir. So this is the concept of deferred tax, sir. And if you want, you can take another example also, sir. For example, I will tell you this, sir. Suppose, sir, the company purchased the asset, sir. 30,000 is the mission value, equipment. Now, as per accounts, sir, it is allowed in 3 years. Depreciation allowed in 3 years. So that means first year 10,000, second year 10, third year 10. Total 30. So first year, second year, third year. Now as per tax, total depreciation is allowed in the first year itself because it is purchased for scientific research purpose. Now you see, depreciation is one of the classic examples for timing difference, sir. Ultimately, we are going to allow the entire cost of the asset only, no, sir, as per books or as per income tax. That means if you purchase an asset for 30,000 for scientific research and you allow it over a period of 3 years in the books, that means every year 10, 10, 10, total 30,000. But as per the income tax, entire cost is allowed in the first year itself. Therefore, first year itself, there is a difference of 20,000. There is a depreciation of 30,000. But ultimately, you see, under both the books, under both the ways, total depreciation allowed is 30. So therefore, this is timing difference. Na? The difference between accounting and taxable income, first year 20, second year 10,000 reverses, third year 10,000 reverses. This is what I called as timing difference. Because see, first year you claimed 30,000 depreciation, sir. See, important, sir. First year you claimed 30,000 depreciation, sir. That means you claimed 20,000 excess depreciation, sir. Because of that, your taxable income is less than accounting income by 20,000, sir. When your taxable income is less than accounting income by 20,000, on this 20,000 you enjoyed the tax benefit, sir. But in future you need to pay tax on this. So therefore 20,000 into 30%. So 6,000 will be deferred tax liability you need to create, sir. Deferred tax liability you need to create. And next year, sir, you see, as per books it is 10,000, but as per income tax nothing is allowed. Therefore, out of this liability, out of this timing difference of 20,000, 10,000 reversed, sir. Therefore, 10,000 into 30%, 3,000 will be reversal of DTL. Reversal of DTL. Reversal of deferred tax liability. Once again, I am telling, sir, you are a company, you purchased a mission, 3,000. As per the books, every year 10,000 allowed. But as per the income tax, total 30,000 allowed in the first year itself. Now you see, ultimately whether it is tax or books, total allowed is 30 only. So that means it is a timing difference. The difference is only in the number of years. Income tax, total 30 allowed in the first year, but as per the books 10 allowed. So first year, what is the difference? 20. That means first year in the income tax you claimed more depreciation, 20,000. Now if you claim more depreciation in the current year, that means you enjoyed more tax savings, because when you claim more depreciation, your taxable income is reduces by 20. When there is a taxable income reduces by 20,000 into 30%, 6,000 you might have saved the tax liability, but this 6,000 will resulting into tax liability later. Why? Because next 2 years you don't have any depreciation as per the income tax, but you have a depreciation as per the books. Therefore, this is a timing difference. On this 20,000, if I recognize 6,000 DTL, next year how much of 20,000 has been reversed? 10,000. So 10,000 to 30%, 3,000. I will reverse it. Next year, 10,000 into 30%, 3,000 I will reverse. So in the first year, what is the entry I will write? Simple. P&L to deferred tax liability. P&L to deferred tax liability. 6,000, 6,000. Next year, DTL to P&L. 3,000, 3,000. Next year, DTL to P&L. 3,000, 3,000. That's it. So this is the concept of deferred tax. So the concept of deferred tax is identify the timing differences. On the effect of timing differences, you create the tax provision. Because these differences are only temporary, which is going to reverse. So anticipate. If it is a liability, deferred tax liability. If it is an asset, deferred tax asset. And in future, when this asset and liability reverses, to the extent of the timing difference reverses, you reverse the DTA or DTL. Okay. Now see the questions relating to deferred tax, sir. First, illustration number 1, sir. Suppose there is a company Rama Limited, sir, which has provided the following information. Depreciation as per accounts 2 lakhs, sir. Depreciation as per income tax 5 lakhs, sir. So see this. Depreciation as per accounting records 2. Depreciation as per income tax 5 lakhs. That means as per income tax, more depreciation is claimed, sir. More depreciation claimed means there will be less taxable income. Now depreciation we know is only a timing difference. So this year we have claimed more depreciation as per income tax. That means our taxable income is less than accounting income. That means you might have enjoyed the tax benefit. Therefore, in future on this 3 lakhs there will be tax liability. So 3 lakhs into 50%. That is 1,50,000 is what, sir? DTL, deferred tax liability. Next, there is one more item, sir. Unamortized preliminary expenses as per tax record. See, in the income tax, sir, preliminary expenses will be allowed over a period of time. So if there is any unamortized preliminary expenses, 30,000 is there, which is going to allow in the coming years, no, sir. That means this 30,000, which is the benefit of which is denied, which is going to be allowed in the future. So when the 30,000 is allowed in the future, to that extent my taxable income will come down, and therefore there will be tax savings. So 30,000 into 50%. So 15,000 is my deferred tax asset. So therefore 1,50,000 deferred tax liability, 15,000 deferred tax asset. So 1,35,000 is the net deferred tax liability. Okay, 1,35,000. Simple concept. Yes. Next, sir, one more question. You see, this question, sir, they're quite regularly asking this question. Omega Limited is working on different projects, sir, which are likely to be completed within 3 years period. It recognizes revenue from these contracts on percentage of completion method for financial statements during 10-11, 11-12 and 12-13, 11 lakhs, 16 lakhs, 21 lakhs respectively. See, as per the books, for recognition of revenue from contracts, sir, they are following percentage of completion method. And how much revenue they are recognizing every year? 11, 16, 21. But as per income tax purpose, sir, it has adopted completed contract method, under which it has recognized a revenue of 7 lakhs, 18 lakhs, 23 lakhs for the year 10, 11, 11, 12, 12, 13 respectively. Income tax rate is 35. Compute the deferred tax asset or liability for the year 10, 11, 11, 12, okay, 12, 13. See, understand the concept first. As per books, tell me how they are recognizing the contract. By percentage of completion method. Now, how much revenue they are recognizing? So, 10, 11. How much they recognized? 11 lakhs. 11, 12. 16 lakhs. 12, 13. 21 lakhs. So, total 11 plus 16 plus 21. total 48 lakhs we have recognized as per the books. As per income tax, 7 lakhs, 18 lakhs, 23 lakhs. So 7 plus 18 plus 23, 48 lakhs. So therefore you understand now, whether it is as per the books or as per the income tax, ultimately total revenue recognized is 48 only. The difference is only in the timing. See this. First year 11 7. So difference, timing difference is how much, sir? 4 lakhs. Next year you see, first year as per the books 11, as per the income tax 7 only. That means in the first year, as per the income tax, you paid tax only on the 7 lakhs. Right? That means you might have enjoyed the tax benefit. You paid tax on less income, because you here as per income tax you take only 7 lakhs, but as per books it is 11 lakhs. Therefore, since the 4 lakhs, on these 4 lakhs you have enjoyed the tax benefit, in future on these 4 lakhs there will be tax liability. Therefore, you need to create DTL in the first year itself. 4 lakhs into 35%. So therefore 1.4 lakhs DTL will be created in the first year itself. Next year, sir, you see, as per books it is 16, as per income tax 18. That means 2 lakhs reversed in the next year. Therefore, you also need to reverse the, okay, 2 lakhs, sir, this is 2 lakhs into 35. You need to reverse 0.7 DTL. You need to reverse it. Next year, another 2 lakhs reversed, sir. So 0.7 lakhs you need to reverse. So therefore, it will be nil. Understand the concepts are very simple, sir. So see this. In the first year, you see, as per books 11, as per income tax only 7, na? That means 4 lakhs is less income tax, less taxable income. Therefore, on this 4 lakhs, there is a tax savings in the first year, but which results in tax liability in coming years. Because this 4 lakhs, next year you see 2 lakhs more, IT, income tax is more, 23. That means ultimately this 4 lakhs is reversed to 2. Therefore, first year you recognize DTL, next year's first year you recognize DTL, then you reverse the DTL. See this. So therefore, as per accounts 48, as per income tax 48. The timing difference is first year 4 lakhs, next year 2 lakhs reversed. And then deferred tax on 4 lakhs, 1 lakh 40, 1.4 lakhs. First year I will recognize deferred tax. Second year 2 lakhs reversed. So therefore, I also need to reverse the DTL by 70,000. So the balance is 70. Next year another 70. So DTL will be nil at the end of third year. Okay. And also one more question, sir. Same question. Just now we solved. No need to discuss. So these are the questions relating to deferred taxes. Now recognition of deferred taxes, sir. Sir, when you want to recognize, a current tax and deferred tax. Just now I told you, sir, in the P&L account we need to show the tax expenses. So tax on income is considered as expenses for the period, and it should be included in the determination of net profit or loss. And also, when you are considering the tax expenses, we need to consider the deferred tax expenses also. But relating to deferred tax assets, sir, there is one important point you need to understand, sir. Deferred tax asset. Sir, the standard says deferred tax asset you are recognizing, na, sir. So generally, sir, we don't anticipate any kind of assets, but the standard says you need to anticipate deferred tax asset. So the standard says there are two cases here. One is you are getting deferred tax asset due to unabsorbed depreciation and carry forward of losses. Suppose, as per the Income Tax Act, any unabsorbed depreciation and carry forward of losses are there, we can carry forward and we can set off with the future incomes, right? As per the income tax, it is allowed. So, because of this unabsorbed depreciation and carry forward losses, there will be tax savings in future. So therefore, it will create DTA for you. But the standard says, in this case, if you want to recognize DTA because of reasons of unabsorbed depreciation and carry forward of losses, there must be virtual certainty that there will be sufficient taxable income in future against which this deferred tax asset will be realized. The logic is quite simple, sir. You are saying it is your deferred tax asset. That means there will be tax savings in future. When there will be tax savings in future? Only when there is sufficient taxable income. When there is no taxable income in the future, then how can there will be savings in tax? That in future, CP, suppose for example, your friend will pay tax only when he has income. Suppose he doesn't have any income, will he pay income tax? No. Similarly, I am saying it is my asset, deferred tax asset. Asset means savings in tax. When there will be savings in tax, in future, first of all, there must be taxable income. Against the taxable income, this must be adjusted. Suppose if there is no chance that we are going to get any taxable income, then don't recognize DTA. That's what the standard says. The standard says when you want to recognize DTA, especially in case of unabsorbed depreciation and carry forward losses. Already the company is having unabsorbed depreciation and carry forward losses, means maybe it's a loss making company. So in that case, the standard says you need to have a virtual certainty. Virtual certainty means 100% pakka evidence to say that there will be taxable income in the future. Then only you recognize DTA. Maybe suppose there is a export contract in the hands of the company and company has to fulfill this contract. So we got one contract from the foreign country to supply the goods. So that we can say that if the contract is in hand, we can say that there is a sufficient taxable income in the future because we will fulfill this contract and we are going to get the income. So there will be taxable income. When there is a taxable income, against the taxable income, this deferred tax, this unabsorbed depreciation of carry forward losses can be adjusted. So to that extent, my DTA will be realized. So therefore, here virtual certainty is required. Sir, if DTA is due to other reasons, other than unabsorbed depreciation and carry forward of losses, just now we have seen 43B payments. Now, if DTA is created because of any other reasons, that means if any other reason, if the benefit of tax has been postponed, now then in such situation DTA will be created. Now the standard says in other cases DTA will be recognized when there is a reasonable certainty that there will be sufficient future taxable income. What is reasonable certainty? Reasonable certainty means based on the past records, if company can able to estimate that there will be sufficient future taxable income against which this deferred tax asset can be realized, then they can recognize DTA due to other reasons. So very simple concept there. See, DTA means savings in future. So the standard says when you are going to recognize the DTA, if DTA is created due to reasons other than unabsorbed depreciation and carry forward of losses, then you recognize DTA only when there is a reasonable certainty that there will be sufficient taxable income. If DTA due to unabsorbed depreciation and carry forward losses, reasonable certainty not sufficient, there must be virtual certainty supported by convincing evidence to say that there is a sufficient taxable income against which this deferred tax asset will be realized. So the difference is reasonable level of certainty, virtual certainty. Reasonable level of certainty means based on past records, you can able to estimate that there will be profits in the future. Then only DTA will be recognized. If DTA due to other reasons, if DTA due to unabsorbed depreciation and carry forward losses, standard says virtual certainty should be there. What is virtual certainty? There should be strong evidence, maybe a binding export order, and cancellation of leads to heavy penalties. That means at any cost we are going to fulfill this. If these kind of evidence is to say, evidence is have in the hands of the company to say that there will be sufficient taxable income in future, then DTA can be recognized. Maybe this can be tested as MCQ. Please be careful. Okay, sir, measurement. Sir, when you are calculating the current tax, which rates you will use, sir? Whatever be the applicable rates. See this, measured the amount expected to be paid to tax authorities using applicable tax rates and laws. So every year, as per the Income Tax Act, we have the rates now. The applicable rates we will use for calculation of current tax. Now, what about deferred tax and assets and liabilities? So the standard says when you are calculating the deferred tax, sir, you need to use enacted or substantively enacted rates at the balance sheet date. So they might test a question on this. Don't calculate deferred taxes based on the regular tax rate if the enacted rates are given. Enacted or substantively enacted. Suppose in the question they mentioned, sir, the government has changed the tax rate from 10% to 15% and it was substantively enacted. That means already government has took a decision, but the approval is pending in the court. Approval is pending in the parliament. No problem. It is substantively enacted. Then you can take 15% to calculation of the deferred tax. No need to wait. Okay. So if the rates have been changed, then you need to take the changed rates for calculation of deferred tax. And the question of discounting will not arise in case of deferred tax. Don't discount the deferred tax asset or liability to their present value. And reassessment of unrecognized deferred tax assets. Suppose if you don't recognize any deferred tax asset due to the reasons that there is no reasonable certainty or there is no virtual certainty that there will be sufficient taxable income against which the deferred tax asset will be realized, then every year you need to see the position, whether position has been improved. In future, whether there will be sufficient taxable income to the company against which this deferred tax asset can be realized. Again, company should consider of recognizing the deferred tax asset. Okay. So at each balance sheet date, sir, unrecognized DTS are reassessed. Future taxable income is reasonable or reasonably there or virtually there, then recognize the previously unrecognized DTS, because I said DTA will be recognized only if there is a reasonable certainty. If due to reasons unabsorbed depreciation carry forward losses, there must be virtual certainty. So suppose if there is no reasonable certainty or virtual certainty, we don't recognize now. Suppose every year we need to assess the situation, whether situation improved or not. Maybe last year there is no reasonable certainty. This year my situation may improve, now company position may improve, so we can expect profits in the future. We can expect taxable income in future. That's why they are saying that reassessment can be done. And similarly, review of previously recognized deferred tax asset. Already we recognize DTA because of either there is a reasonable certainty or virtual certainty. But next year may be missing. Maybe the company went into losses. There is no reasonable certainty or there is no virtual certainty. Then whatever the DTA already recognized, reverse it. Okay. And also offsetting the assets and liabilities, sir. What is this offsetting tax assets and liabilities? Sir, can a company set off both current tax assets and current liabilities? Like for example, provision for tax and advance tax, can they set off? Yes. So only when two conditions: legally enforceable right to set off and intent to settle it on net basis. So company can set off current assets and current liabilities. The tax current assets and tax current liabilities, like provision for tax and advance tax, they can, if it is legally legally enforceable, the right to set off is there, and then the company want to settle it on net basis. Generally, provision for tax we will set off with advance tax now. That is allowed. Next, deferred tax assets and liabilities, can they be allowed to set off? Yes, deferred tax assets and liabilities can also be allowed, provided there must be a legal enforceable right to set off and both must be arrived from the same taxation law. Important. This deferred tax asset, deferred tax liability can be set off with each other. Only two conditions must be satisfied. First of all, there must be legally enforceable right to set off. Second, they must arise both from the same taxation laws. For example, the parent company books, there is a DTA. In the subsidiary company, which is there in the USC, there is a DTL. So when I am preparing the financial statements, consolidated financial statements, can I adjust both of them? No. Why? Because DTA in the parent books is arising from the Income Tax Act in India. DTL in the books of US subsidiary arises because of the tax laws in foreign country. So both cannot be set off. So this is one concept, simple concept, sir. Next is special cases. Sir, these are important. What are the special cases, sir? Two special cases. One is tax holiday. What is tax holiday, sir? Sir, in income tax, there are some provisions like 10A, 10B, 80A. Now, these sections will give tax benefits to the companies, to the business enterprises for some number of years. That is called tax holiday. Now, what is the accounting treatment in case of tax holiday? It is simple. Any timing differences which originates and reverses within the tax holiday period, ignore, don't recognize DTR, DTL. Any timing difference which originates but which is capable of reversal after the tax holiday, then recognize DTA or DTL. And always follow FIFO method, first in, first out. The timing difference which originates first is going to reverse first. So 3 points you need to remember. Suppose, sir, there is a business entity. Say this. Suppose there is a company, Info Limited. They have the tax holiday of 10 years. Say this. 10 years tax holiday is there. Right? The standard says within this tax holiday, you don't have any tax liability. Therefore, whatever the timing difference which originates and reverse within the tax holiday period, ignore. Why? Because in the first 10 years, there is no tax liability to you. So the question of anticipation of deferred tax asset or liability will not arise. So therefore, whatever the timing difference which originates and reverses. For example, first year timing differences between accounting income and taxable income is 500. Second year 100. Total 600 lakhs timing difference. Out of 600, 250 lakhs reversed within the tax holiday period only. Ignore. So to the extent of these 250 lakhs, don't recognize deferred tax asset or liability. But sir, out of 600, 250 only reversed, sir. What about the remaining balance, sir? For that, you can recognize DTA or DTL in the year of origination of timing differences. So originate in tax holiday period, but reverses after tax holiday period, create DTA or DTL. Important. So, and when you are reversing, sir, the timing difference which originates first will be assumed to be reversed first. For example, see, this 500 lakhs minus 250, this reversal happened first from this 500, then only you should consider this. So therefore, see this, in this case, what we need to do is, first year timing difference 500 now, how much reversed within the tax holiday period? 250. So what will be the balance? 250. When it is going to reverse? After tax holiday period. Suppose on that 50% tax. So 250 into 50, I need to create, suppose this is DTL. I will recognize DTL of 120. Next year there is 100 lakhs, 30%. That is 120, 30 lakhs. I need to recognize DTL. So timing difference which originates and reverses, both happened within the tax holiday period. Ignore timing difference which originates but reverses after tax holiday period. After tax holiday period, recognize DTL. Because once the tax holiday period is over, you are a normal entity, you need to pay the tax. Therefore, this timing difference which originates between accounting income and taxable income, which is going to reverse after the tax holiday period, you anticipate the deferred tax. Okay, so I will show you one question, sir. Yeah, see this scenario based question 6. There is a company Y Limited, sir, which is a full tax free enterprise for the first 10 years of its existence. So first 10 years full tax free and is in the second year of its operation, sir. Okay, depreciation timing difference INR 200 lakhs 400 lakhs respectively, which will result in tax liability in year 1 and 2, sir. So there is a timing difference in depreciation, sir. We know depreciation is one of the timing difference. First year how much, sir? 200. Second year 400, sir, which will give you tax liability. That means deferred tax liability will come. Okay, from third year, it is expected that timing difference would reverse each year by how much, sir? 10 lakhs. Sir, first 2 years there is a timing difference origination. From third year onwards, they are saying that every year there is a reversal of 10. Assuming tax rate 40%, find out the deferred tax liability at the end of second year and any charge to P&L. Simple question, sir. Suppose, for example, how many years, sir? 10 years. First year, what is the timing difference, sir? 200. Second year, 400, sir. From third year onwards, how much is reversal, sir? 10 lakhs. How many years? 8 years. That means 80 lakhs reversal. Therefore, from this 200, 80 lakhs is reversed. Before method, sir, first in, first out. Whatever the timing difference originated first is assumed to be reversed first. So from this 200, 80 is reversed. So what's the balance? 120. On this 120, 40%, 48 lakhs DTL will be recognized in the first year. The timing difference which originates first reverses within the tax holiday period. To that extent, ignore. Out of 200, 80 is reversed within the tax holiday period. So on this 80, don't create DTL. But 120 which is reversed after tax holiday period, on that you need to create the DTL. In this case, deferred tax liability. Second year 400 lakhs timing difference, on that 40%, so 160 lakhs. So therefore the total DTL in the second year, the DTL is 160, so 160 lakhs will be charged to P&L account, but the total DTL is first year 48, second year 160, so total 208 lakhs in the balance sheet. Simple concept. And last concept, MAT concept. Sir, what is MAT? Minimum alternative tax. Sir, in income tax, you will calculate the tax as per the normal provisions, and also you calculate the tax by seeing the normal provision, MAT provisions, right? Minimum alternative tax, whichever is higher, you pay to the government, right? Suppose in any particular year, your tax liability came, your current tax liability came as per the MAT. Shall I use the MAT rate? MAT rate for calculation of deferred tax also? The answer is no. Deferred taxes is always calculated by following the normal provisions only. Don't use MAT rates. Please understand. Suppose, sir, this timing difference originates, but which is going to reverse in the coming years. So the year which is going to reverse, in that year, suppose my tax liability came as per the MAT. So can I use MAT rate for calculation of DTL, for reversal of DTL? No, never. So even though your current year tax liability is as per the MAT provisions, don't use MAT rates for calculation of deferred tax. Right? So suppose tax paid under section 115 JB, considered as a current tax for the period. Deferred tax, DTL or DTLs for timing differences during tax payment under 115 JB must be measured using regular rates only, not 115 JB rates. And even the year in which the timing differences reverses, you have to use regular tax rates only. So remember, deferred taxes is always calculated by using the regular tax rates, not the MAT rates. Even though the current year the tax liability arises because of the MAT, don't use the MAT rates, sir. Don't use the MAT rates. Okay, that's it, sir. So this is accounting standard 22. The next accounting standard we are going to revise is accounting standard 13, sir. Accounting for investments. Basically, this standard provides the accounting treatment for investments, and it also covers all the aspects relating to investments. right from defining what is investments, providing the basis for classification of investments, how to determine the cost of investments initially, at what value investments will be carried in the balance sheet date, and also whenever there is a disposal of investments, how to determine the carrying amount of investments sold, and what is the accounting treatment for reclassification of investments, what kind of disclosures we need to make in the financial statements relating to investments. So all the aspects relating to investments are covered under this standards. Now let us try to understand first what is investments as per accounting standard 13. See, whenever any business enterprise has any surplus idle cash reserves, they want to invest this surplus idle cash reserves into the most profitable avenues where they will get maximum return for their investments. Maybe they will invest in shares, the debentures, debt securities, government bonds. Maybe they will invest in land, buildings. So depending upon their requirements, depending upon the object they want to achieve, they will find out the most profitable avenues where they want to invest. Sometimes, as a policy, the companies will make investments like investment in associates, subsidiaries, joint venture. Therefore, making investments is part of the business. So, it is very ordinary for any business enterprises. And there is a standard, accounting standard 13, which will provide the accounting treatment for all these kinds of investments. Okay, now let us try to understand what is investment as per AS 13. Sir, AS 13 says investments are assets which is held by the enterprise for the purpose of earning income by way of dividend, interest or rentals or capital appreciation or any other benefits to the investing enterprise. So here the intention, with what intention you are making investment, your intention should be earning income. That income can be in any form, maybe in the form of dividend, interest, rent or capital appreciation, that is increase in value, or any other benefits in the investing enterprise. So the standard says basically investments are assets. Why these assets are held by the enterprise? For the purpose of earning income. In what manner? Maybe dividend, interest, rental or capital appreciation, that is increase in value of assets, or maybe any other benefits to the investing enterprise. And the interesting point is any assets held as stock in trade, they are not considered as investments, because we know any assets held for sale in the ordinary course of the business, which we held them for sale in the ordinary course of the business, that will be considered as what? Stock inventory as per accounting standard 2. So assets held as stock in trade is inventory basically, therefore they are not investments. So we understood what is investment. So basically investment is nothing but our resources we are putting in different kinds of securities, different avenues, so with an intention to generate some kind of benefits. And anything we held for sale in the ordinary course of the business, that is inventory, that is not considered as investment as per accounting standard 13. So what is the object of AS 13, sir? As I told you, the main object of accounting standard 13 is to provide the accounting for investments and also what kind of disclosures we need to make in the financial statements relating to those investments. So basically the standard deals with the accounting for investments in the financial statements and also the related disclosure requirements. Let me tell you one interesting point, sir. Sir, if you are dealing in shares, debentures or other securities, shares, debentures, other securities held for sale in the ordinary course of the business, they are not considered as investments. Just now we have seen any assets held for sale in the ordinary course of the business, they are not investments, they are inventory. But if you look at accounting standard 2, sir, in accounting standard 2 scope also, shares, debentures, other securities held for sale in the ordinary course of the business, they are not covered. That means if I am a dealer in shares, debentures, other securities, AS2 is not applicable, AS13 is not applicable. But the provisions in this standard relating to current investments. Next I am going to explain the classification of investments. In that current investments, the provisions which is applicable for the current investments are equally applicable to the trader of shares, debentures, other securities, but of course with suitable modifications. So that is an interesting point you have to remember. However, their accounting and disclosure are similar to current investments. See this. So shares, debentures, other securities held for sale in the ordinary course of the business are not considered investments, but under this standard. However, their accounting and disclosure are similar to current investments. The provisions of this standard relating to current investments also apply to such stock in trade with necessary modifications. Now scope. Sir, this standard has 4 exceptions, sir. This standard does not deal with the following. First thing is any income generated from investments. This standard is not applicable. The standard applicable for accounting of investments, various aspects of investments, not the income generated from the investments, because we have a separate standard AS 9 which exclusively deals with the revenue recognition. Second thing, sir, any kind of leases, operating lease or finance lease, this standard cannot be applied because we have a separate standard AS 19. Next, any investment in retirement benefit plans, life insurance enterprises, like for the employee benefits, any retirement benefit plans like PF, gratuity, pension, so life insurance, these kind of investments, basically they are not covered under accounting standard 13 because we have separate standard employee benefits. And also, sir, any mutual fund companies, venture capital fund companies, asset management companies, banks, public financial institutions, for them don't apply this standard. So this standard does not cover interest, dividend, rentals earned on investments because they are covered by AS 9. Next, operating or finance leases covered by AS 19. And also investment in retirement benefit plans, life insurance enterprises don't apply this standard. And also mutual fund companies, venture capital fund companies, asset management companies, banks, public financial institutions, for them don't apply accounting standard 13. Next, forms of investments, very simple. Can be physical, can be non-physical. Physical means tangible assets. We may invest in land, buildings. Non-physical means we will invest in shares, debentures, debt securities, government bonds. So they are basically represented by certificates. Next, classification of investments. This is very, very important. Listen to me carefully because the next whatever we are going to discuss, so the carrying amount of investments depends upon the classification of investments. Whatever the aspects next we are going to discuss, that depends upon this types of classification of investments. Let us try to understand this classification of investments properly. Sir, AS 13 has divided the investments into two categories. One is current investments, another one is long-term investments. Sir, what is current investments? Current investments are those investments by nature readily realizable and which is held by the enterprise with an intention of holding not more than 1 year, which are intended to be held for not more than 1 year from the date on which the investment is made. Sir, what is current investment? Current investment is an investment that is by nature readily realizable. By nature, that must be readily realizable. That means you should have an active market. Whenever I want, I can sell it and I can get the cash. By nature, the investment should be readily realizable. Suppose if by nature, if it is not readily realizable, that cannot be considered as current investment. So what is current investment? An investment that is by nature readily realizable. And the second thing is, I intended to hold for not more than 1 year from the date on which such investment is made. My intention is to hold not more than 1 year. That means whenever I will get a good price, I am ready to sell. I am not intended to hold for not more than 1 year. And the intent to hold for short period is determined at the time of purchase. Maybe investment in shares, debentures, so government bonds. These are all what, sir? By nature readily realizable. And if your intention is to hold not more than 1 year, then they will be classified as current investment. Suppose if I invest in a unlisted startup company, shares. So by nature, is there readily realizable? No. Who will purchase, sir? Unlisted, maybe newly started companies. I have some shares. I want to sell in the market. Maybe ready-made market is not available. Active sales are not happening because they are unlisted and that too startup company. So therefore, they are by nature not readily realizable. Therefore, you cannot classify them under current investment. So to become a current investment, by nature, it must be readily realizable. That means it should have an active market. Whenever I want, I can convert them into cash. And my intention is to hold for not more than 1 year from the date on which the investment is made. And all other investments are long-term investments. Next, the most important thing. So we understood the classification of investments, current, long-term. Current, intention is to hold not more than 1 year and by nature they are readily realizable. Okay. All other investments are long-term investments. Now, sir, how to determine the cost of investments? Sir, initially when you acquired any investments, how to determine the cost? Sir, the determination of cost depends upon the mode of acquisition. Here I have given 3 different modes of acquisition, sir. First one, investments are acquired by cash or bank. Sir, when you acquire any investments by cash or bank, purchase price, add all the taxes, duties, all kind of expenditure which is directly related to acquisition, you just add. Like for example, stamp duty, brokerage, commission, whatever you pay, any kind of taxes, everything you must add to the cost of investments. Second, investments acquired by issue of shares or securities. Sometimes, sir, we will acquire any investment by issuing our own company shares or securities. Then in such a situation, the cost of investments acquired is the fair value of the securities issued. Whatever the shares and securities you are issuing now, sir, the fair value, that will be the cost of investment. Sometimes you acquire investments by issue of any other asset, sir, not shares or securities, any other asset. In such a situation, the standard says the fair value of the asset given up or the fair value of the investments acquired, whichever is more clearly evident, that will be the cost of investment. So three cases. One is investment acquired by cash or bank. So cost generally includes acquisition charges like brokerage, fees, duties, everything we will add. For example, X Limited investor rupees 200 lakhs with a brokerage cost of 1 lakh. So investment value is 201. So investments acquired by issue of shares or securities. Then acquisition cost is the fair value of the securities issued. For example, X Limited acquiring debentures of Y Limited. And for that, the shares, equity shares are issued as a consideration. Now in that situation, what is the cost of debentures we are acquiring? Simple, the fair value of the equity shares issued. Suppose we are issuing 10,000 equity shares of 10 rupees each. So 1 lakh is the fair value. That will be the cost of debentures. Now sometimes investments are acquired in exchange for any other asset. Then in such a situation, fair value of the asset given up or the investment acquired, whichever is more clearly evident. Sir, if both are clearly evident, then you can take any one, nothing wrong. Okay, so three cases. Now the most important point is this one: interest, dividend, rentals receivable. Sir, when you make investment, from the investment you are going to receive some income in the form of interest, dividend, maybe rent. Suppose if you invest in buildings and the buildings are given for rent, you will get rental income, right? So basically these are what incomes, and we will credit to P&L account. Generally incomes are credited to P&L account because they are revenue incomes. Okay, but in some cases they will be treated as recovery of cost of investment. Rather than transferring to P&L account, we will adjust to the cost of investment. That's why this point I am discussing in the cost of investments. So generally these are incomes, sir, we will credit to P&L account, but sometimes they are representing recovery of cost. So instead of crediting to P&L account, what we will do is we will adjust the cost of investment. Generally it is income from investment and credited to P&L account. Of course AS9 is applicable, this standard is not applicable. In some cases these represent what? Recovery of cost, not income. Sir, when they will represent recovery of cost? See here, see this, there is a concept called pre and post acquisition interest. So first I will take debt securities. For example, I am Mr. X, sir. Okay, I invested in 10% debentures in A Limited. 10 lakh rupees I invested in the 10% debentures in A Limited on 1st October. Okay, this company pays interest on 30th June, 31st December. So once in 6 months they will pay. Now tell me, understand this properly. When I purchased this investment, sir, 1st October, correct? This is the date of purchase. Now already by the time I am purchasing this debentures, when was the last time interest paid, sir? 30th June. That means July, August, September. 3 months are already over. That means the person from whom I am purchasing these debentures, sir, I am not purchasing debentures directly from the company. I am purchasing debentures from the debenture holder. Already a person invested in the debentures of this company. Now from him I am purchasing. So I am purchasing on 1st October. Okay. Now tell me, if you are the seller, you know already last time interest was paid on 30th June and you are holding these investments for the next 3 months also. So July, August, September. And you are selling these to Mr. X on 1st October. Now think from Mr. X point of view, sir. Mr. X will pay the 3 months interest also to the seller. Okay, 3 months interest. That is pre-acquisition period actually. Pre-acquisition period is June to 30th June to 1st October. Now whenever I am purchasing debentures from the existing seller, so by the time I am purchasing, how many months interest already accrued, the seller will charge that interest also from the buyer. Therefore on 1st October, sir, as a buyer, I will purchase these debentures along with the interest. Now suppose in the question, if they mentioned about the sale price including interest, that is called cum interest price. Suppose if they quoted a price excluding interest, that is called X interest. Sir, cum interest price, X interest price are their expression of selling prices, sir. Understand? If the seller quoted a price including the interest component, that is called cum interest. Suppose if the seller quoted a price excluding interest, that is X interest. X interest doesn't mean that seller won't charge interest. In the price whatever given, that interest is not included. That is the meaning here. Understand? So therefore, if I am the seller, I am selling to Mr. X on 1st October debentures, I will charge 3 months interest. And as a buyer, I know I will pay 3 months interest and I purchased these debentures. Now the due date came, 31st December. Now you tell me, Mr. X will get how many months interest? Total 6 months interest he will get. Company will not see out of this last 6 months who is having how much period. Company will not do that. Company will see on 31st December whose name is there in register of debentures. Mr. X is there. So Mr. X will get 6 months interest. But frankly speaking, sir, Mr. X out of the 6 months, first 3 months he does not have any interest. And next 3 months he is having investments, right? Therefore, this 3 months, that is 30th June to 1st October, is a pre-acquisition period. And relating to this period, whatever the interest he received from the company, that is what, sir? That is nothing but recovery of cost, pre-acquisition interest. And after once he make an investment, whatever the interest he get, sir, that is post-acquisition. That will be treated as revenue income charged to P&L account, credited to P&L account. For example, in this case, interest calculated, sir, 10 lakhs face value, 10% for 6 months, 50,000 came. This 50,000, sir, pre-acquisition, post-acquisition. Pre-acquisition 3 months, post-acquisition 3 months. So therefore, 50,000 into 3 by 6, 25,000, which is recovery of cost adjusted to cost of investment. Therefore, from the cost of investment of 10 lakhs, I will reduce 25,000. So 9 lakhs 75,000 we need to consider. Post-acquisition interest will be credited to P&L account. So you understand the concept, sir? See, generally income received sometimes, generally income received is credited to P&L, but sometimes it is treated as recovery of cost. Now in this case, on 31st December, whatever the interest received by Mr. X from the company, 6 months interest. Out of the 6 months interest, first 3 months pre-acquisition period, he does not have any investment. So this 3 months interest, whatever he is receiving now, sir, it is treated as recovery of cost. It is treated as what? Recovery of cost. And it is adjusted to cost of investment. Next, similarly, sir, when it comes to shares, for example, sir, there is a company A Limited, sir. 24-25 is the year. Now, from 1st April 2024 to 31st March 2025 is the financial year. Now, I purchased the shares of this company on 30th June 2025, sir. 30th June 2025. Now, this company on 30th September 2025 declared the dividend relating to 24-25. Last year dividend was declared on 30th September 2025. And suppose I am Mr. X, sir, I don't have any investment in this company. One share, not even one share I hold in 2024-25. But I have shares before dividend is declared relating to the last year. Now that means, tell me, whatever the dividend I am going to get from A Limited relating to the last year, it is basically representing what? Pre-acquisition dividend. Because I don't have investment in this period. So this is my pre-acquisition period. I acquired on 30th June. Even though I don't have any investment in the last year, but when company is declaring dividend relating to the last year, by the time I'm investing, by the time they are declaring, my investment is there. Therefore, it is my pre-acquisition dividend, which is also adjusted to what? Cost of investments. So it's a pre-acquisition dividend, sir. Okay. So it's the same concept we have taken in consolidation also, sir. Pre-acquisition dividend. So when the subsidiary company declares dividend from the pre-acquisition profits, so we consider it as a pre-acquisition dividend. Similarly, as an investor, after I make an investment, okay, from the profits which is generated by the company after I made an investment, so that is my revenue income. Because suppose I invested in a company, my money used in the business, profits earned, whatever the profits distributed to me, maybe I can consider that as my revenue credited to P&L account. Imagine last year I don't purchase the company shares. That means I don't have any investment in the last year. But still I managed to receive some share in the profits of the last year because I purchased the shares before declaration. Sir, please understand, sir, whenever company gives a dividend, they don't see who is having shares in the last year and all. So they will have one date called record date. So on that date, if your name is there, they will give you the dividend. Okay. So understand this. That's it. So this concept. So therefore, basically incomes is created to P&L, but sometimes they will be represented as recovery of cost. So any kind of pre-acquisition dividend or pre-acquisition interest adjust to the cost of investment. And there is one concept relating to rights shares. Important, sir. Listen to me carefully. Sir, generally what is rights shares? To the existing shareholders, if company has given any shares, those are called rights shares. Now, either existing shareholders can subscribe the rights shares or they can transfer their rights to somebody else. Now, suppose if I am an investor in a company, company has offered some rights shares, I subscribed. Therefore, my cost of investment will increase, right? So, if I subscribe, cost is added to the original holding carrying amount. Okay. If I subscribe, sir, whatever the cost I incurred for purchase of the rights shares, it will be added to my original holding. Now, suppose if the rights are sold, I have not subscribed, but the rights I have sold to somebody else, then what I need to do? Whatever the amount you are going to receive for sale of rights, that will be treated as income, that will be created to P&L account. So sale proceeds are recorded in P&L account as income. But there is one exception here, very, very important, sir. Generally, if company has given the right shares to you, right offer to you, if you don't subscribe, you can transfer to somebody else. Now, whatever the proceeds you got from the sale of the rights, you can definitely transfer to P&L account as an income. But there is one exception. The standard says, sir, sometimes if the shares are acquired on cum right basis and after they becoming ex right, if the value of the investment, I mean the market value of the shares falls below the cost of investments, then the sale proceeds from rights are adjusted against the cost of investment. If shares are purchased on which basis? Cum right basis. Cum right means including right. That means company already announced the rights. Now on the shares, this right benefit is included. So whoever is having these shares, they will get the right offer, right shares offer. So the shares are acquired on which basis? Cum right basis you acquired. That means on my share, I am going to get the right offer. Next. And after they becoming X right, that means right shares have been issued. The offer is over. Now they become what? X right. So you acquired on cum right. Now they become X right. Now if the market value of the shares, look at the market value of the shares you invested. If it is falls below the cost of investment, the market value is falls below the cost of investment, then the standard says whatever the sale proceeds you got from the sale of rights, if you sold the rights, then it will be adjusted against the cost of investment. That means, see here, for example, I am Mr. X, sir. Okay, the cost of investment, suppose for example, is 10 lakhs, sir. 10 lakhs I invested in a company. So 10 lakh rupees I invested. 1000 shares I purchased, sir, 10 lakhs. Now company offered me right offer another 1000 equity shares, right shares. Now if I subscribe these 1000 shares, so 1000 shares, each share is offered at 10 rupees, for example. So 10,000 rupees I will add to the cost of my original holding. So my investment will become 10 lakh 10,000. Originally I have 1000 shares. The carrying amount of the investment is 10 lakhs. Now they offered right shares, and if I subscribe, 10,000 rupees is my cost. I will add to the original cost of holding. Suppose instead of subscribing, I sold the rights. Now whatever the amount I got from the sale of rights, so 1000, for example, I sold it for 1 rupee. So therefore 1000 rupees I will credit to P&L account. But what is the exception here? The exception is sometimes I purchase the shares on cum right basis, and after they becoming X right, if the market value of the shares fall below the cost of investment, then the sale proceeds I will adjust to the cost of investments. I will adjust to the cost of investments. For example, see sir. Suppose I purchased the shares 10 lakh rupees, sir. Cost of purchase of shares 10 lakhs. Cum right. Now after they becoming X right, the market price becomes 8 lakhs. That means how much is the fall? Tell me. 2 lakhs is the fall. Now the standard says, sir, from the sale of rights, suppose you got 1,50,000 rupees. So try to adjust this 1,50,000 with this fall. Don't credit to P&L account. Generally, whatever the amount you got by sale of rights, you will adjust to P&L account now. But this is the exception. When this exception will applicable? If the market value of the shares after becoming X right falls below the cost. Then the sale proceeds you will try to adjust to the cost of investment. That means bank account debtor to sale proceeds from right 1,50,000, 1,50,000. Sale proceeds from right to investment. So this 1,50,000 will be adjusted to the investment value instead of creating to P&L account. Generally what we do, sir, in this case, bank account debtor to sale proceeds from rights. Whatever the sale proceeds from rights are there, 1,50,000 suppose we got from sale of rights. These sale proceeds we will transfer to P&L account. Sale proceeds from rights account debit to P&L account I will credit. 1,50,000, 1,50,000. Right? 1,50,000, 1,50,000. This is the normal treatment. But if you see the market value of the investments is fall below the cost of investment, then use this proceeds from sale of rights to adjust the cost of investment. Your investment initially 10 lakhs now it should brought to 8 lakhs because 2 lakhs fall. So that 2 lakhs fall is a loss. Try to adjust this loss with the sale proceeds from rights. So therefore, in this case, sale proceeds from rights account debit to investments. So try to adjust the loss to the extent of 1,50,000 with the sale proceeds from rights. So this is the exception. So you understand this point, sir? Rights shares. I think in study material we have one question also, sir. Yeah, see this question, sir. Mr. X acquires 200 shares of a company on cum right basis for 70,000. He subsequently receives an offer of right to acquire shares in the company in the proportion of 1:1 at 107 each. He does not subscribe but sell the rights for 12,000. The market value of the shares after they becoming X right 60,000. You see, sir, that means my cum right price, how much, sir? Cum right price 70,000, right? Now what is the market value after X rate? 60,000, sir. Therefore how much is the fall, sir? 10,000 fall, sir. Now tell me what standard says whenever the market value of the shares after becoming X rate is fall below the cost of investment, then whatever the sale proceeds you got, 12,000 you got, sir, try to adjust the loss with this profit, I mean with this income. Therefore here bank account debit, how much you are getting from sale of rights? 12,000. Adjust to investment account 10,000. Balance you transfer to P&L account as normal income, because generally from rights from sale of proceeds from sale of rights we credit to P&L, but in this case 10,000 we will adjust to cost of investment, remaining 2,000 will be transferred to P&L account. So in this case, out of the sale proceeds of 12,000, 10,000 may be applied to reduce the carrying amount to bring it to the market value, and 2,000 will be created to P&L account. Okay, so that's it, sir. So this is the cost of investment, sir. So 5 points are there, all the 5 points we have discussed. Next, so initially when we acquire investments, how to determine the cost we have seen. Now carrying amount of investments, sir, in the balance sheet at what value the investments will be carried? Important, sir. Sir, when it comes to current investments, the standard says cost or fair value, whichever is lower. When it comes to long-term investments, sir, always at cost. Always at a cost. So, if you are having current investments, how to value the current investments, sir? Cost and fair value, whichever is lower. Whichever is lower. Suppose the cost of investment is 10 lakhs. The fair value is 8 lakhs. So we need to value the investments at 8 lakhs. Suppose for example, next year, value the investment at 8 lakhs. That means investments will be reduced by 2 lakhs. So this 2 lakhs is what? Our loss. This will be transferred to P&L account. Right? Suppose for example, next year what happens is your fair value has become 11 lakhs. Cost has become 10 lakhs. So now you need to value the investments at 10 lakhs. Anything in excess of the cost you should ignore, because the principle is always what? Cost or fair value, whichever is lower. cost or fair value, whichever is lower. So any reduction in fair value is debited to P&L account. However, if the fair value of the investment is increased subsequently, the increase in value of current investments up to the cost of investment is credited to the P&L account, and any excess portion, if any, is ignored. Therefore, whenever there is a fall in value of investments, I mean the cost or fair value, whichever is lower, if the fair value is less than cost, what we need to do is we need to bring the investments from the cost to fair value. So entry is what? So P&L account data to investments. Next year, suppose for example the fair value may be increased beyond the cost, then investment to P&L account to the extent of the cost of investment. So always remember, current investments are valued at cost or fair value, whichever is lower. Now valuation. Sir, how to do the valuation? Sir, standard says overall basis is not appropriate. You cannot value current investment on overall basis. You need to value them individual basis. Individual basis. So overall basis is not considered appropriate. Prudent method is to carry investments individually. So whatever the current investments you have in different companies, for example, you have investment in A Limited, B Limited, C Limited, each investments you try to value separately. Don't follow the global basis, the overall basis for valuation. Now long-term investments, very important, sir. Sir, the standard says, sir, long-term investments are always carried at cost. Always carried at cost. But there is one exception. If there is a decline in the value of investment, and if due to reasons other than temporary, if the value of the investment was declined, I mean the fair value of the investment is below the cost due to reasons other than temporary, then the standard says you need to make the value of investments to at fair value. That means suppose for example the cost of investment is 10 lakhs, sir, but the fair value is 9 lakhs. You see there is a 1 lakh decline. Why the decline happened? Because of reasons other than temporary. Then standard says you need to value the long-term investments at their fair value. Generally they will be carried at cost, but if there is a decline in the value of investments due to reasons other than temporary, then you need to value the investments at their fair value. So this, where there is a decline other than temporary in the carrying amount of long-term investments, the resultant reduction in the carrying amount is charged to P&L account. The reduction in carrying amount is reversed when there is a rise in the value of investment or if the reasons for reduction is no longer exist. So because of reduction in value of investments due to reasons other than temporary, then you can bring the investments from the cost to their fair value. Again, if there is an increase in the situation, if there are situations that your value of investments increased and those reasons are not temporary, then you can bring your investments back to their cost. So that is what they are saying, sir. Okay, sir, here the most important thing is what is reasons other than temporary. See, they have given some examples, sir. Examples of decline other than temporary. Suppose there is a company which is suffering continuous cash operating losses. A company in which investment is made is suffering continuous cash operating losses. So it's a sign that the reasons are other than temporary, leading to reduction in net worth. New regulations, another example, sir. Suppose government has brought in new law, sir, which is negatively impacts the working of the investing, which is negatively impacts the working of the investing. So that can also be considered as another reason other than temporary. Next, significant reduction in quoted price. Suppose if the company market price has been significantly reduced. Okay, so see here, I will show you. Suppose see, continuous cash operating losses or net worth erosion. Suppose Steel Corporation Limited has been reporting cash operating losses for the last 3 years due to rising raw material cost and declining the demand. Sir, our raw material cost is continuously increasing, sir. Our demand has been fall down. So that means we are suffering continuous cash operating losses. And its net worth is reduced by 60%, impacting its ability to continue as a going concern. So can be considered as what? Reasons other than temporary. Then in such a situation, you need to see if I make any investments in any company and if that company has any losses, continuously it is suffering cash losses, then I may think about valuing my investments other than at a cost. That means I need to bring to its a fair value because the reasons are other than temporary. Maybe negative impact of new regulations. Second, a new environmental regulation has imposed strict pollution control norms requiring heavy capital investment. Steel Corporation Limited lack funds to comply with the new requirements, forcing reduction in production capacity. Suppose government has brought a new environmental regulation which says all the companies have to install the pollution free control equipment. Now we have old machinery. Now in order to replace old with the new, we need to invest huge amount. The company does not have funds. That means, can I say that the new regulations is negatively impacting the investee? That can be reasons other than temporary. And the last one, sir, significant reduction in quoted price. Suppose the market price is 250, sir. Now it come back to 80. In the over the 15 months, 250 has become 80 because of the persistent losses and regulatory concerns. Then we can say that it is reasons other than temporary. So therefore, in examination, they may give a question relating to the valuation of long-term investments. So understand, long-term investments are always valued at cost, but if there is a decline in value of investments due to reasons other than temporary can be continuous cash operating losses, which is leading to net worth erosion of the company, and maybe a new regulations which is introduced by the company which is significantly impacting the working of the investee, or maybe significant reduction in the quoted price where there is no chances that there is a recovery again. All these are what the reasons other than temporary. And again, sir, even long term investments also, try to invest them on individual basis. Don't invest them on, make a valuation of them on global basis. Next, investment properties. Sir, what is this investment property? The investment property means investment in land or building, not for the purpose of using in the business, but the purpose of earning income is called investment property. So investment property is basically investment in land or building that are not intended to be occupied substantially for use or in the operations of the investing enterprise. See, we don't purchase this for the purpose of using in the business, but our intention is to earn some income. So those are called investment properties. And if you remember, sir, accounting standard 10 says these investment properties are valued by using the cost model as per AS 10. Okay. Now there is one important point in the study material, sir. Shares in cooperative society or company. Suppose, sir, the cost of any shares in cooperative society or company, the holding of which is directly related to right to hold the investment property, is added to the carrying amount of investment property. Sir, in order to, sometimes in some places, sir, suppose in order to acquire any investment property, if I need to purchase shares in a cooperative society or a company, because what happens is in respect of certain properties, sir, so they will form a cooperative society or a company. Now first, in order to hold that investment property, I need to invest in that cooperative society or company. So whatever the cost I spend for acquisition of shares in a cooperative society or company, the holding of which is directly related to right to hold the investment property. So in order to hold that investment property, if I purchase any shares in a cooperative society or a company, now the cost of the shares which is directly related to holding of that investment property, then we need to add the cost of shares to the carrying amount of the investment property. So this is one small point, sir. So in order to hold any investment property, if I purchase shares in a cooperative society or a company, now since the cost of the shares is directly related to the acquisition of investment property, so I can add this to the carrying amount of the investments. Very small point, nothing great. Okay. Suppose, sir, see this example. ABC Limited wants to buy an office space in a commercial building run by XYZ Cooperative Society. Instead of directly purchasing the property, ABC Limited must buy what? 5,000 shares of XYZ Cooperative Society, which gives them the legal right to occupy and use the office space. So, see here, in order to acquire the right to use the investment property, we need to buy 5,000 shares in the cooperative society because these buildings are owned by cooperative societies. Now, these shares are not separate investments, but necessary condition to hold the property, right? Therefore, not only the direct cost of acquiring the property, but also any additional cost, such as shares related to cooperative society that grants the right to hold the property, should also be included in the carrying amount. Okay, very simple, you understand it? So, sometimes in some places, sir, if any office space in a commercial building, if I want to acquire, which is run by cooperative society, I need to purchase the shares in the cooperative society to get the right to hold the investment property. In such a situation, whatever the cost I acquired, so to get the right to use the investment property. That cost is also part of the carrying amount of the investment property. So include in the carrying amount of the investment property, sir. Okay. Now next, sir. Next is disposal of investment. Sir, suppose if any company, if any investor disposed his investments, then, sir, whenever there is a disposal, so there is a sale, we need to find out the profit or loss. How to find out the profit or loss? Compare the sale value with the carrying amount of investment sold. What is the sale value? What is the carrying amount of investment we are selling? Compare it. So the difference between the carrying amount and disposal process. Carrying amount and disposal process. Disposal process means sale value. Net of expenses is recognized in P&L account. Suppose if I sold partial disposal of investment, for example, I'm having 1000 shares. Out of 1000, I'm selling 500 shares. Therefore, you need to find out the carrying amount of the investment proportionately. See, where the part of the investment is sold, the carrying amount allocated to that part is based on the average carrying amount of the total holding. Average carrying amount of the total holding, sir. For example, see sir, I buy 500 shares at 200 each, sir. 1 lakh is my total. Now, out of this, I want to sell 250 shares at 220 each. So, therefore, in this case, what is my sale value, sir? 55,000. And if I want to profit or loss, I need to compare carrying value, sale value with carrying amount. What is the carrying amount, sir? I purchased 500 shares at 1 lakh. And what is the shares? I am selling 250 shares. So, find out the carrying amount of the investment sales, carrying amount of the shares sold based on the average basis. So 50,000. So this is the carrying amount of the investment sold. So 5,000. So whenever part of the investment is sold, find out the carrying amount of investment sold based on average basis. When part of the investment is sold, the carrying amount is allocated to that part is based on the average carrying amount of the total holding. Now, reclassification of investments. So this is one of the very, very important topics, sir. I don't know, but most of the times they are asking question from this only. What is this? Sir, suppose at the time of making investment, your intention is these investments are my current investments. Later on, you can change your opinion. No. I want to treat them as long-term investments. Maybe at the time of investment, you are treating them as long-term investments. Now you want to change your intention. No. They are not my long-term. I want to treat them as current investments. So that is called reclassification of investment. Now, reclassification can be from current investment to long-term investment, maybe from long-term investment to current investment. Anything is possible. Initially, it is my current. Now I want to treat them as long-term. Initially, it is long-term. Now I want to treat them as current investment. Okay. Now listen. Sir, when you initially treat it as current, now you want to treat them as long-term investments. So at what value they will be measured? At what value the transfer should be made? Important, sir. At what value the transfer should be made? Now, when you are transferring from current to long-term investment, sir, this transfer should be made at the lower of the cost and fair value at the date of transfer. The lower of cost and fair value at the date of transfer. Suppose if you want to convert from long-term to current investments, then the transfer will be made at the lower of cost and carrying amount at the date of transfer, whichever is lower. So I will tell you one small trick here, sir. Simple. So whenever reclassification of investment question given, sir, you see old is what? Long-term. New, current investments. So think from the new one point of view. So generally, how current investments are valued, sir? Cost or fair value, whichever is lower. Cost or... So no. When you are converting, reclassification of investment is happening now, sir. So long-term to current investments. Generally, long-term investments. Old point of view, tell me, long-term investments generally carried at what value, sir? Cost. And if there is a decline due to reasons other than temporary, then maybe it is brought to their fair value. That means carrying amount may be different than the cost. So therefore, you compare cost and carrying amount. Whichever is lower, you take. And that too on the date of transfer. Please understand, on the date of transfer, what is the cost? What is the carrying amount? Whichever is lower, that will be the transfer. That is the value at which the current investments will be shown. Now suppose if you are changing from current to long term, so current is old, long term is new. Now think from the old point of view, current investments generally valued at cost or fair market value, whichever is lower. So take it, cost, fair value, whichever is lower, that's it. So whenever reclassification is done, sir, originally it is what kind of investment, based on that the transfer will be made. Suppose if I am converting from current to long term, current investments are generally valued at cost or fair value, whichever is lower. Therefore the transfer will be made at that value, cost and fair value on the date of transfer, whichever is lower. Suppose if you are converting from long term to current investments, long term investment generally valued at cost, and if due to reasons other than temporary, if it is valued other than cost, then the carrying amount. So cost and carrying amount, whichever is lower. So remember this point. And finally, sir, what kind of disclosures we will make in the financial statements? So relating to investments, what is the accounting policy companies following? Interest, dividends, how much we earned, how much is the profit or losses from disposal, any restrictions relating to ownership of investments, and provide the aggregate amount for quoted unquoted investments. Quoted means listed company securities, unlisted company securities, including their market value of quoted ones, including any additional disclosures required by law, and classify the investments. Disclosures not that much important, sir. Now, sir, in this accounting standard 13, sir, we have questions relating to investment account preparation, sir. Now you try to solve questions relating to investment account, sir. Investment account preparation, variable income investment, fixed income investment, sir. So solve one question relating to variable, solve one question relating to fixed income investment, sir. Entire standard I have covered, sir. Mostly there is a chance that the question may come from the standard, or maybe of course investment account can also be asked, but if at all they want to ask an investment account, they have to ask it at least for 8 to 10 marks, sir. That's the problem. Chances that maybe a 4 marks question may come. Okay, mostly from the standard. Okay, see this question, illustration number 13. This is relating to reclassification. So ABC Limited wants to reclassify its investments in accordance with AS 13. Decide and state on the amount of transfer based on the following. Okay, a portion of current investments purchased at 20 to be reclassified as long term. So tell me, sir, they want to transfer current investments to long term investments. At what value the transfer will be made? Originally it is current, so therefore cost or fair value, whichever is lower. Correct? Cost or fair value, whichever is lower. What is the cost? 20. What is the fair value? 25 given. So whichever is lower means 20 over. Next, another portion of current investment purchased for 15 to be reclassified as long term investment. Again, current investments they want to transfer it, classify as long term. Again, cost or fair value, whichever is lower. What is the cost, sir? 15. What is the fair value, sir? 6.5. Whichever is lower means 6.5. And the last one, long term investments no longer considered for holding purpose to be classified as current. So long term investments they want to classify as current investments. So when long term investments are classified as current investments, cost or carrying amount, whichever is lower. So what is the cost, sir? 18. But it had to be written down to 12. So carrying amount is 12 due to reasons other than temporary. So 18 or 12, whichever is lower, 12 should be the answer. Now, next, sir, how the questions will be asked. Now, suppose an unquoted long-term investment is there, which is carried in the books at 2 lakhs. So there is a long-term investment, sir, which is carried in the books at 2 lakhs, sir. The published accounts of the unlisted company where we invested received in May 2011 showed that company was incurring cash losses with a declining market share. I told you, sir. Tell me, sir. Cash losses with a declining market share is which reason? Due to reasons other than temporary. I told you. I have given 3 examples. In that, the first one, continuous cash operating losses. So in the examination, when you see the cash losses with a declining market share, then you see the reasons are other than temporary. If the reasons are other than temporary, the long-term investments are valued at their valued to their fair value, and the long-term investments may not fetch more than 20,000. That means original cost 2 lakhs. Generally, long-term investments are carried at 2. But if there is a decline due to reasons other than temporary, so here other than temporary only, therefore it should be valued at fair value, that is 20,000. So therefore 2 lakhs is the cost. Now we need to market value 20. We need to value at 20,000. 1,80,000 is what? Losses, sir. Losses. So, and also, sir, X Limited on 1/1/2011 had made an investment of 600 lakhs in equity shares of Y Limited, of which 50% is long-term category and the rest is temporary investment. That means 50% long-term, 50% is current investment, sir. So total investment 600 lakhs here. So 50% long term, 50% current investment. So long term investment 300 lakhs, current investments 300 lakhs sir. Okay. Next what happened? The realizable value of all such investments become 200 lakhs as Y Limited lost case of copyright. From the given market condition, see, it is apparent that the reduction in the value is not temporary in nature. That means there is a permanent reduction. How will you recognize the reduction? Simple, sir. Sir, your cost of investment is how much, sir? 600. 300 long term, 300 current investment. Right? This is the cost of investment. Now at the end we got the recoverable value. So how current investments are valued? Cost or fair value, whichever is lower. What is the cost, sir? 300. What is the fair value, sir? I mean the market value. The realizable value 200, sir. In that 50% current. Therefore 100. Whichever is lower means 100. So therefore current investments are valued at 100 lakhs. Now come to long-term investments, sir. Long-term investments are generally valued at cost. What is the cost, sir? 300. If there is a decline other than temporary, then they will be write down to their market value. What is the market value, sir? 200. Out of that 50%, 100 lakhs. So the reasons are other than temporary. Therefore, long-term investments are valued at market value 100. That means 200 is what, sir? Loss. 200 lakhs is the loss in value of long-term investment. So these are the types of the questions they are asking from accounting standard 13. So, okay, that's it. The next accounting standard we are going to revise is accounting standard 18, sir, related party disclosures. Basically, sir, this standard is a disclosure based accounting standard, sir. Like accounting standard 17 and 24, this is also one of the disclosure based accounting standards. Here the disclosures are relating to related party. Now when a party is said to be related, what kind of related party relationships are covered and what kind of disclosures we need to make in respect of related parties, all these things they have prescribed in this standard, sir. See, this standard is based on a simple idea, sir. Whenever we do transactions with our related parties, there is a chance that the transactions might got influenced by relationship. There is a chance that the terms of the transactions might got compromised because of the relationship. Similarly, when a business enterprise has done any transactions with the related parties, there is a chance that somewhere the company's interest might got compromised because of the relationship. Because of the relationship, the company's interest may got compromised or maybe terms of the transactions may got compromised. So therefore, they brought accounting standard 18 and through this they are making mandatory for business enterprises. Dear business enterprises, who are your related parties, what kind of relationship you had, what are the types of transactions you are doing with them, you kindly disclose. We are not saying you have done something wrong, but there is a chance that the company terms may be got compromised. There is a chance that some misuse of the company funds may happen. Therefore, you kindly disclose it, then everybody will know what company is doing, who are all related parties to the company, what transactions this company is doing with them. Suppose a company appointed the managing director's son as the consultant and paying 10 lakh rupees as remuneration every month. And the same consultant with the requisite qualification, same qualification is available from the market for 5 lakhs only. Now the question is, why company is paying 10 lakhs? So the people started asking questions now. So that's what this standard wants to achieve. This standard making it mandatory for business enterprise, you disclose your related parties and your transactions, then rest will be issued by the users of financial statements. Okay, sir, how to learn this standard, sir? First, come to the definitions and try to understand who is related party. Sir, the standard says parties are said to be related if at any time during the reporting period, one party has the ability to control the other party or exercise significant influence over other party in making financial and operating decisions. So to become related party, sir, any time during the reporting, sir, even for one day sufficient, any time during the period, one party has the ability to control the other party or exercise significant influence over the other party in making financial and operating decisions, either financial decisions or operating decisions. I can exercise the significant influence. Financial decisions, loans, borrowings, operating decisions, production, manufacturing, procuring raw material, all these operating decisions, financial decisions. So to become related parties, what is required? Tell me. Control, significant influence. If one party has the ability to control the other party or exercise significant influence over other party, then both of them are considered as related parties. And this can happen at any point of time. at any time during the reporting period. Now, what is control, sir? See, the standard says control can be achieved through three ways. One is having more than 50% voting power, directly or indirectly. Having control over composition of board of directors, that is ability to appoint or remove either all or majority of the directors. Then the third one, substantial interest, control of substantial interest in the voting power and power to direct the financial and operating policies of the enterprise. So more than 50% control over composition of board of directors, substantial interest, control of substantial interest and power to direct the financial and operating policies. That means if my my company has the ability to direct the financial and operating policies of the other enterprise, I have the power to direct the financial and operating policies of the other enterprise, then I say I have control. Now here substantial interest means having 20% or more voting power. Now next is significant influence. What is significant influence, sir? Simple, sir. If one enterprise has the right to participate in the financial and operating policy decisions of the enterprise, but not control of those policies. See, I don't have any power to control the policies of other enterprise, but I can participate in the financial and operating policy decisions. So whatever be the financial policies, whatever the operating policies of the enterprise is there, I can participate in the meeting and I can cast my vote. Okay, but this significant influence, how I am going to achieve, sir? There are so many ways significant influence can be achieved, sir. The control can be achieved by having more than 50% share or control of composition of board of directors, but are having a substantial interest. All those things, substantial interest and power to direct the financial and operating policies. But significant influence, they are saying that just you have the right to participate in the financial and operating policies. How can I achieve this? See, there are number of ways I can achieve this. One is by representation of the board of directors. Maybe we have the representation in the board of directors. For example, there is a bank, sir. Bank has given a loan to the company. Now, on behalf of bank, they have appointed one person as the board of directors. By representing the entire bank in the company, the board of directors is appointed by representation of board of directors. Then we can say we have significant influence because since on our behalf we have appointed a person who is representing us in the board of directors. And participation in the policy making process, if you have the right to participate in the policy making process of the company, then we say we have significant influence. And material intercompany transactions between the company, interchange of managerial persons, if two companies are exchanging their management personnel, interchanging, so then we say we have significant influence. Dependence on technical information, one company is depending upon the technical information provided by other entity, that can also be significant influence. See, significant influence can be achieved in several ways. These are some of the ways I have given, but the last one is most important, having 20% or more of voting power. Sir, you said 20% or more voting power is a substantial interest. See here, control of substantial interest means having 20% or more voting power directly or indirectly. And along with that, there is a power to direct the financial and operating policies. Then it will become a control. It is not just you have a substantial interest. Along with the substantial interest, you have the power to direct the financial and operating policies of the enterprise. Similarly, sir, here to achieve significant influence, sir, you should have 20% or more voting power. One of the ways to achieve significant influence is having 20% or more voting power, either directly or indirectly. So here it is presumed that the party has significant influence unless provide otherwise. Having less than 20% of the voting power of the enterprise, it is presumed that the investing party does not have significant influence unless provide otherwise. That means suppose in a company you have less than 20%. Generally, we assume that there is no significant influence. But sometimes, even if you have less than 20%, still you can exercise significant influence, because significant influence can be achieved in so many ways, not just through shares. So, to become related parties, one party must have the ability to control or exercise significant influence. Significant influence can be achieved in so many ways: by having representation in the board of directors, by ability to participate in the policy making process, maybe there are material intercompany transactions happening between the entities, maybe interchange of managerial persons, or maybe dependence on the technical information given by other company, or maybe having 20% or more of voting power. All these things I can achieve the significant influence. Okay, so I understood what is related party. Parties are said to be related, either I must have control or significant influence, right? Next, scope of the standard, sir. Para 3, important, sir. Sir, this standard is applicable only the following related party relationships, which is described in A to E below. So this standard is applicable only for these 5 types of related party relationships. So first of all, in the given question, you have to check whether the related party relationships is covered in paragraph 3 or not. If it is, then only the standard is applicable. So this standard deals only with the related party relationships described in A to E below. So what are the related party relationships? Very simple, sir. Parent company, subsidiary company, fellow subsidiary. This is the first one. Parent, subsidiary, fellow subsidiaries. Second, associates and joint ventures. Associates and joint ventures. See this. First one, sir. There is holding company, parent company. When I say there is a parent company, it is having subsidiary company. Parent, subsidiary. Both are related. Because here holding company is having what? Control. So one party has the ability to control the other party. So parent, subsidiary, both are related. Parent point of view, subsidiary related. Subsidiary point of view, both parent related. Both are related. So if I am seeing from the point of view of subsidiary, if this is the reporting entity, parent is the related party. If holding company is the reporting entity, subsidiary is the related party. So parties are said to be related if at any time during the period one party has the ability to control or significant influence. Now parent company has the control over subsidiary. Now both will become related to each other. Now from whose point of view you are seeing, that is important. If you are seeing from parent, subsidiary related, subsidiary, parent related. Now along with that, sir, one more thing, sir, fellow subsidiary is also related. Fellow subsidiary means, suppose for example, you are the subsidiary of parent company. Along with you, there is another company is also subsidiary of parent company. So that will become your fellow subsidiary. That will also be related party. For example, A Limited is the parent company, sir. It is having 2 subsidiaries, B Limited, C Limited. Now, from A Limited point of view, who are related parties? B, C. B Limited point of view, who are related parties? A, C also. In B Limited point of view, A is related party. In which capacity? Parent company. It is my parent company. And C Limited is also my related party. In which capacity? Fellow subsidiary. Fellow subsidiary. So C Limited point of view, who are related parties? A Limited is a related party because it is my parent company. And B Limited is also my related party. In which capacity? It is my fellow subsidiary. So therefore, accounting standard 18 says, so as per paragraph 3, the first related party relationship covered is parent, subsidiaries, fellow subsidiaries. They are all related to each other because the common thread connecting them is what? Control. Next, associates and joint ventures. The second type of related party relationships covered in paragraph 3 in AS 18 is associate, joint venture. Listen to me carefully. Sir, I am an associate company. When I said I am associate, I have what? Investing company or investing party. And when I said joint venture, I have venturer. Right? Suppose B Limited is the associate company. Of which company? A Limited. So the standard says, if you see from associate company point of view, its investing party is related party because there is a significant influence generally. And if you see from joint venture point of view, venturer is the related party. If you see from investing party point of view, associate company is the related party. If you see from venturer point of view, joint venture is related party. But here you need to understand, sir, co-associates are not related to each other. Like fellow subsidiaries, you cannot apply the same concept for co-associates. For example, there is A Limited, sir. Now, this A Limited got B Limited, C Limited, 2 companies as their associates. Associate company. So, B Limited is one associate company, C Limited is one associate company. Now, tell me who are related parties to A Limited. A Limited point of view, both B Limited, C Limited, both are related because They are my associates. They are covered in paragraph 3, related party relationships. Now think from B Limited point of view. B Limited point of view, who is related party? A Limited is a related party because it is my investing party. Can C Limited is also related party to B Limited? No. Co-associate cannot be considered as related party. And C Limited point of view is related A. Will B Limited will be related to C? No. Similarly, sir, suppose if I am a joint venture. So I have venturers. Suppose for example, generally in joint venture what happens is, suppose there are two entities, A Limited, B Limited. These two together started one joint venture, sir. Joint venture. So joint venture point of view, who are related? A and B, both are related because they are venturers. And now from joint venturers point of view, who is related party? Joint venture is related party. Joint venture point of view, venturers related. Venturer point of view, joint venture related. Whether these two venturers will be related parties? No. No. Co-associates not related party. Joint venturers, co-venturers are not related parties. Of course, both of them together they started a joint venture. Now, joint venture point of view, venturers are related. Venture point of view, joint venture is related. So, but not between the venturers, there is a relationship. So, this is the second one. Associates, joint ventures, investing party and venturers. Next, third category which is covered in paragraph 3 in AS 18. AS 18 is individuals with significant influence. Sir, any individual who is having control or significant influence in the company, that we will consider as a related party. Not only that, his relatives is also related parties. See this. Any individuals owning directly or indirectly an interest in the voting power of the enterprise that gives them control or significant influence over the enterprise and the relatives of such individual. Suppose for example, sir, there is a company A Limited. In this A Limited, Mr. X is having 60% shares. That means Mr. X is having what's their control. So that means we can say that A Limited point of view, Mr. X is what? Related party. Individual having significant influence or control. Suppose for example, Mr. Y is there. He is having 20% shares in A Limited. So unless provided otherwise, we can say there is a significant influence because he is having 20%. So A Limited point of view, Mr. Y is also related party. Covered in paragraph 3. That is accounting standard 18. This relationship is covered. Not only Mr. X or Mr. Y, sir. Any individual who is having control or interest, sir. Any person who is the relative of these individuals are also covered, sir. Important, sir. Relatives is also covered. Now who is relative as per accounting standard 18? See, in respect of an individual, sir, relative means spouse, son, daughter, brother, sister, father, mother, who may be expected to influence or be influenced by that individual in his or her dealings with the reporting enterprise. Suppose for example, Mr. X is there, Mr. X wife, Mr. X son, daughter, Mr. X brother, sister, Mr. X father and mother. These are relatives. Generally, these people, if they are influenced by this person, when they are doing transactions with the reporting enterprise, then we will consider them as relatives, right? And they will be considered as related parties as per accounting standard 18. Understand, sir? So, company point of view, any individual who is having control in that company is a related party. Having significant influence in that company is a related party. Not only him, his relative is also related party. Now, key management personnel, KMP. So, key management persons are always related parties. So, key management persons and also any relatives of such persons is also covered. Key management persons and relatives. Again, who is key management person, sir? The standard says key management persons means any person who has the authority and responsibility for planning, directing and controlling the activities of the enterprise. Any person who has the authority for planning, directing and controlling the activities of the enterprise. Maybe managing director, whole-time director, managers, or anyone who directs the decisions of the board of directors. So they can be considered as what? Key management persons. Now the key management persons and his relative is also considered as related party and covered in accounting standard 18. But here one clarification, sir. Non-executive director is not considered as key management persons unless he has the authority over the planning, directing, controlling the activities of the enterprise. Suppose even if non-executive director is involved in the financial and operating decisions, AS 18 does not treat them as related party unless they meet the criteria, that is to become a key management persons. So either they should be have the authority for and responsibility for planning, directing and controlling the activities of the enterprise. Generally these people, MD, whole time director, managers, so they can be considered as key management persons. So key management persons and their relatives are also covered as related parties. And the last one, sir, enterprises under influence. Sir, any enterprise in which the parties mentioned in C or D is exercising control or significant influence, that enterprise is also our related party, sir. So very, very interesting, sir. See, there is a company A Limited, sir. In this A Limited, Mr. X is the managing director. So managing director is key management persons. So therefore he is covered in D. In scope para 3, he covered in D, relationship D. I mean point D he covered. He is the MD, key management person. So he is a related party to the A Limited. He is related party. Now the standard says, sir, when Mr. X is the related party in the capacity of key management persons, now any company, if this key management person has control or significant influence, that is also a related party. Suppose there is a company B Limited, sir. In this B Limited, okay, Mr. X is having 60% shares. That means Mr. X is having control on the B Limited, sir. So the standard says, so any key management persons, okay, is a related party, and any enterprise in which he is having significant influence or control, now that one is also our related party. Therefore now A Limited point of view, B Limited is also related party. In which capacity? In the capacity of it is the entity in which our managing director got significant influence or control. So that means if you look at this paragraph 3 properly, sir, they have covered everything. So therefore, see this enterprise over which any party described in C or D is having significant influence. So this includes enterprise owned by our directors, major shareholders of the reporting enterprise, and the enterprises that have a member of key management persons in common with the reporting enterprise. So therefore, you remember all these 5 relationships. Once again, only these 5 relationships this standard will be applied, sir. One is parent, subsidiary, fellow subsidiary. Parent point of view, subsidiary related. Subsidiary point of view, parent, fellow subsidiaries are related. Common thread is control. Second, investing company, associate, both are related. Investing point of view, associate related. Associate point of view, investing related. Next, venturer, joint venture, both are related. So venturer point of view, joint venture point of view, venturers related. But remember guys, co-associates not related, co-venturers are not related. Fellow subsidiaries are related to each other because of the control aspect. Now next, third one is what? Individual. Any individual, directly or indirectly, if he is having control or significant influence in any company, then he is a related party. Not only him, not only the individual who is having control or significant influence, his relative is also covered. And the next one, key management person and their relatives. Key management persons means any person who has the authority, responsibility for planning, directing, controlling the operating activities like MD, whole time director, manager. All these persons are key management persons. So key management persons is related party, and not only key management persons and his relatives are also covered. And the last one, any enterprise in which the party is mentioned in C or D. That means the company, our major shareholders, our directors, our key management persons, if they are having any significant influence in any other enterprise, that any other enterprise will also be covered as related party. So this standard basically applies to these kind of related party relationships. Okay, this standard is applicable only these kind of related party relationships. Now sir, one interesting point, sir, exemptions from related party disclosures under AS 18, sir. Suppose, sir, the standard saying we need to disclose related party transactions, related party requirements, all these things we need to disclose. Suppose if the confidentiality is affected, like for some industries, sir, confidentiality is utmost important, sir. Like for example, banking companies. Banks must keep the customer transactions confidential. So AS 18 does not override this obligation. In the name of AS 18, I already told you, accounting standards cannot override the principles in the law. So if disclosure would violate the legal or regulatory confidentiality duty, it is not required. When there is a conflict between the law and standards, always follow the confidentiality and always follow the law. Okay. And also state controlled enterprise, sir. Related party disclosures are not required for transactions between the government owned enterprises. Sir, government will not disclose anything. Between the government enterprises, if any transactions are happening, sir, very confidential transactions. Government doesn't disclose all the information, how much equipment purchased, what kind of weapons we purchased, so how much worth of goods we sold, all these things will they disclose to the government. This is very confidential information relating to the security of our country. So this standard does not applicable to state controlled enterprises, that is government owned enterprises. Between them, whatever the transactions happen, they will not disclose, sir. And especially when you are preparing consolidated financial statements, sir, no disclosure is required for intergroup transactions in consolidated financial statements, because we know when we prepare the consolidated financial statements, any transactions between the parent and subsidiary, common transactions, we will eliminate, sir. So that's why no disclosure is needed for intergroup transactions. So if the confidentiality is affected, so no need to follow AS 18, because law prevails over the standard. And also if you are a state owned enterprise, no need to make any disclosures, because for them the confidentiality is very, very important, sir. Next, sir, the following are deemed not to be related parties. See, the standard has given certain lists, sir. Generally, these are not considered as related parties. Two companies are not related parties simply because they have a common director. Sir, simply because two companies are having one director who is common, you cannot say the parties are related parties. We need to see whether that director can influence both the companies' policies in their mutual dealings. If they have the ability to influence the policy decisions of both the companies in their mutual dealings, maybe the parties are said to be related. But simply because a director in common in both the companies without having control or significant influence, so he cannot be considered as, the companies cannot be considered as related parties. And also, sir, a company does not become a related party just because it depends economically on a major customer, supplier, or distributor. Sir, suppose we are doing majority of our sales to one particular customer, so that customer will become our related party? No, since because you are economically depends upon one single party, maybe a major customer, your supplier or your distributor. For example, you are purchasing 100% of your raw material from a supplier. Will that supplier become your related party? No. So to become a related party, there must be control or significant influence. So because you are economically depend upon one single party, we cannot say parties are said to be related. And also, sir, the following entities are not related parties because of their normal dealings with the company, like any lenders and financial providers. So company taking loans, any lenders and financial providers to the company, any trade unions, any public utilities like electricity, water suppliers, government bodies and agencies. Generally, these parties are not considered related parties. The following are deemed not to be related parties. Okay, so two companies not considered as related parties just because they have a common director, unless the director can influence the policies of both the companies. And simply because a company depends economically on any other customer, economically depends on a major customer, supplier, distributor, we cannot say they are related parties. And lenders and financial providers, trade unions, public utilities, government bodies and agencies, they are not considered as related party. Okay. Now finally, sir, disclosures. So what kind of disclosures we need to make in the financial statements in respect of related parties? That is the important thing, sir. Now disclosures, sir, important, sir. See, for the purpose of disclosures related to related party transactions, sir, this standard has divided into three categories, sir. So for the purpose disclosure related party transactions, for the purpose of disclosures relating to related party transactions, they have categorized into three categories. Okay, the related party disclosures. First one, sir, when the related party relationship is due to the control, concept of control, and there are no related party transactions during the year between the parties. See, first thing is what? There is a related party relationship. See, we need to make disclosures relating to related parties in the financial statements. Now, for the purpose of disclosure, this standard is divided into three categories. First category is what? There is a related party relationship because of control. There is a concept of control. Through control, there is a relationship between the parties, and there are no related party transactions during the period. Suppose there is a parent subsidiary relationship. Parent subsidiary relationship generally comes through control, but there are no transactions during the year between the parent and subsidiary. That is first category. Now in that case, what you need to disclose? Only two things. That is name of the related party, name, and nature of related party relationship. So that means there is a related party relationship because of control, and there are no related party transactions happened between the parties during the year. Then disclose two things: name, nature. Name of the related party, nature of the relationship. Second category, when there is a related party relationship because of significant influence and there are no related party transactions between the parties, then no disclosures are required. No disclosures are required. Sir, if the related party relationship is because of control and there are no transactions, at least we disclose the name and nature of relationship. But if the related party relationship is because of significant influence and there are no related party transactions, then even name and nature is also required, not required. No disclosures are required. So MCQ is possible. When the related party relationship is due to the concept of significant influence and there are no related party transactions. And the last one, sir, you can guess. There is a related party relationship either because of control or significant influence and there are related party transactions during the period. So there is a related party relationship because of control or significant influence aspect and there are related party transactions between the parties. And then the standard says you need to disclose the following information. So important, sir. What information we need to disclose? First, you need to disclose the name of the related party. Second, the description of the relationship. So first you disclose who are all related parties names. Second, description of the relationship. That means what is the nature of the relationship you had. Next, description of the nature of transactions. What kind of transactions you have done with them? Sale, purchase, loans taken, loans given, any kind of transactions. Next, the volume of transactions, either as an amount or as a percentage. What is the volume of transactions you have done with the other party? And any other element which is necessary for understanding the financial statements. And also what is the amount outstanding and provision for doubtful debts in respect of the transactions with the related parties. And also any amount written off or written back in respect of the debts due from the or to the related parties. Any amount we have written off or written back in respect of the amount due from the related parties or amount due to the related parties. So therefore, what are the disclosures we will make in respect of related party relationship is there because of control or significant influence and there are transactions between related parties. The following disclosures will be made. First, name of the related party, then description of the relationship, then description of the nature of transactions, then volume of the transactions either as a amount or as a percentage. Next, any other element which is necessary for understanding the financial statements, any amount outstanding and provision for doubtful debts, and any amount written off or written back in respect of the debts due from the related parties. You have to remember. So therefore, for the purpose of disclosure, the related party relationships are categorized into three. One is related party relationship is because of control and there are no transactions. Then you need to disclose the name of the related party, nature of relationship. And second, if the related party relationship is due to the significant influence and there are no related party transactions, no need to make any disclosures. And the last one, there are related party transactions. If there is a relationship because of control and significant influence and there are related party transactions, then you need to disclose the name of the related party, the nature of the relationship, describe the nature of relationship, description of the transactions you have done, volume either as an amount as a percentage, and any other element which is necessary for understanding the financial statements. What is the amount due from to the related parties? How much amount is written off or written back in respect of the amount due to or from the related parties? That's it. And sir, one more important thing, sir, related party transaction definition. Sir, what is related party transactions? The standard says related party transaction means transfer of resources or obligations between the related parties, regardless of whether or not price is charged. Whether price charged or not, that is considered as related party transaction. Suppose, for example, parent company has provided services to the subsidiary freely. That is also related party transaction. It is not that related party transaction always will be charged. Okay. Now, in this chapter, sir, I will tell you the important questions, sir. We'll see once. Very easy questions are there, sir. Yeah. You see this question? There is a company P Limited, sir. And in this company, Mr. Robert is the MD, Managing Director. So, is he covered? Yes. Para 3, he is covered. Related party related. So, key management persons. So, he is a related party. Now, in the P Limited, Mrs. Andy, the spouse of Mr. Robert, that means key management personnel, his spouse is relative. He is also covered in para 3, scope of the standard. And company is paying a remuneration of 5 lakhs to her. Okay, received remuneration 5 lakhs. See this. 1st April 2001, sir, year beginning, year end 31st March 2011, 31st March 2012, year beginning 1st April 2011. Now, Mrs. Andy left on 1st July 2011. See this. So that means she provided services from 1st April to 30th June. April, May, June. 3 months she provided the services. Now, the question is whether Andy is to be identified as a related party at the year end for the purpose of AS 18. Yes, I mean, Mrs. Andy, will she be considered as a related party? Tell me. Tell me. What is the related party definition? Parties are said to be related if at any time during the reporting period. Any time during the reporting period. Any time. That means she is there in the company from 1st April to 30th June. Na? That means any time during the period. So, when Mr. Robert is the key management personnel, she is the wife of Mr. Robert. So, she is also covered in paragraph 3. So, she is also related party. Anytime during there, she is in the company from 1st April to 30th June. Therefore, on 31st March 2012, she will be considered as related party. First thing. Second, most important thing. Sir, what kind of disclosures we need to make in respect of Mrs. Andy? The company has done transactions with her from 1st April to 30th June. Na? And between this period, company paid 5 lakhs remuneration. This is the related party transaction we need to disclose. Sir, suppose after 30th June, she left the company, right? After she left the company, if company has done any transactions with her, not in the capacity of Mrs. Andy, suppose for example, she divorced or she become an independent person. Now company has done some transactions with her. Now understand, once the related party relationship ceases, after that any transactions done with the party, that is not covered under accounting standard 18. So therefore parties are said to be related if at any time during the reporting period, even for one day the relationship is there, she will be considered as related party, or he or she will be considered as related party for the purpose of this standard. Okay, I will show you one more question, most important. See this. X sold goods to associate company during the first quarter ending 30th June 2011. After that, the related party relationship ceased to exist. Sir, X Limited sold goods to an associate company, sir. Associate investing company, both are related. And we sold goods till 30th June. After that, related party relationship ceased. That means it is no more relationship. However, goods were supplied as were supplied to any other ordinary customer we supplied. Decide whether transactions of the entire year have to be disclosed. I told you. See, to identify the related party relationships, at any time during the reporting period, you need to see. But in order to report the related party transactions, only till the period the relationship exists, we need to consider. Therefore, in this case, there is a related party relationship in the first quarter. That is sufficient to say at the end, this associate company is our related party. But will you disclose transactions you have done with the associate company for the entire year? Oh, no. Only till the relationship exists, that is till 30th June, whatever the transactions you have done, that will be disclosed as related party transactions. See this. As per AS 18, transactions of X Limited with associate company for the first quarter ending 30th June only are required to be disclosed as related party transactions. The transactions for the period in which the related party relationship did not exist should not be reported. So therefore, the final conclusion is to identify the related party relationship anytime during the reporting period is sufficient. Second thing, but in order to disclose the related party transaction, only the transactions done till the related party relationship exists, that will be considered. Okay. And also, sir, see this question also very good question. Illustration number 9. See, there is a company P Limited, sir. In this company has 22% shares and voting rights in Q Limited. That means investing associate, both are related. Goods sold on 1st April 2011 amounting to 5 lakhs. Okay. Now the year is April to March. 1st April 2011 to 31st March 2012. Now we sold goods at the beginning for 5 lakhs. Now on 30th June, sir, in this company we had 22%, sir. Entire 22% sold, sir. That means it is no more related party to us after 30th June. But after 30th June also we made some sales like a normal customer. Now whether the transactions determine whether the transaction for the entire year is required to be disclosed. Understand. Suppose P Limited point of view, if you think at the end of the year 31st March 2012. First of all, tell me P Limited point of view, whether Q Limited will be related party or not. The answer is yes. Why? Parties are said to be related if at any time during the reporting period. That means from 1st April to 30th June, it is our related party. Na? So any time during the year is sufficient to establish the relationship. So it is our related party. First thing. Second thing is, we need to disclose related party transactions. Suppose, to what extent we will disclose? Only when the relationship is exist. First quarter, that is April to June, 5 lakhs. Only this will be disclosed. Now, once related party relationship ceases, na sir, after that, whatever transactions you done, that will be like a normal customer, that we will not consider as related party transaction. So don't disclose it. Okay. So in this case, no, this is because as per AS 18, the disclosure requirements under standard relate only to the period during which related party exists. Accordingly, only transactions between P and Q till 30th June are required to be reported or disclosed. The transactions entered after 30th June not required to be disclosed. Remaining questions are all very, very simple questions, sir. You see them once. Okay, important questions I have explained. The next accounting standard we are going to revise is Accounting Standard 29, sir. Accounting Standard 29 predominantly focuses on the following areas: provisions, contingent liabilities, and contingent assets. These are the major areas of focus of this standard. Apart from these areas, there are some small areas also which we are going to cover in this standard. Now, first things first, what is the main objective or scope of Accounting Standard 29? See, this standard will provide you the guidance relating to the recognition, measurement, disclosure of provisions, contingent assets, contingent liabilities. Relating to provisions, contingent liabilities, and contingent assets, what will be the provisions for recognition, measurement, and disclosure? Predominantly, this standard will addresses these things. Next, we are going to focus first on one of the major aspects of this standard, that is the concept of provision. Of course, we will come back to the scope of the standard later. First, try to understand the concept of provision. Sir, what is provision first of all? See, this standard defined provision as a liability that can only be measured using significant degree of estimation or substantial degree of estimation. Liability with a substantial degree of estimation will become provision. So here they are saying basically provision is liability. So if you create any provision on assets of the company, that is not provision as per AS 29. So that's why when you are preparing the financial statements of the company, whatever the provision you created on the assets, we will show by way of deduction from that particular asset, like provision for depreciation, provision for doubtful debts. Only provision relating to liabilities, provision of liability, we will show in the balance sheet liability side, like either short-term provisions or long-term provisions. So provision, basically liability, and this liability we will measure only by significant degree of estimation. Now the question arises, what is liability, sir? Very, very important, sir, the definition of liability, because if you understand this definition of liability properly, you will understand the contingent liability concept also. So contingent liability is nothing but if any liability is missing the characteristics of the definition of the liability, basically we call it as a contingent liability. So let us try to understand what is liability. See, liability means a present obligation. The standard says it's a present obligation of the enterprise from the past events. So from the past events, there is an obligation for us, and that obligation is presented at the year end. Not only that, now the settlement of which is expected to lead to an outflow of economic benefits. Now I need to settle that obligation. In order to settle that obligation, we are expecting outflow of economic benefits. Some cash resources will go out of the organization. So present obligation from the past events should be there, and at the same time, to settle this obligation, we are expecting outflow of resources. If both the conditions are satisfied, then we say it is liability. Sir, an organization has done many things in the past. Not all the past events or transactions done by the company creates an obligation. Only those events which creates obligations, those are called obligating events. See, there are certain events, certain transactions, certain contracts which is entered by the organization which now they are creating obligation for the organization. That is called obligating event. Now the obligation, whatever created by the obligating event, an organization has no realistic alternative except to settle it. Now the organization has to fulfill this obligation, has to settle this obligation. There is no way to skip this obligation. So what is obligating event? An event that creates an obligation, leaving the enterprise with no realistic alternative to settling it. So to become a liability at the end of the year, you need to see whether there is an obligation presented or not. The obligation is there, but it is not presented on the balance sheet. It is not liability. To become a liability, there must be present obligation. And that too, these present obligation came from past event. Which past event? Obligating event. For example, sir, company sold goods with warranty of 1 year. Now you tell me, the sale of goods with warranty is a event, past event. Is it an obligating event? Yes, which creates an obligation for the enterprise. What is the obligation? Within that 1 year warranty period, company has to incur replacement cost, repairs cost. Company has to incur some cost for the repairs and replacement of the products we sold. That means the past event, that is sale of goods with warranty, has created an obligation. So it becomes an obligating event. Now this obligation organization has to fulfill. There is no realistic alternative to settling it. That means organization must honor it. Okay. So there is a past event. The past event as obligating event created an obligation. Now that obligation must be present obligation. See, coming to obligations here, there are two possibilities. One is present obligation, another one is possible obligation. What is present obligation? The standard says an obligation is present if based on evidence available. If based on the evidence available, its existence at the balance sheet date is considered probable, more likely than not. If based on the evidence available, if the existence of the obligation is considered more probable, more likely, chances that the obligation is there on the balance sheet date, we say it is present obligation. For example, there is a case pending in the court. Now, if you lose the case, we need to pay damages to the other party. Now we asked the lawyer. Lawyer said 80% chance that we are going to lose the case. That means based on the evidence available, the existence of the obligation is probable, more likely. Suppose the lawyer said 30% chance that we are going to lose the case. That means 70% we are going to win. So based on the evidence available, the existence of the obligation is not probable. Therefore, it is a possible obligation. So guys, understand, there is some event happened in the past that has created an obligation, so that becomes an obligating event. Now that obligation, if based on the evidence available on the balance sheet date, if it is probable, then it becomes a present obligation. Now present obligation which requires settlement, which involves outflow of economic benefits, will become a liability. So therefore, to become a provision, it must be liability. To become liability, there must be present obligation and there is probable outflow of resources to settle this obligation. Sir, there is a present obligation, sir, but we are not expecting any outflow of resources to settle it. Then it is not a liability. So if it is not a liability, no question of provision will arise. So understand the linking, okay? So obligating event, present obligation, possible obligation, provision, liability. So these are the 5 definitions which is very, very important. Now, sir, after making the discussion of these definitions, ultimately what you need to remember is the criteria for recognition of provision. AS 29 has given 3 conditions to recognize a provision. So if they ask a question relating to provision, sir, mostly they will ask, so whether in this case provision will be recognized or not. Like that they will ask one question. A provision will be recognized only if 3 conditions are satisfied. Actually, these 3 conditions are just derived from the definitions only. So just now we discussed now what is provision. Provision is a liability with a significant degree of estimation. What is liability? Liability is a present obligation arising from past events and it requires the settlement of which involves outflow of resources. Now, based on these definitions, they have given 3 conditions. Look at the first condition. There should be present obligation. The liability, to become a liability, first condition is what? Present obligation from the past event. So whenever I want to create a provision, first of all, I will make sure that the present case, it becomes a liability. To become a liability, first of all, I should ensure that there is a past event is giving an obligation for me, and that obligation is presented on the balance sheet date. For example, if company sold goods on warranty basis at the end of the year, so there is a past event, that is sale of goods with warranty, that has created an obligation. Company has to incur replacement repairs cost, and that is presented on the balance sheet date. Because the moment you sell the goods, warranty will apply from day one. So based on the past experience, maybe out of the sales we made, some percentage of the goods will be subject to repairs or replacement. So there is a present obligation. And then to settle this obligation, there must be probable outflow of resources. Probable means more likely. It is probable that resources outflow will be needed to settle the obligation. So we have present obligation, and at the same time, to settle this obligation, we are expecting outflow of resources. So that is the second condition. Third condition, reliable estimation of the amount of obligation. You should be able to measure the obligation reliably. So all the three conditions are satisfied, we create a provision. So if any of these conditions are not satisfied, no provision should be recognized. So guys, please remember, to recognize the provision, there must be present obligation from the past event, and it is probable that resources will be outflow to settle this obligation. Third, reliable estimation of the amount of obligation is also required. Because see, wherever you see in the asset recognition, liability recognition, the standards also, every time when you want to recognize any asset or liability, they say reliable estimation. So reliable estimation should be there. Sir, here you said provision is liability with a substantial degree of estimation. So how can estimation be reliable? See, the intention of the standard is even estimation also you should done scientifically. It is not that some vague amount you will say this is my provision. It is not allowed. So reliable estimation can be made of the amount of obligation. Okay, so these three conditions to be satisfied to recognize a provision. So first one, present obligation, sir. Second one, past event. Present obligation created from past event, right? Now relating to past events, sir, some important points are there. See this, provision for past events. Sir, provisions are recognized for obligations created from past events only. That too, that those obligations that exist independently of the future actions, like penalties, decommissioning cost, etc. So any penalty you need to pay for violation of law, irrespective of your future course of action, definitely when you have violated the law, when you have done some damages, you need to pay, you need to incur some cost now. So therefore the standard says provision is created for present obligation created from past event, and that should exist independently of your future actions. Suppose if I can avoid something, this obligation I can avoid through future actions, then I am not required to create a provision. Next, no provision for future expenditure. Sir, tell me, present obligation coming from past event, I will require to create a provision. Can I create a provision for the future expenditure? Suppose next year company is planning to purchase 50 computers. For that, is it allowed to create a provision current year? If that is the case, na sir, no company will have profits. Every company will have only reasonable profits whenever they want to pay less tax. So what they will do is they will book the future expenditure as a provision for the current year, and lot of expenditure they will book. Obviously, our profits will come down. So therefore, the standard says no. For future expenditure, we are not allowing any provision, because this is not an obligation created from the past event. The definition says provision is liability. Liability is a present obligation arising from past event. Here no provision is made for future expenditure because that can be avoided by future actions. And sir, obligating event due to new loss. This is important point, sir. Suppose, sir, previously there was no law. Suppose we have contaminated the environment. Now there is no law requiring us to clean up the environment. Previously we have done the damage. Now later on the government has brought a new law. Now the new law has created an obligation for us. So then company has to create a provision. So previously it is not an obligating event, but because of the change in law, new law, now it has become an obligating event for us. So those things will happen. If an event can become an obligating event if new law requiring rectification of the past damage, even if no obligation existed at that time. Okay, we need to create a provision. But you need to understand that the new law must be virtually certain. then only we need to say that the new law is coming. Because of that, there is a obligation for us. There is the previously there is no obligation, but now the obligation came. Therefore, we need to create a provision. I think relating to this, one question is also there, sir. Very important. I will show you. See this problem number 7, sir. See, there is an oil company has been contaminating the land for several years. It does not clean up because there is no legislation requiring cleaning up. At 31st March 2011, it is virtually certain that law requiring cleaning up of land already contaminated will be enacted shortly after the year end. Is provisioning presently necessary? Sir, this company is contaminating the land over several years, sir. Now, it does not require cleanup because there is no legislation requiring cleaning up. But on 31st March 2011, it is virtually certain that a new law is coming which requires us to clean up the land already contaminated. Now, previously you have done contamination, but is there any obligation? No, it is not an obligating event. This is not creating any obligation because no cleaning up is required. But the new law is coming which making this past event as an obligating event. Now, the obligating event is what? An event which creates an obligation now. So, what is the obligation now? I need to incur some cleanup cost. The contamination we have done already. Therefore, there is a present obligation from the past event, probable outflow of resources to settle this obligation, and reliable estimation of obligation. Therefore, provision is required. So, previously an event may not be an obligating event, but because of the new law, it may become an obligating event for you. So, you need to create a provision in this case. See, when environmental damage is caused, there may be no obligation. The causing of the damage will become an obligating event when a new law requires the existing damage to be rectified. So this is obligating event now. So in the given case, it is virtually certain that the law will be enacted requiring cleaning up of the land already contaminated. Therefore, an oil company has to provide such cleaning up cost in the year in which the law is virtually certain to be enacted. Okay. So that's it. That is past event. Next, probable outflow of resources embodying economic benefits. So to settle this obligation, we are expecting probable outflow of resources. Some cost will be incurred. And then reliable estimation of the obligation. We need to able to measure the obligation reliably. So three conditions relating to provisions. So present obligation from the past event. Second, probable outflow of resources to settle the obligation. Third one, reliable estimation of the obligation. If these three conditions are there, we have to recognize the provisions. Otherwise, we will not allow to recognize the provision. Next, sir, in this standard, the next major area is contingent liability. Sir, what is contingent liability? See this. Sir, this standard has expressed the contingent liability in two ways. Or if I can put it very simply, sir, the word contingent has been added before liability. That means basically it is not a liability. It is not satisfying the definition of liability. Now, just now we have seen to become liability, two conditions are required. There is a present obligation from the past event. Second, the settlement of which involves outflow of resources. Suppose if any one of them is missing, contingent liability. That is what they have expressed. So, what is contingent liability? Possible obligation from the past event, and which is confirmed only by future uncertain events which are not fully within the control of enterprise. So contingent liability is a possible obligation from the past event which is confirmed only by the future uncertain events which is not fully within the control of enterprise. Suppose there is a case pending in the court. The lawyer said 50-50%. That means 50% we may win, 50% we may lose. Suppose if you lose the case, you need to pay the damages. If you win the case, no need to pay damages. Right now, based on the evidence available, its existence is not probable, not more likely, 50-50. Therefore, it becomes what? Possible obligation. The moment if you say it is a possible obligation, it is contingent liability. And this is now right now possible, but which is confirmed only by future uncertain events, which is not wholly within the enterprise control. The court judgment is in your favor, sir. Future event, uncertain future event, which is not in your favor. Next, sometimes, sir, what is contingent liability is It is a present obligation. There is a present obligation, but we will not recognize this as a provision because there is no probable outflow of resources to settle it, or reliable estimation is not made. That means to become a provision, three conditions are there, na sir. Out of these three conditions, if any one of the condition is missing, then it will become a contingent liability. So I told you to become a provision, three conditions. Present obligation from past events, it is missing, contingent liability. Probable outflow of resources to settle the obligation is missing, it is contingent liability. Reliable estimation of the obligation is missing, contingent liability. So that's why contingent liability is defined in two ways: possible obligation, present obligation arising from the past event, but probable outflow of resources to settle the obligation is not there, or reliable estimation of the obligation is missing. Any one is missing. Any one is missing. Then it called as what? Contingent liability. For example, sir, see this example number 1, sir. Suppose the company may have to pay damages to the other party. So it's called possible obligation, which arises from past events. A customer sued the company due to defective product sold last year. So we sold defective product to the customer last year, sir. Now because of that, customer filed a case against us claiming damages. So past event, but it is possible obligation. Why it is possible obligation? The matter is pending in the courts and confirmed by uncertain future events. When we are going to confirm about the exact situation, the company will know the liability only when the court makes the judgment, and which is not within the control of enterprise. The court decision is not in the company's hand. So if losing is possible but not probable, it is contingent liability and should be disclosed. If based on the evidence available, if existence of the obligation is probable, then it becomes liability. Then you thought of creating a provision. But if the losing is possible but not yet probable, not more likely, because 50-50% chances are there, then it becomes a contingent liability. Suppose, sir, the company may have to pay extra tax. The tax authorities issued a notice based on the past tax filing. So we filed a return of income. Government department has sent a notice to pay the extra amount of tax. So this is what possible obligation, and which is confirmed by uncertain future event. What is that? The tax tribunal will decide whether the tax needs to be paid or not, which is not in my control. The judgment is not in my control. So therefore, if payment is uncertain, disclose it as a contingent liability. Okay. Or else, sometimes what happens, I told you, contingent liability can be, there is a present obligation, but there is no probable outflow of resources to settle it. We are not expecting probable outflow of resources. See this. Either contingent liability can be defined as possible obligation and from the past events. The moment you see the obligation is possible, it is contingent liability, sir. Second, there is a present obligation. Obligation is there, but there is no probability that there will be outflow of resources to settle it. So the best example is, suppose, see this. The company has signed a contract to guarantee supplier's loan. Suppose supplier is taking a loan, sir. Now the company has signed a contract to guarantee supplier's loan. The moment company has given a guarantee, there is a present obligation arises because of the contract. And this is arises from past event. The guarantee was provided in the past when the supplier took the loan, but not probable outflow. See, there is a present obligation, but there is no probable outflow of resources, because as long as the supplier is financially stable and likely to repay the loan, I am not thinking about the payment. So therefore, even though there is a present obligation, there is no probable outflow of resources to settle the obligation. So since there is no probability of outflow, it remains as contingent liability. Okay. So therefore understand the contingent liability is there is a present obligation, but I am not expecting there is an outflow of resources for me to settle this obligation as of now. Like, I will give you one more example, sir. Suppose the parent company has given a guarantee for the loan taken by subsidiary company. Now, subsidiary company is taking a loan from the bank and parent company has given a guarantee. The moment the parent company has signed the guarantee papers or guarantee, it becomes a present obligation. But the question is whether this requires outflow of resources as of now. No, probable outflow of resources is not there. We are not required to pay the loan. As long as our subsidiary company is financially stable, making the payment, we are not liable. So therefore, it will become a contingent liability. Or sometimes, sir, reliable estimation cannot be made. For example, sir, the company might have to pay fine for violating pollution norms. Suppose we have violated the environmental laws. So government has sent a notice. The pollution occurred last year and authorities are investigating. Investigation is going on. No reliable estimation. The amount of fine is unclear because an investigation is going on. Now in this case, there is a present obligation because already you have contaminated the environment. So obligation is there. And you need to pay the amount also. There is probable outflow of resources. But the point is, how much amount you are unclear, therefore no need to create a provision. Since the fine amount cannot be reliably estimated, it is a contingent liability disclosed in the financial statements. So understand the difference between the liability, contingent liability. So the difference is liability is a present obligation, but contingent liability is a possible obligation. Liability is a present obligation with probable outflow of resources, but contingent liability may be present obligation, but there is no probable outflow of resources. And to create a provision, reliable estimation is required, but reliable estimation I am unable to make. Even though there is a present obligation, but I can't say how much amount I need to pay to the other party. So that will become a contingent liability. Okay. So, sir, okay. If any liability is a contingent liability, what organization need to do? See, the standard says generally contingent liabilities we will not show on the face of the financial statements. Contingent liabilities are not part of balance sheet, but the information relating to contingent liabilities we will disclose in the notes to accounts. That too, if the probability of outflow of resources is not remote. See, many of the students are under the impression that contingent liabilities generally will be disclosed in the notes to accounts, which is not correct, sir. If you read accounting standard 29 properly, it says contingent liabilities will be disclosed in the notes to accounts only if the possibility of outflow of resources is not remote. If there are remote chances that there is a possibility of outflow of resources because of this contingent liability, then even disclosure in notes to accounts is also not required. Okay. See this, a contingent liability should not be recognized in the financial statement, but it should be disclosed unless the possibility of outflow of resources is remote. Remote means rare. If there are very rare chances that this contingent liability will become a liability and after that there will be outflow of resources to settle it. So if the organization felt there are very less rare chances, then they can ignore them even in the notes to accounts also. Okay. This is about contingent liability. Now come to contingent assets, sir. Sir, what is contingent asset? See, like contingent liabilities, contingent assets are not expressed in two ways. Because in the liability definition, there are two conditions. So that's why in contingent liabilities, they have defined in two ways that if any one of the condition is missing, it becomes a contingent liability. That's why they said contingent liability is a possible obligation. Contingent liability is a present obligation, but there is no probable outflow of resources or reliable estimation cannot be made. But when it comes to contingent asset, they're saying that it is a possible asset. It is not a present asset. It is a possible asset. And obviously this is creating from the past event and which is confirmed only by the uncertain future events, which is not in my control. Similar to contingent liability. Possible obligation, which may be confirmed by my future actions. So, I mean, it is confirmed by the future events, which is not in my control. Similarly, contingent assets or possible assets, they are confirmed only by the future uncertain events, not fully in the enterprise control. Okay. Like for example, a company warehouse was damaged in fire accident, sir, and it has filed an insurance claim. The insurance company might reject the claim, making the company responsible for the losses. If the insurance company accepts the claim, the company will not bear any liability. So the decision rests with the insurer, which is not in the company's control. So if the insurance rejection is possible but not probable, disclose it as a contingent liability. Oh, thinking about contingent liability. Okay. Come to contingent assets, sir. Yeah. Pending insurance claim for fire loss. Suppose the company might receive insurance compensation. It's a possible asset. Why? Because the company's warehouse was damaged in a fire last month. Now, if my warehouse is damaged in the fire in the last month, sir, I have an insurance. I claimed the amount. Whether the insurance company will give the claim or not, that's a confirmed by uncertain future events. The claim will be settled only if the insurer approves it. And it is not in my control. The decision rests with the insurance company. So if the claim approval is probable but uncertain, it is contingent asset. If the insurer confirms the payment, recognize it as a asset. Suppose the company had filed a lawsuit for patent infringement last year. So there was infringement of my patent. I filed a case against the person who infringed my patent and for 10 crores. If I win the case, I am going to receive 10 crores. So it's a possible asset arising from the past event and which is confirmed by uncertain future events. That is, the compensation depends on the court decision, not wholly within the control of the enterprise. That is not in my control. Okay. So if the case has a strong chances of success, disclose it as a contingent asset. If the ruling in the company's favor, recognize the asset. So therefore, in case of contingent assets, sir, understand it is a possible asset from the past event and which is confirmed only by the future uncertain events which are not wholly within my control. Sir, what to do with the contingent liability, sir? Contingent asset. What is the accounting treatment for contingent asset? Contingent liabilities at least will be disclosed in the notes to accounts, sir, but contingent assets will not be disclosed in notes to accounts also. Contingent assets will be disclosed in the notes to accounts. Simple. So contingent assets are not disclosed in the financial statements, but may be disclosed in the report of the approving authority. That is board of directors report. Understand, guys? Important. Okay. So provision, contingent asset, contingent liability. Provision generally will be recognized subject to 3 conditions: present obligation from the past event, probable outflow of resources, reliable estimation. Any one missing, no provision will be recognized. Next, contingent liability. Contingent liability is either possible obligation, present obligation, but no probable outflow of resources, or reliable estimation is missing. Or contingent asset means possible asset, which is confirmed by future events, which is not in the control of the enterprise. That's it. And contingent liabilities will be disclosed in the notes to accounts if the possibility of outflow of resources is not remote. If it is remote, rare chances that there is a possibility of outflow of resources, you cannot disclose in the notes to accounts also, not required. Contingent assets may not be disclosed in the notes to accounts. It may be disclosed in the board of directors reports. So these are the major areas of accounting standard 29, sir. Sir, along with these areas, sir, there are some other concepts also there in this standard, sir. Yeah. See this, as I told you, there are small areas which we are going to cover in this standard. One is future operating losses. Another one is restructuring provision. Another one is reimbursement. Now let us discuss these concepts. First, sir, future operating losses and restructuring provision. Suppose, sir, as an enterprise, sir, you are expecting there will be losses in the future years. Okay. Future operating losses. Sir, suppose an enterprise is expecting that there will be losses in the next year. Can an organization is allowed to create a provision for future operating losses? The answer is no, because whatever the losses we are expecting for the coming years, it is not satisfying the definition of liability. So liability means what? Present obligation from the past event. So these are the future expected losses. So they are not satisfying the definition of liability. So the question of creating provision for the future losses is not allowed. Okay. Suppose a company expects to make 5 crores loss next year due to increased cost. Since there is no present obligation, no provision can be made. The loss will be recognized in the future financial statements when incurred. So this is the first thing. Next, restructuring concept. Important concept, sir. Listen to me carefully. What is this restructuring concept? Actually, this standard has defined restructure. I have given it in the definitions part. Restructuring is nothing but a program which is prepared by the management. See this restructuring. What is restructuring? Restructuring is a program planned by management that ultimately will change the scope of the business or the manner in which the business is conducted. So restructuring is basically what? A program which is conducted by the management, planned by the management, which will ultimately change the scope or the manner in which the business is conducted. Either it will change the scope or the manner in which the business is conducted. And in the standard itself, sir, they have given some examples relating to restructuring. Like for example, sale or termination of a business line. If any company wants to sell any of its existing business or terminate any of its existing business line, that is restructuring. Because ultimately, because of that, the scope will change, or maybe an organization will close or relocation of business locations. Maybe they will shift their operations from one business location to another location, and they will close some of their business locations. Or maybe change in management structure. Company will bring changes in the management structure, eliminating one layer of management. See, every company has their own way of doing things. So it is the management structure which allows the companies to function properly. Now suppose top management, middle level management, lower level management. Now we want to eliminate entire middle level management. So eliminating layers of management is also restructuring. Next, fundamental reorganization. Any fundamental reorganization which will have major changes affecting the nature and focus of our operations. So these are all examples of restructuring. Sir, okay, what is the relevance of this? Simple, sir. Sir, whenever a company wants to do restructuring, whenever they have planned any restructuring program, because of the restructuring, whatever the cost company is going to incur, whether a provision can be created for that restructuring cost. The answer is yes. A company can create a provision for restructuring cost provided the recognition criteria for provision is satisfied. Present obligation from the past event, probable outflow of resources, reliable estimation. Now here restructuring program is a past event which creates a present obligation. Now if company wants to do any one of these things, definitely it will create an obligation for the organization. Now what kind of cost I will include as a part of provision for restructuring? That is the important thing here. So a provision for restructuring cost is recognized only when the recognition criteria for provisions are met. Okay. So, sir, important, sir. Sir, generally, what kind of cost we are going to incur when a company announces restructuring? Simple, sir. I will tell you. Suppose, sir, look at this example. There is a company ABC Limited, sir, which decided to restructure its operations by shutting down its manufacturing plant and shifted to new location. So they have one manufacturing plant, sir. They want to close it and they want to shift to new location. So can you tell me, is it a restructuring first of all? Yes. Just now I told you restructuring is what? Restructuring involves even closing of the business, shifting to new location is also restructuring. Okay. Now they are expecting the restructuring cost is 50 lakhs. So what are the cost? Some first one, employee severance payment 20 lakhs. Tell me, sir, generally when you close down any of your existing operations, you might sever some of the employees, you might lay off some of the employees of the organization, right? So for them we need to pay some compensation. So company expected to pay 20 lakhs. Next, lease termination penalty. Suppose we have taken the lease for 10 years. Since we are closing the business, we terminate the lease early. So when you terminate any contract early, you might need to pay penalties to the other party. Now in this case, 10 lakhs we need to pay to the other party. And next, dismantling the factory machinery. Suppose in this case, we are shutting down the manufacturing plant. So whatever the machinery installed, we need to dismantle. For that, some cost will be incurred. So 5 lakhs. And also retraining the employees for the new roles. See, since we are shifting to new location, in that location, new location, who will handle what? The employees, the company will want to give retraining to the employees for the new roles. So for that, 7 lakhs they are going to incur. And then marketing cost for the new location. So we have shifted to business to new location, right? So to do the marketing of that, advertising of that, we might incur some cost 5 lakhs. And also company wants to invest in new information systems, IT systems, 3 lakhs. So like this 50 lakhs cost they are incurring because of this restructuring plan. What is this restructuring plan here? Shutting down its manufacturing plan and shifting to new location. AS 29 says if company announced a restructuring and company can create a provision for restructuring cost provided recognition criteria is met. There is a present obligation from the past event. Yes, the company announced restructuring, so there is a present obligation. Now, is this obligation involves outflow of resources? Yes, company has to incur 50 lakhs. Third, reliable estimation. Yes, company can able to estimate reliably. Therefore, all the three conditions are satisfied. Company can recognize a provision. But the question is, sir, you said, and I mean, then the question they said, entire restructuring cost is 50 lakhs. Can entire 50 lakhs is allowed for provision? The answer is no. The standard says, when you consider the cost for restructuring for provision purpose, only the cost which is directly related to restructuring you need to take. If any cost, if it is relating to the ongoing activities of the business, if it is relating to the future conduct of the business, please don't consider it as a part of restructuring cost. So that means, see here, direct restructuring cost. Restructuring provision should include only the direct cost necessary for the restructuring, not ongoing activities. And the standard exclusively said, see this, some of the cost will be excluded from restructuring cost. That is, cost not included in restructuring provision is retraining or relocating the staff. Sir, any retraining given to the staff, relocating of the staff from one place to another place, whatever the cost you are going to incur now, that will not be part of restructuring provision. Similarly, marketing cost, we will not include it as a part of restructuring cost. And also investment in new systems. If company started investing in new systems, that cost is also not included in the restructuring cost. Because the intention of the standard is these are relating to the future conduct of the business. Investment in new systems, marketing cost, retraining of the staff. See, these are necessary for future conduct of the business. They are not present obligations. They are necessary for future conduct of the business. That's why they will not be included as a part of restructuring cost. That's why you see, when you are creating a provision in this case, sir, first three, since they are unavoidable cost due to restructuring, they are necessary for restructuring, so they are the direct cost. So therefore this 35 we will include as a restructuring provision. What about these three costs, like for example retraining the employees, marketing cost, investment in new IT system? The standard says these costs should be excluded because they are relating to the future business expenditure, future business operations. They are not relating to the past obligations. Sir, you are going to purchase new IT system, that means it's a future action, sir. So how can you say it is a present obligation from the past event? No. So similarly, marketing cost, it's a future business operations, so we will not include it. Retraining of the employees for the new roles, this is also future conduct of the business necessary. Therefore, when you are creating a provision for restructuring, make sure that only direct cost relating to restructuring will be considered, and any cost you are going to incur for the future conduct of the business, like retraining of the employees, relocation of the employees, marketing cost for the new location, investment in new IT systems, please don't include it. So here provision to be created 35 lakhs and expenses not to be included in provision is 15 lakhs. So these are the concepts relating to future operating losses, restructuring provision. For future operating losses, you are not allowed to create a provision. Next, one more concept, sir, the concept of reimbursement. Very important concept, sir. This is also, what is this reimbursement concept, sir? Reimbursement means when any third party gives or shares some of our expenditure, we call it as reimbursement. For example, there is a company A Limited. A Limited has some contractual obligations. To fulfill that obligation, company has to incur some expenses. Now, out of these expenses, if part of the expense is reimbursed by third party, either because of the insurance contract or contract of indemnity or warranty, that is called reimbursement. Suppose, for example, sir, I am B Limited, sir. I am selling goods to customers by giving warranty, and the same goods I am purchasing from A Limited. So A Limited is the original supplier, sir. I am an agent and I am selling goods to my customers. So when I give warranty to my customers, sir, they will approach me for the repairs and replacement, and for that some cost I need to incur. And when the customer came for me with for repairs and replacement, I will approach the original supplier, sir, because these goods are belongs to original supplier, na, sir. So original supplier is giving guarantee to me. Therefore, whatever the contractual obligation B Limited had towards the customers, out of that amount, certain portion is going to be reimbursed by original supplier. This is called reimbursement. Now the standard says, in case of reimbursement, there are two situations, sir. Important, listen to me. First situation is, there is no obligation for the entity for that part of expenditure which is going to be reimbursed by third party. So as an organization, we are no way connected or no obligation for us relating to that part of the expenditure which is going to be reimbursed by third party. Suppose 100 lakhs is the amount we need to pay under the contractual obligation. But out of 100 lakhs, 40 lakhs is going to be paid by insurance company or warranty. Under the contract of warranty may be paid by the original supplier. And we are not bothered about this 40 lakhs. So we don't have any obligation for that part of the expenditure which is going to be reimbursed by third party. Then in such a situation, no provision is required. No provision is required for this 40 lakhs. You create a provision only for the part you are legally you have a obligation. But if you have no obligation for that part of the expenditure which is going to be reimbursed by the third party, ignore it. But if there is an obligation for the entity in respect of that part of the expenditure which is going to be reimbursed by the third party, now see, you are fully responsible towards your customers to fulfill the contractual obligations, and of course some of the amount may be reimbursed by the third party, but you are responsible. Now in this case, customer will come and ask B Limited, not A Limited. That means B Limited is fully responsible towards the customer, but B Limited knows that whatever the amount they are going to pay to the customers, whatever the cost they are going to incur to fulfill the obligations, some part of it is going to be reimbursed by A Limited. Now that is the second case. So originally the obligation is on me only, but I know certain expenditure of my contractual obligations is going to be paid by the third party, reimbursed by third party. In that situation, the standard says there are two possibilities. If the reimbursable amount, recovery of reimbursable amount is virtually certain, if you feel the third party is going to give the amount, the recovery from the third party is virtually certain, 100% pakka we are going to receive, then standard says recognize a provision, recognize the reimbursable amount as an asset. Recognize the provision as well as recognize the reimbursable amount. Whatever the reimbursable amount coming from the third party, recognize this as an asset. Suppose if the recovery of the reimbursable amount is not virtually certain, then recognize a provision, don't recognize the reimbursable amount. Recognize the provision, don't recognize the reimbursable amount, sir. Okay. So important, sir. Actually, this one, very good concept. Yeah. For example, see this, sir. Insurance reimbursement for product recall. Suppose there is a company, sir, which recalls 1000 defective products. Say this. The company sold defective products, so now they identified and they recalled. And company has to incur 50 lakhs for this repairs. Recall. Recall cost is 50 lakhs. Because we need to recall the defective products and we need to supply the original products, or maybe these defective products will be rectified and will be given. So for that, we are expecting 50 lakhs. Okay. So that means company has the obligation, fully responsible. Now the company has a product called insurance. Luckily we have an insurance for product recall, and which covers 80% of the cost. That means out of this 40 lakhs is going to be given by whom? Insurance company. Now in this case, tell me, who is responsible fully for the 50 lakhs? Company only. So company is responsible even for that part of the expenditure which is going to be reimbursed by insurance company. Suppose insurance company not paid this 40, so we have to incur 50 lakhs now. That means we are fully responsible towards our customers. But we know out of this 40 lakhs is going to be reimbursed by the insurance company. Therefore, in this case, what I told you, if there is a reimbursable amount and you are fully responsible, you create a provision for 50 lakhs, and also this reimbursable amount, if it is virtually certain, then you create reimbursable amount as an asset. So therefore, in this case, company has to create a provision for 50 lakhs and reimbursable amount 40 lakhs we need to recognize. Okay. So this company recognize a provision for 50 lakhs and also they need to recognize reimbursement asset for 40 lakhs. So in this case, what entries we will write is, see here. First, this is the entry for recall expenditure. Recall expenditure account debtor to provision for recall. 50-50. This provision, this 50 lakhs is the recall expenditure debited to P&L account, and we created a provision. Next, reimbursable amount account debit 40 lakhs because it is an asset for us. Asset, reimbursable amount which is going to be received from the insurance company will be debited for 40 lakhs. Against this 40 lakhs, this expenditure of recall will be adjusted. And when we incur the recall expenditure, provision to bank, and when we receive the reimbursable amount, bank to reimbursable amount. So very simple, sir. First you write the recall expenditure. So recall expenditure to provision for recall. Then when you whatever the reimbursable amount is there, create an asset. Against this asset, these expenses will be adjusted, and then you incur the cost, and then you receive the reimbursement amount. So tell me guys, what is the concept of reimbursement? So any of your obligation is shared by some other party, that is called reimbursement. In reimbursement, there are two situations. One is no obligation for that part of the expenditure which is going to be reimbursed by third party. Then no provision, no disclosure. And I am responsible for the full obligation, and I know some of the obligation amount is going to be reimbursed by third party. Then in such situation, if the recovery is virtually certain, I will recognize both provision as well as reimbursable amount as an asset. If the recovery is not virtually certain, then recognize provision only, don't recognize the reimbursable amount. Okay. And sir, these are the small concepts, sir. And I told you scope of the standard, sir. Scope. In scope also, one important point is there. Scope of accounting standard 29. Basically, sir, this standard does not apply to financial instruments which is carried at fair value. And also, second point important, sir, any contingent liability from executory contracts unless the contract is onerous in nature. That means as long as the contracts are executory in nature, the standard is not applicable. But if the contract is onerous, the standard is applicable. Sir, what is this executory contracts, onerous contracts? Simple. Sir, executory contract means a contract in which either both parties have obligations that are yet to be performed, or neither party has fully delivered their part of agreement. Either both the parties fail to fulfill their obligations, or both the parties equally performed their obligations. That is called executory contract. Now generally, if the contract is executory contract, what happens is neither parties has fulfilled their obligations, or neither parties or both the parties have fulfilled their obligations only to a certain extent. Then these kind of in these cases, there is no party can enforce the other party legally. Therefore, it cannot be generally recognized in the books. Like for example, a company rental agreement. A company signs a 1-year lease agreement for office space, sir, agreeing to pay 5 lakhs per month. Now the landlord has not yet provided the office space and the company has not paid the rent. See, you entered a contract agreeing that you will pay 5 lakhs per month, but they have not given the office space for rent. The space is not available, so you have not paid the rent. That means both the parties still have obligations, so it's an executory contract. So if the contract is executory, no entry is required until the rental payments begin. So the standard says if the contracts are executory, the standard is not applicable. Suppose if it becomes onerous, then the standard is applicable. When we say the contract is onerous, see, simple. When the benefits to receive fulfilling the contract, when the cost to fulfill the obligation is more than the benefits what I am going to receive, not fulfilling. See, what are the cost I am going to suffer if I not fulfill the contract is more than the benefits I am going to receive if I fulfill the contract. Like for example, see this, a company agrees to supply raw materials to a customer for 50 lakhs. But due to rise in materials, the cost of fulfilling the contract increases to 60 lakhs. Now company will incur 10 lakhs loss, making this as an onerous contract. Now you can recognize a provision for the unavoidable loss of 10 lakhs because the contract is onerous in nature. So when the contract is onerous in nature, you can allow to create a provision for the future cost or future loss. Okay. And also any contingent liabilities from contracts with policy holders in insurance enterprises, and anything which is covered specifically in any other accounting standard like 7, 9, 15, 19, 22, this standard is not applicable, sir. And sir, the most commonly asking the question from this chapter is this one, sir. Creation of provision amount, this one. So scenario based question 8, sir. They will ask you to create a provision. So very simple. If the warranty period is less than 1 year, 2% provision, more than 1 year, 3%. So you need to create a provision at 31st March 2011 as well as 31st March 2012. So from 31st March 2011, still you have to see for this sale how many days are left. If it is less than 1 year, apply 2% provision. If it is more than 1 year, 3% provision. Like that you calculate the closing provision. So 31st March 2011, provision you need to calculate, 31st March 2012 provision you need to calculate. And the difference between the opening and closing provision is nothing but what? The provision created during the year. So they are also asking you compute how much amount is debited to P&L account. So in this case, sir, on 31st March 2011, 2400, sir. 31st March 2012, 4850, sir. That means opening provision 2400, closing 5850. So the difference is 2450, which is debited to P&L account. I think this is the most important question they're asking, sir. And this airlines question is also there. Suppose there is an airline company which is required to overhaul its aircraft once in 5 years. Now, according to the law, it is compulsory for this airlines company that they need to overhaul its aircraft once in every 5 years. So will you require to create a provision? The answer is no, because there is no present obligation. So suppose I am at the end of the first year, I know I have to do the overhauling at the end of the 5th year. So as of now, there is no present obligation. So no need to create provision. And one more thing, sir. I told you the past event which created the present obligation, which exists independent of the future actions, only provision will be created. But in this case, on aircraft, so maybe I can sell the aircraft before expiry of the 5 years. So therefore, I can able to avoid this obligation. So therefore, as of now, there is no present obligation. Okay. And remaining questions and all very simple questions only. And in this question, sir, there is a probability that we are going to win the case. See, this case has been filed against the company in the customer court, and the notice for levy of penalty 20 lakhs has been received. The company has appointed a lawyer to defend the case for a fees of 2 lakhs. 50% of the fees has been paid in advance, 50% will be paid after finalization of the case. 75% chances that penalty may not be levied. That means 75% chances that we are going to win. So therefore, there is no present obligation relating to this 20 lakhs. Okay, because based on the evidence available, we are going to win 75% chance. Only 25% chances is there. Therefore, existence of the obligation on the date of balance sheet date is not probable. But relating to lawyer fees, already we paid 50. Remaining 50 we need to pay after the case, irrespective of the result of the case. Therefore, provision is required to be created. So that's it, sir. And relating to reimbursement also, one question is there. Same questions repeated. So that's it. This is accounting standard 29, sir. This is the major crux of accounting standard 29. So very few questions are there in the study material. Kindly solve it after listening this. Okay. The next accounting standard we are going to revise is accounting standard 11, sir. Accounting standard 11 deals with the effects of changes in foreign exchange rates. So whenever there were changes in foreign exchange rates, the effect of those changes, how we are going to tackle, that is what this standard addresses, sir. See, being an Indian enterprise, Indian enterprise may enter a transaction in foreign currency, or an Indian enterprise may have operations outside India, or an Indian enterprise may enter a foreign currency forward contract. Now in all these cases, sir, the transactions were entered in foreign currency. But being an enterprise, being an Indian enterprise, reporting must be done in Indian rupees. So rupees is our reporting currency, because an Indian company. So the company which belongs to India, generally we will report in Indian rupees, but the transaction was done in foreign currency, like for example American dollars. So the first thing is we need to convert this into Indian rupees. These foreign currency items must be translated into Indian rupees. We must convert it. How we are going to convert the foreign currency items into Indian rupees? By using an exchange rate. So which exchange rate I need to utilize? And these exchange rates will keep on fluctuate. They will not be the same. So how I am going to tackle the changes in exchange rates? They are affecting my financial items which is arising from foreign currency transactions. Now how I am going to tackle these changes in exchange rates? So that is also addressed by this standard, sir. And when it comes to the scope of the standard, sir, the standard actually addresses three things. One is foreign currency transactions. Second, translating the financial statements of foreign operations into Indian rupees. Third, forward exchange contracts. These are the major areas dealt by accounting standard 11. Foreign currency transactions first. Second, financial statements of foreign operations. Third, forward exchange contracts. So if we discuss all three, the standard is over. And in the scope of AS11, sir, there are some exclusions. 4 exclusions are there. See, this standard does not specify the currency in which financial statements must be prepared. Of course, if an Indian company, generally we will prepare financial statements in INR. Generally, suppose if I am an US company, I will prepare in American dollars. So because our investors, our users of financial statements belongs to which country, generally to which country we belong, now companies will prepare their financial statements based on that currency. But AS11 does not specify the currency in which financial statements are to be prepared. But being an Indian company, we will use INR. And you can prepare financial statements in any currency other than INR also, being an Indian company. But you need to specify the reasons why you are doing that. For example, there is an Indian company which is a subsidiary of US company. And then for the users of for the investors or for the users of financial statements who are there in USA, maybe this Indian company which is a subsidiary of US company can prepare financial statements in American dollars. So that is allowed. So it is not that the companies which are situated in India always have to report in Indian rupees. That is not the case. So this standard does not specify the currency in which enterprise presents its financial statements. Usually the currency of the country where the company is based is used. By different currency may be used, the reason must be disclosed. Indian companies generally will report in INR. Suppose if you are an Indian company, you are the subsidiary of US company, maybe you report in US dollars. So for the investors, for your original investors. So this is the first thing. This standard does not specify the currency in which financial statements has to be prepared. Second thing, sir, cash flow statement. See, for cash flow statement, we have a separate standard AS3. So therefore, when you are preparing the cash flow statement, sir, the cash flows from foreign currency transactions, the inflows or outflows, so they are dealt by AS3. So don't apply AS11. And also, sir, any exchange differences arising from foreign currency borrowings to the extent they are recorded as adjustment to interest cost. So A16, if you look at the A16, sir, borrowing cost definition, I clearly explained. This was excluded from the scope of AS11 because it is exclusively covered in AS16. So when you take any foreign currency borrowings, on those borrowings, if there is any exchange differences arises, to the extent they are recorded as adjustment to interest cost, we will treat it as borrowing cost as per A16. Right? The difference between the interest on foreign currency loan, the same loan if it is taken in India, what is the interest in India? The difference is treated as adjustment to interest cost, and out of the exchange difference arises, so that portion we will treat it as borrowing cost, remaining we will transfer to P&L account as per AS11. I explained in AS16. So this was excluded from the scope of AS11, sir. One more thing, sir, this standard cannot be applied for restatement of financial statements from reporting currency to any other currency. For example, I want to convert my financial statements from rupees to American dollars. So can I apply this standard? Suppose rupees is my reporting currency, but I want to prepare financial statements in dollars. So can I apply AS11? The answer is no. It is applicable from other currencies to reporting currency, not from reporting currency to another currencies. This standard cannot be applied. So restatement of enterprise financial statements from its reporting currency to another currency. So this standard does not applicable. So 4 exceptions are there for accounting standard 11. So this standard does not specify the currency in which financial statements are to be prepared. But of course, you can prepare financial statements other than INR also, being an Indian company, but we must specify the reasons why you are doing that. Second one is this standard is not applicable for cash flows arising from foreign currency transactions when you are preparing cash flow statement, because we have a separate standard. And the standard does not, any exchange difference arising from foreign currency borrowings to the extent they are recorded as adjustment cost, this will be treated as borrowing cost as per AS16. So this will not be applied. And also, sir, restatement of financial statements from reporting currency to another currency, the standard is not applicable. Now, first let us discuss, as I told you, the standard deals with 3 areas. First one is foreign currency transactions. Now, suppose if an Indian enterprise has entered a foreign currency transactions, what will be the accounting treatment? First of all, understand what is foreign currency transaction. Foreign currency transaction means a transaction which is denominated or which requires settlement in foreign currency. Either the transaction must be denominated, expressed in foreign currency, or which requires a settlement in foreign currency, that is called foreign currency transaction. Including any transactions where an enterprise entered either for which involves buying or selling of the goods, in foreign currency, or maybe borrowing on lending of the funds in foreign currency, maybe involving a transaction entering into forward exchange contracts, or maybe purchasing assets, selling assets, acquiring, incurring liabilities in foreign currency. So the common thing is that you entered these transactions in foreign currency. So what is foreign currency transaction? The transaction must be denominated or require settlement in foreign currency. Now, when it comes to the accounting for foreign currency transactions, sir, there are 4 stages. First one is initial recognition. First time when you enter the foreign currency transaction, how initial recognition will be done. Next is subsequent measurement, that is valuation on balance sheet date. And then any contingent liabilities are there because of the foreign currency, contingent liabilities in foreign currency, how we are going to tackle them, and whatever the exchange differences arises in the foreign currency, what is the accounting treatment. Now first let us see the initial recognition. Sir, whenever an Indian company has entered any transaction in foreign currency, initially that will be converted into Indian rupees by using the exchange rate on the date of transaction. Or alternatively, we can use the average rate of a week or a month, provided there are no significant fluctuations in the exchange rate. So foreign currency transactions are initially recognized by applying the exchange rate on the date of transaction. Alternatively, an average rate of a week or a month can also be used if there are no significant fluctuations in the exchange rate. For example, if an Indian company is entering so many transactions in a week or in a month, so many foreign currency transactions are entered, sir. So alternative option is also given, because converting them into daily basis may be difficult. That's why we are giving you an option. So whatever the exchange rate is there for that week or a month, you can use it. So average rate of a week or a month can be used, provided there should not be any significant fluctuations. Suppose if there are significant fluctuations in the exchange rates, then we cannot follow this average rate of a week or a month. Okay, next. So we entered the foreign currency transaction. These transactions are initially recognized by using the exchange rate on the date of transaction. For example, a company sold goods $1 lakh to Mr. X in USA. Now, the transaction happened on January 1st, 2025. Okay, and now we need to convert into Indian rupees. We will see the exchange rate on the date of transaction. Suppose the exchange rate on the date is equal to $1 is equal to suppose 70 rupees. So by using this exchange rate on the date of transaction, convert into Indian rupees. So $1 lakh into 70. So 70 lakhs will be the sale amount we will record on the date of transaction. Now, okay. Next is subsequent measurement, sir. Sir, when you enter a foreign currency transaction, because of the foreign currency transaction, any asset or liability may arise, na sir, if those assets and liabilities are continued till the balance sheet date. Now, how we are going to value them? Important, sir. Listen to me carefully. When we enter a foreign currency transaction, initially we recognized by using the exchange rate on the date of transaction. Now, because of this foreign currency transaction, either an asset may come or a liability may come. And if these assets and liabilities are continued till the balance sheet date, now you are closing the books of accounts on balance sheet date. So the standard says, sir, for the purpose of valuation on the balance sheet date, the assets and liabilities arising from foreign currency transactions are divided into 2 categories: monetary items, non-monetary items. So when you enter any foreign currency transaction, now because of the foreign currency transaction, some items will arise. Now those items can be an asset or liability. Now they have to be valued at the balance sheet date. So right, for that purpose, standard has divided these items into 2 categories: monetary, non-monetary items. Listen to me carefully. Sir, what is monetary item? The monetary items are money held, cash in hand, cash at bank, those things. Monetary items are money held. Not only that, any asset to be received in fixed or determinable amounts of money, any liability to be paid in fixed or determinable amounts of money, any asset, first you take an asset, any asset to be received in fixed or determinable amounts of money, you can able to determine the amount of money you are going to get. So any asset to be received in fixed money is a monetary item, monetary asset, monetary item. Any asset to be received in determinable amounts of money is a monetary item. Similarly, any liability to be paid in fixed or determinable amounts of money is called monetary items. So for example, trade receivables. Debtors is what? Monetary item, because debtors is an asset to be received in fixed or determinable amounts of money. Investment in debentures, debt securities, investment in bonds. So if I make investment in bonds there, so it is an asset to be received in fixed or determinable amounts of money. So investment in bonds or debentures is what? Monetary item. For example, investment in equity shares, is it a monetary item? So investment in equity shares is an asset to be received in fixed or determinable amounts of money. No, because when you invest in equity shares, your principal is in danger. Maybe investment in equity shares may not be monetary item, because to become a monetary item, that must be an asset which is received in fixed or determinable amounts of money. Fixed money, or I can able to determine the amount of money. So if it is not fixed or determinable amounts of money, then it is not a monetary item. Okay. Similarly, take liabilities. Liabilities to be paid in fixed or determinable amounts of money, like creditors. And now one more thing, sir. Closing stock. Can you tell me what is closing stock? Asset. Is this asset is going to be realized in terms of fixed or determinable amounts of money? The answer is no. Sir, when you sell closing stock, you are going to get the money. But see, they are telling what is monetary as monetary item. Simple. By nature, that item must be receivable or payable in terms of fixed or determinable amounts of money only. For example, we received advance from customers. Advance from customers is what item? Non-monetary item. Why? Because if I receive the money, again I need to give what? Goods. So advance received from customer is an asset received in fixed or determinable amounts of money. Suppose for example, I have given a advance to my supplier. Now against that advance, he will give what? Goods. So therefore, that is a advance given to supplier might be my asset. It is received in terms of goods, not in terms of money. Therefore, that is not a monetary item. Similarly, any advance received from the customer is a liability. The liability to be paid in terms of money, no, in terms of goods. So therefore, it is a non-monetary item. So what is monetary? What is non-monetary, sir? Monetary is any asset to be received in terms of money. Any liability to be paid in terms of money is called monetary items. So can you give me examples of some non-monetary items? All fixed assets are non-monetary items generally. Like for example, land and buildings, plant and machinery, furniture and fittings. These are all what? Non-monetary items. Why they are non-monetary? Because suppose building. Is building is an asset to be received in fixed or determinable amounts of money? No, by nature it is not realizable in terms of money. Right? So therefore, building, all kinds of fixed assets, they are not monetary items. So monetary items, non-monetary items. So the standard says for the purpose of valuation on balance sheet date, whatever the items arising from foreign currency transactions, so they will be classified into monetary, non-monetary items. Now the standard says all monetary items arising from foreign currency transactions will be restated at their closing rate. Closing rate means rate at the exchange rate on the balance sheet date. All non-monetary items, you need to see whether they are originally valued at cost or fair market value. If they are originally, that item is valued at cost, then no need to do any revaluation. So actual rate which you used originally for converting into Indian rupees, that rate will be continued, right? Suppose if that item is carried at fair market value, then closing rate we will use. So that means initially one exchange rate we have used. Now at the end, if it is a closing rate, we are using closing rate. So there is a difference between the rate which you have used initially and the rate at the end. The difference is called exchange difference, that will be transferred to P&L account. Similarly, non-monetary items. If it is a non-monetary item, again you need to see whether these non-monetary items originally carried at cost or at fair market value. For example, closing stock is there. Closing stock is what? Non-monetary item. Why? Monetary item means amount receivable in terms of money, fixed or determinable amount of money. Closing stock is not an asset to be received in terms of money. Sir, when I sell, it is going to realize. Sir, not sell, sir. By nature, that asset must be realized in terms of money, like debtors, investment in debentures, like that. Okay. So if it is a non-monetary item, if it is carried at cost, we will use actual rate. No remeasurement will be done. Okay, if it is carried at fair market value like inventory, so inventories are valued at cost or fair market value, whichever is lower, cost or NRV, so you use closing rate. Now if the closing rate is unrealistic or remittance restrictions exist, the monetary item should be reported at the amount likely to be realized or required to settle at the balance sheet date. Okay, now whatever the exchange difference arises, that will be transferred to P&L account. What is the exchange difference arises here, sir? The exchange difference is initially you entered one rate, now at the balance sheet date you are using closing rate now, sir. So there is a difference. That difference will be charged to P&L account as an exchange gain or loss. And what about contingent liability? If there is any contingent liability in foreign currency, so convert them into Indian rupees by using the closing exchange rate. By using the closing exchange rate. So say this, classify the following items into monetary, non-monetary. Inventory, which item? Non-monetary. Trade receivables, monetary. Investment in equity shares, monetary or non-monetary? Non-monetary. Why? Why can't it is monetary? Monetary means amount receivable, asset. Investment is an asset to be received in terms of money, fixed or determinable amounts of money. When you invest in equity shares, are you expecting fixed amount of money? No. Therefore, it's non-monetary. Property, plant, equipment, non-monetary. Okay. Now see this. Suppose goods purchased on January 1st, 2011 at 75, sir. Exchange rate at the end 31st March 2011 74, sir. Actual date of payment 7/7/2011 73, sir. You are required to ascertain the gain or loss to be recognized for the financial year ending 31st March 2011 31st March 2012 as per AS 11. Very simple, sir. Sir, you purchased goods in foreign currency. That means you entered a foreign currency transaction. So initially we will record it rate using the exchange rate on the date of balance on the date of transaction. So therefore initially we might record it $15,000 into 75 rupees, right? So initially we will record at 11 lakhs 25,000. Okay, now at the end of the year, see, tell me, because of this transaction which item arises, sir? Creditors arises, correct? Creditors. Creditors is which item? Monetary item. If it is a monetary item, closing rate we need to use for balance sheet date purpose. So balance sheet date, what is the rate? 74. So by using 74, we need to restate this item. So 15,000 into 74 now. It becomes 74. So 74. So 15,000 into 74, sir. So 11 lakhs 10,000, sir. That means, sir, initially you recognized the creditors at 11 lakh 25,000. Now at the end, the rate has become 74. Now you need to revise the creditors to 11 lakh 10,000. That means creditors decreased by how much, sir? What is the exchange difference, sir? 11 lakh 25 minus 11 lakh 10. 15,000 exchange difference. Is it exchange gain or loss, sir? I think it is gain, sir. Why gain, sir? Creditors means liability decreased, sir. So it's a gain. So this gain will be credited to P&L account, sir. Now year end over, sir. Next transaction actually settled on 7th July 2011, sir, at 73. That means ultimately from your pocket, how much amount will go out? I need to pay $15,000, sir. For each dollar, I need to pay 73 rupees, Indian rupees. So 73 into 15,000. So 10 lakhs 95,000 will be the ultimate outflow. But my creditors already on the balance sheet date, I have brought them to 11 lakh 10,000. So again, there is a exchange gain. That is 74 has become 73. So 1 rupee exchange gain, sir. So 15,000 into 1. So 15,000 is again on this transaction. There is an exchange difference of 15,000, which is nothing but gain, which is transferred to P&L account. So this is how the foreign currency transactions will be accounted. Initially, we will record by using the exchange rate on the date of transaction. Next, because of this foreign currency transaction, whatever the items arises, classify them into monetary, non-monetary. If they are monetary, use the closing rate. If they are non-monetary in rate, if they are carried at cost, original rate. Yes. If they are carried at fair market value, closing rate. And if any difference arises, that will be transferred to P&L account. Initially 75, at the end 74. So 1 rupee exchange difference. Next 74 has become 73. Another 1 rupee exchange difference, $15,000. So 15,000 exchange difference at the end of the first year, 15,000 exchange dollars at the time of settlement. So total 30,000, sir. So by 31st March 2011, 15,000 will be credited to P&L account. On next year, another 50,000 will be transferred to P&L account. So this is how the foreign currency transactions will be accounted, sir. Very simple. Now next, sir, there is one special option available to the companies, which is amendment to para 46A. Sir, what is this? See, government has given a special option to the companies, which is alternative to transferring to P&L account. Generally, whatever the exchange differences arises, we will transfer into P&L account. But imagine, sir, if I am a company, I am doing so much foreign currency transactions, so many foreign currency transactions, or I have done big amount in the foreign currency transaction I have done, and if there are huge fluctuations in my foreign exchange transactions, what happens, sir? They will directly impact my P&L account. So because of that, my P&L account, either profits will come down, or if there is an abnormal increase in my profits. So maybe that is not the ideal scenario, because this exchange gain or loss, sometimes it is an unrealized gains or unrealized losses. Because of that, my financial statements are got impacted much. So therefore, these companies started requesting the government. So government has come up with the one amendment to para 46A, sir. The main object of this amendment is alternative to the P&L account. So when you enter any foreign currency transaction, and because of this foreign currency transaction, if there are any long-term foreign currency monetary items, now instead of transferring to P&L account, the exchange differences, we will have an alternative. That alternative is nothing but special option available. What is this? Say this. Irrevocable. And once this option exercised, it is irrevocable, sir. It cannot be cancelled back. So para 46A of AS11, introduced in December 2011, allows enterprise to follow this treatment for the period starting from 1st April 2011 onwards. Once exercised, this option is irrevocable and must be applied consistently to all such items. And now important. So this option is available only in case of long-term foreign currency monetary items. What is that? Long-term foreign currency monetary item. Sir, what is this long-term foreign currency monetary items? Long-term foreign currency monetary items means any asset or liability arising from foreign currency transactions which has a term of 12 months or more from the date of origination. That means that asset, that liability should have the term of 12 months or more from the date of origination. Then only this is considered as long-term foreign currency monetary item. If there is a long-term foreign currency monetary item, then you can take this option. But once you exercise this option, that's it. You cannot go back. It's an irrevocable option. But this option is applicable for which asset and liability? An asset and liability arising from, it is designated as foreign currency long-term foreign currency monetary item. So this long-term foreign currency monetary item, if it is has a term of how much? 12 months or more from the date of origination. Now listen to me carefully. This option says, suppose you entered a foreign currency transaction. Because of the foreign currency transaction, and there is a asset or liability. That asset or liability has a life of 12 months or more. So it's a long-term foreign currency monetary item. If the exchange difference relating to long-term foreign currency monetary item, if it is directly related to acquisition of depreciable asset, directly related to what? Acquisition of depreciable asset, then whatever the exchange difference arising on this long-term foreign currency monetary item, instead of transferring to P&L account, adjust to the cost of the asset. And accordingly, whatever the revised carrying amount of the asset is there, that will be depreciated. Okay. In any other case, that means if this long-term foreign currency monetary items does not relate to acquisition of depreciable asset, then whatever the exchange difference arises now, instead of transferring to P&L account, they are telling that transfer to an account called FCMITD account. FCMITD account means foreign currency monetary item translation difference account. Amortize this balance over the period of this life of this asset. So whatever the debit or credit balance in FCMITD account, which will be shown under the head reserves and surplus as a separate item. So, sir, the intention of the standard is very simple, sir. Suppose when you take any foreign currency loan, sir, that loan you use it for purchase of depreciable fixed assets, sir. On this loan, whatever the exchange difference arises now, sir, generally these exchange differences we will transfer to P&L account. But once you exercise this option, this says this exchange difference which is arising on the foreign currency loan, if it is directly related to the acquisition of depreciable fixed asset, you adjust this exchange difference to this asset itself. No need to transfer to P&L account. One thing. Second thing is, if this exchange difference arising from long-term foreign currency monetary, they are not directly related to depreciable asset. For example, you have taken a foreign currency loan. that loan you are using for business purpose, you are not acquiring any depreciable fixed asset. Therefore, whatever the exchange difference arising from the loan, that will be transferred to an account called FCMITD account. See this, exchange difference on long-term foreign currency monetary item, if it is related to acquisition of depreciable asset, add or deduct from the cost of the asset and depreciate over the balance life of the asset. If it is relating to others, then transfer to FCMITD account and amortize over the balance period of such long-term item. Okay, I will show you one question, sir. Now in this case, you see, suppose illustration number 9, sir. There is a company A Limited, sir. They have borrowed $10,000 in foreign currency on 1st April 2011 at 5% interest, sir. And by using that, they have acquired a depreciable asset. That means foreign currency loan, which is directly related to acquisition of depreciable asset. Loan generally means long term only, no sir. So therefore, long term foreign currency monetary item. Exchange rates given, sir. In the beginning $1.48, at the end $1.51. You are required to pass the journal entries in the following cases. Option under para 46A not availed. Option not allowed means what, sir? Whatever the exchange difference arises, that will be transferred to P&L account. Second, option under para 46A availed. When option availed, what we need to do, sir? The exchange difference we will adjust to the cost of the asset, because in this case, this foreign currency loan, which is directly related to acquisition of depreciable asset, then in such a situation, whatever the exchange difference arising from foreign currency loan, if it is directly related to acquisition of depreciable asset, that exchange difference we will adjust to the cost of the asset. Third, if the loan was taken to finance the operations of the entity and not to procure depreciable asset. Now that means if the loan taken from foreign currency is not directly related to acquisition of depreciable asset, in other cases, whatever the exchange difference arises, that will be transferred to FCMITD account. And if you don't avail 46A, P&L account. So in all cases, assume interest accrued on 31st March is paid on the same date. Now see, sir, in this case, suppose first bit, if I solve, option under para 46A not availed, then what you do, tell me? $10,000 loan I have taken, it is 48 rupees, right? So initially my loan amount is 10,000 into 48, 4,80,000. I will recognize the loan in Indian rupees. Now at the end, $1 has become 51. $1 has become what? 51. Therefore 10,000 into 51, that means 5,10,000 is my loan amount. That means my loan amount has increased by how much? 30,000. This is what? Exchange difference. Nothing but 3 rupees. 3 rupees into $10,000. So 30,000 is what? Exchange difference. So what you do? This 30,000 you will transfer to P&L account. If you don't avail the option. Suppose if you avail the option, this 30,000, what you do? You adjust to the cost of the asset. You adjust to the cost of the asset. Okay. So suppose for example, you see, if you don't avail the option, what entries will write? First, when you take the loan, what is the entry? Bank account debtor to loan account. 4,80,000, 4,80,000. And at the end, whatever the difference arises, 30,30. So to that extent, you need to increase the asset value, right? Sorry, you need to increase the loan amount. So therefore, foreign exchange difference to loan, 30,30. And interest on this $10,000, 5% at the end, 51 rupees. So interest to bank. So this is when option not availed, whatever the exchange difference arises, again we will transfer this to P&L account. Suppose if option under para 46A is availed, then what you do? Same, when you take the loan, bank to loan account. Interest cost also same. Next, exchange difference arises on the loan. So foreign exchange difference to foreign loan account, 30,30. And this exchange difference, instead of transferring to P&L account, what I will do? I will debit to P&L account. See this, 30,30. This is when I avail the option. So when I avail the option, instead of transferring to P&L account, I will adjust to the cost of the asset. Suppose for example, third bit, sir. Third bit means I am not purchasing the asset in any other case. So in any other case, whatever the exchange difference arises, sir, that will be transferred to FCMITD account. See this. This foreign exchange difference I transfer to FCMITD account. This FCMITD account will be written off over the period of the item. Okay, that's it. So I think you understand special option under para 46A. So this special option is applicable when once you exercise, it will be available to you. You cannot come back. And once you exercise this option, according to this option, any long-term foreign currency monetary item, understand only long-term, any asset and liability arising from foreign currency transaction which has a term of 12 months or more, First of all, that long-term foreign currency monetary item should be there. And from this long-term foreign currency monetary item, whatever the exchange differences arises, if you are using this, if it is directly related to depreciable fixed asset, you adjust the exchange difference to asset. If it is not directly related, then you can transfer to FCMITDA account. Okay. Next, foreign operations. Next concept. Sir, suppose if you have an Indian, you are an Indian company, you have foreign operations. Foreign operations means maybe you have a branch, a subsidiary, joint venture, anything. Now, accounting standard 11 says, sir, when you have any foreign operations, at the end of the day, you need to convert them into Indian rupees. Na? The financial statements of foreign operations must be converted into Indian rupees because we need to prepare financial statements for the overall entity. For that, I need to consider the branch results also. Suppose I am parent company, I need to prepare the consolidated financial statements. So for that, I need to consider the subsidiary company, associate company, joint venture, all these things I need to consider now. So therefore, the financial statements in the foreign country, foreign operations, financial statements, I must convert into Indian rupees. Now the standard has divided the foreign operations for the purpose of conversion into two types: integral foreign operations, non-integral foreign operations. So for the purpose of conversion of foreign operations into Indian rupees, they will be converted into two: integral, non-integral. What is integral foreign operations? In simple, I can say, sir, integral foreign operations are nothing but dependent branches, dependent on the reporting enterprise, depending upon the head office, nothing but. That means they are just the extension of the reporting enterprise, just the extension of the head office. They completely depend upon the head office. Their policies will be decided by head office. Their money is arranged by head office. So the finance is arranged by head office. They don't take any policy decisions. They just act as a representatives of head office. That is integral foreign operations. What is non-integral foreign operations? Non-integral foreign operations is kind of an independent branches. That means they will arrange their own money. So they make their own sales. They do less transactions with the reporting enterprise. So they make their own sales. They will arrange their money through local borrowings. So they will bear their own cost. So mostly they are independent kind of organizations. So therefore, when you want to convert the financial statements of foreign operations into Indian rupees, you need to classify them as integral, non-integral. Integral is what? It is IFO is an operation whose activities are essential part of the reporting enterprise activities. That means IFO operates as an extension of the reporting enterprise. It is just our extension. Non-integral means it is not an integral part of the foreign operations. Now see, there are certain indicators which is given in the standard. When we say it will become our non-integral foreign operations, there are certain indicators given. First, it operates independently of the main operations. Second, transactions with the main enterprise is very minimal. Very less transactions will be done by the foreign operations outside India. It is self-financed. That means it depends on its local borrowings. For example, we have a branch in America. So they will take their own borrowings. They will arrange their own money. They will not ask the head office, or head office will not finance. Next, they bear their own cost. Costs are paid in local currency, and sales are mainly in other currencies, not the reporting currency. So not in Indian rupee. For example, our Indian currency head office is in India. So our branch outside India will do sales in other currencies, not in Indian rupees. And the main enterprise cash flows are not affected by the daily activities of the foreign operation. Prices depends on the local factors, not exchange rates. It has strong local market. So after reading all these things, one thing you need to understand is these are the indicators to say whether the foreign operation is integral or non-integral. If all the majority of them satisfied, na, it is non-integral. So non-integral is kind of a independent organization. Okay. So if the foreign operations is integral foreign operations, then I need to convert into Indian rupees. Na? So following is the rules I need to remember. In the financial statements of my integral foreign operations, monetary items are there. I told you what is monetary item. Money held, any asset to be received in fixed or determinable amounts of money, any liabilities to be paid in fixed or determinable amounts of money. Monetary items, always convert them by using closing rate. Non-monetary items, again same. Carried at cost, original rate only you continue, and carried at fair market value, closing rate you use. And P&L account items in the financial statements of foreign operations, use the rate on the date of transaction or average rate if it is available. Any contingent liabilities, closing rate. Very simple. So all monetary items, closing rate. Non-monetary items carried at cost, original rate. Carried at fair market value, closing rate. P&L account items, rate on the date of transaction or average rate. Contingent liabilities, closing rate. And when you convert the integral foreign operations into Indian rupees, whatever the exchange difference arises, that will be transferred to P&L account. Now come to non-integral foreign operations. Suppose if your foreign operations are non-integral in nature, then the standard says whether monetary items or non-monetary items doesn't make any difference. Closing rate. All P&L account items rate on the date of transaction or average rate. Contingent liabilities closing rate. But whatever the difference arises in when you are converting the foreign operations for financial statements of non-integral foreign operations into Indian rupees, whatever the difference arises, sir, that will be transferred to an account called FCTR account. FCTR account, foreign currency translation reserve account. What is that? Foreign currency translation reserve account. And where this FCTR account will be shown? This FCTR account will be shown under the head reserves and surplus until the sale of the foreign operation. So see this, don't confuse. Normal exchange difference will be transferred to P&L account. Any exchange difference in general it is transferred to P&L account. And if you avail the special option under para 46A, any exchange difference arises. Okay, if it is directly related to acquisition of depreciable fixed asset, adjust to the cost of the asset. In other cases, the exchange difference will be transferred to FCMITDA. That is different. Foreign currency monetary item translation difference account, which will be shown as a part of reserves and surplus. And this FCTR account, when you convert the non-integral foreign operations into Indian rupees, the financial statements of non-integral foreign operations are converted into Indian rupees. Any exchange difference arises, that will be transferred to FCTR account. But in case of integral foreign operations, exchange difference is transferred to P&L account. The logic is simple, sir, because I told you integral foreign operations is our extension only. Therefore, when you are converting the financial statement, it will directly affect my P&L account. But non-integral operations are kind of independent organization. When I convert the financial statements of non-integral foreign operations into Indian rupees, whatever the difference arises, that will not impact my P&L account. That will be transferred to a separate reserve called FCTR account. Now the important point, the balance in this FCTR account will continue till the date of sale of the foreign operations. As long as there is our investment is there in the foreign operation, non-integral foreign operation, this FCTR account will be continued. So reclassification of foreign operations. Sir, suppose till now our foreign operations are integral. Now we want to convert into non-integral. What we need to do? Integral has become non-integral. Simple, sir. From now onwards, any exchange gain or losses arises from because of the reclassification, it will go to FCTR account. Because in case of integral, any exchange differences on conversion, we have transferred to P&L account now. Now it has become non-integral. Therefore, if you convert the integral to non-integral, whatever the exchange gain or losses arises, that will be transferred to FCTR account, because now onwards it is non-integral, right? Non-integral to integral, this is important, sir. Sir, you have the foreign operations, which is basically non-integral. Now you want to convert into integral. So the standard says any exchange gain or loss after reclassification will go to P&L account, because now onwards it is what? Integral. Sir, very simple, sir. Integral has become non-integral, sir. Now I told you, in case you are converting the foreign financial statements of non-integral into Indian rupees, whatever the difference arises, now onwards it will be transferred to FCTR. Now you are non-integral, now become integral. Integral means whatever the exchange difference arises on translation, it will be transferred to P&L account. That is what they're saying. But here, when non-integral has become integral, sir, one important point, sir, whatever the balance is there, I mean, previously it is non-integral. That means at the time of conversion into Indian rupees, whatever the difference arises, that we transfer to FCTR account, sir. Whether we cancel this FCTR account once we reclassify the non-integral into integral, the answer is no. This FCTR account balance will be continued till the disposal of investment in foreign operations. So the existing FCTR balance stays in the balance sheet until the operation is sold. For example, if I sold the part of the operations, part of my investment in non-integral foreign operation, then part of the balance in FCTR account will be transferred to P&L account. A proportionate amount from the FCTR is transferred to P&L account. So this is reclassification, sir. So relating to foreign branches, sir, there are some questions. So if you solve those questions, it will be very clear, sir. Just application of rates, these rates you remember, sir. Now the last concept is forward exchange contract, which is important, sir. Listen to me. First of all, what is this forward exchange contract? See, forward exchange contract is a contract between two parties, either to purchase the currency or sell the currency in future at a predetermined price. Generally, sir, any contract entered for purchasing and selling of a particular item in future at an agreed price is called forward contract. Here the item, the main subject is relating to foreign currency, sir. Suppose I am a company, I entered a contract with a bank to purchase American dollars after 6 months at pre-agreed price. That is called forward exchange contract. So what is forward exchange contract? Is a contract where one party agrees to buy from or sell to another party an asset at future date for an agreed price. Okay, now, so the company entered a transaction either to buy the foreign currency or sell the foreign currency when in future at a pre-agreed price. That is called forward contract. Now listen to me carefully. Sir, this standard has divided the forward contract into two categories. One is forward contract entered for hedging purpose. Second one is trading or speculation purpose. Hedging purpose, trading or speculation purpose. What is hedging purpose? To minimize the risk of foreign currency fluctuations. To minimize the risk of foreign currency fluctuations, if any transaction forward contract is entered now, that is called forward contract entered for hedging purpose. So business enterprises will enter the forward contract for managing or minimizing the foreign exchange fluctuation risk. That is called hedging. Second one is trading or speculation purpose. If any forward contract is entered by the company for trading or speculation purpose, that is the second case. Okay. First, I will tell you simple. Listen to me carefully. Suppose I'm an Indian company. Now listen to me carefully, sir. Suppose I'm an Indian company, sir, A Limited. So I purchased one plant and machinery for $1 lakh. Okay. Now the contract is for 6 months. I need to pay this $1 lakh after 6 months, sir. And I entered this transaction on January 1st, 2025. And I purchased this from Mr. John of USA. Okay. So this is the contract. A Limited purchased plant and machinery. Purchased plant and machinery from Mr. John. $1 lakh. I need to make the payment after 6 months. 1/1/2025 is the date of transaction. Now see, on the date of transaction, $1 is equal to 80 rupees, sir. 80 rupees. Right? Now, as a Limited, I am little bit worried because today $1 is 80. That means if I need to pay the amount today, 1 lakh into 80. So 80 lakhs will be my cost in Indian rupees. Correct? 80 lakhs will be my cost. But I need to pay after 6 months. Suppose in the next 6 months, okay, if the exchange rate has become 100, then I am end up paying 100 lakhs in Indian rupees to get this 1 lakh US dollars. Correct or not? If I want to pay 1 lakh US dollars after 6 months, and after 6 months the exchange rate suppose increased to $1 is equal to 60. So what I need to do, sir? I need to incur 100 lakhs, na, sir, to get this $1 lakh. That means today $1 is 80, but after 6 months $1 has become 100. There is a chance. We don't know. We are predicting that it may become 100. Therefore, I end up paying 100 lakhs, na, sir. So therefore, there is a risk for me. Being a Limited, there is a risk for me as a businessman. So what I will do? I will approach a bank. I will approach a bank and says to the bank, see, dear bank, I want $1 lakh because I need to pay to my US supplier after 6 months. So we enter a contract. Are you ready to sell me foreign currency after 6 months? Now bank is the seller. I am the buyer. We both entered a contract. Now according to that contract, they entered a price that A Limited is agreed to buy 1 lakh US dollars after 6 months at $1 is equal to 90 rupees. So I am ready to pay 90 rupees per dollar. Bank is ready to sell $1 at 90 rupees. So therefore understand, this is called forward contract entered for which purpose? Hedging purpose. Minimize the risk. How the risk is been minimized? Suppose for example, imagine as what I expected, after 6 months $1 has become 100. Now I will get each dollar at 90 rupees only from the bank. Na? Therefore 10 rupees loss I have saved per dollar. That means 10 lakhs loss have been saved. Na? Imagine, suppose for example, after 6 months $1 has become 120. Suppose if there is no forward cover, I might end up in paying how much, sir? 120 lakhs. But because of the forward contract, I pay only 90 lakhs to the bank. Therefore, I am minimizing the risk now. That is called forward contract entered for minimizing the risk. See this. Managing or minimizing the foreign exchange risk. That means you already entered some foreign currency transaction. Either you receive foreign currency or you need to pay the foreign currency. And because of the fluctuations, there is a risk for you. To cover that risk, you entered a forward contract. That is called forward contract entered for hedging purpose. trading or speculation purpose, you don't have any foreign currency transaction. Just for trading or speculation, you entered the forward contract. That is the second case. Now, okay. If you entered any forward contract for hedging purpose, what is the accounting treatment? The standard says any premium or discount at the inception of the forward exchange contract is amortized over the contract period. Important, sir. Sir, when you entered any forward contract for hedging purpose, any premium or discount at the inception of the forward exchange contract it is amortized over the contract period, sir. What is this premium or discount? See this. Premium or discount. Premium or discount. What we need to do? We need to amortized over contract period. That is what the treatment says. And any exchange differences arises, P&L account we will transfer. Any P&L from cancellation or renewal is also transferred to P&L. So only point you need to remember is this. When you entered any forward contract for hedging purpose, any premium or discount at the inception of the contract, we will amortize over the contract period, sir. I will show you one best question, sir. So you do this question, same question will be repeated if at all there is a chance. See this question. Rao Limited purchased a plant, sir, $1 lakh on 1st February 2011, payable after 3 months, sir. Company entered into the forward contract for 3 months at 49.15 per dollar. Exchange rate per dollar on 1st February was 48.85. How will you recognize the profit or loss on forward contract in the books of Rao Limited? First understand, sir. Rao Limited is an Indian company, purchased a plant for $1 lakh. When? 1st February. When they need to pay this amount? 3 months. February, March, April. So we need to pay this amount at the end of the April. Now we entered a forward contract because we want $1 lakh after 3 months. And we entered a contract with the bank to purchase $1 at 49.15 per dollar. This is called forward rate. This is called which rate? Forward rate. Forward rate means the rate at which the contract was entered, 49.15. We entered a contract to purchase $1 at 49.15. And the exchange rate per dollar on 1st February was 48.85. This is called spot rate. So spot rate is 48.85. 48.85. So what is spot rate, sir? Rate on the date of transaction. What is forward rate, sir? The rate at which the transaction was entered. The difference between the forward rate and the spot rate. See, the spot rate is 48.85, but you are ready to purchase each dollar at 49.15. So therefore, how much is the premium you are paying? 0.3. This is called premium. The difference between the forward rate and spot rate. The standard says the difference between the forward rate and spot rate is premium or discount. At the inception, this into how many dollars? $1 lakh. That means for each dollar you are ready to pay 0.3 rupees extra, right? Compared with the spot rate. So therefore 1 lakh into 0.3, that is 30,000. What is this, sir? This is premium. This premium we will amortize over the contract period. Contract period is, I think, 3 months. So therefore, this 30,000, sir, how you are going to amortize? February month you entered the contract. So February, March, 2 months belongs to current year. So 30,000 into 2 by 3. That is 20,000 will be recognized in the current year. 30,000 into 1 by 3. So this will be recognized in the next year. Okay. So this is how the accounting will be done. See this. So the total premium 0.3, number of dollars this, total loss 30,000. Loss means what? Premium, because we are ready to pay more. It's a loss. This loss has to be amortized over the period. So therefore loss to be recognized in the current year 20,000, because February, March, 2 months. 10,000 will be recognized in the next year. 10,000 will be recognized in the next year. Okay. Now in the same case, sir, suppose if this is forward contract entered for hedging purpose. Suppose if the forward contract is entered for non-hedging, trading or speculation purpose, then in such a situation, sir, you need to remember this premium or discount on the forward exchange contract we will not recognize. We will ignore it, sir. We will not recognize separately. Understand? In case if the forward contract is entered for speculation purpose, don't recognize premium or discount on the forward exchange contract on the date of transaction. Rather, what we need to do is on each balance sheet date, this forward contract is marked to its current market value. In that process, if there is any difference arises, sir, that difference will be transferred to P&L account. See this. At each balance sheet date, the contract value is marked to its current market value and the gain or loss on the contract is recognized. How to recognize the gain or loss on the reporting date? Very simple. What is the foreign currency amount? Suppose $1 lakh. What is the forward rate at reporting date for the remaining maturity period less the original forward rate? That means, see this. Originally, you entered a contract at what rate? Suppose $1 is equal to 50 for 3 months contract. Okay, for speculation purpose. Now, suppose you enter this contract on 1st February 2025. Now, at the end of the year, 31st March 2025, 2 months already over, right? February, March, 2 months expired. Still 1 month more is there. 1 month is there because the contract is for 3 months, right? So, therefore, 30th April 2025, this is the ending date of the contract. Already 2 months are over, sir. Suppose, sir, if the forward contract is entered to buy the American dollars or to sell the American dollars for the next 1 month, at what rate they are ready to enter? Suppose they are ready to enter at $1 is equal to 48. $1 is equal to 48. Now see, you, or for example, I will take at 52. That means, you understand, sir, you entered a forward contract to buy American dollars, 1 lakh American dollars at $1 is equal to 50. When 1st February, if the same contract is entered for the remaining period on 31st March, the same contract to buy the American dollars, you might have earned, suppose if you enter at the 31st March 2025, you might enter $1 is equal to 52. That means you need to pay for $1 52 rupees to buy 1 American dollar. So therefore, what will be the gain to you? Gain is equal to 2 rupees per dollar. Per dollar, 2 rupees gain. This is called marking the contract to its market value. Sir, originally I entered the contract $1 is equal to 50, sir. If the same contract is entered for the remaining maturity period, $1 I need to purchase, I need to pay, ready to pay 52. That means I am on the profit side. So if I sell this contract outside, now people are ready to buy $1 is equal to 52 rupees. But I entered at $1 is equal to 50. Therefore, there is a gain of 2 rupees. This we need to recognize. That is what we need to do in case of speculation or trading purpose. In case of speculation or trading purpose, we don't recognize any premium or discount. So that is what they're saying, sir. Okay. Now see this. There is a question, sir. Mr. A bought a forward contract for 3 months of US dollars 1 lakh on 1st December at $1 US is equal to 47.10 when the exchange rate was $1 US is equal to 47.02. You see this? There is Mr. A, sir. He bought, that means he purchased a forward contract for how many months? 3 months. US dollars 1 lakh. When he purchased it, sir, when he entered this contract 1st December at $1 US is equal to 47.10 when the exchange rate was what? $1 US is equal to 47.02. That means he entered the contract at 47.10. This is forward rate. This is spot rate. On 31st December, when he closed his books, the exchange rate was $1 US is equal to 47.15. On 31st January, he decided to sell the contract at 47.18 per dollar. So how the profits from the contract will be recognized. First of all, in this case, how the contract was entered. Is it for hedging or non-hedging? Non-hedging. Because here, forward contract is not entered to cover any loss. Okay. So therefore, this is trading purpose he entered. So whenever trading purpose entered, any premium or discount will be recognized? No. So therefore, what we need to do? We need to mark the contract to its market value at the end of the year. So you entered the contract on 1st December, right? Now 31st December is the year end. See this, 1st December, 31st December. So you entered at 47.10. You are ready to buy $1 at 47.10. This is the rate you entered now. Now the same contract, the contract is for 3 months. The same contract, if it is entered on 31st December, $1 is equal to 47.15, right? 47.15. Suppose if I say, if you entered contract on 31st December to buy $1 US, you might have entered the contract at 47.15. That means you are on the gain side now, gain. Because I entered to purchase $1 at 47.10 only. But if I entered contract at the end, I might have ready to pay 47.15. Therefore, what will be the gain in this case for me? 47.15 minus 47.10. So gain is 0.05 into how many dollars? $1 lakh. So therefore, $1 lakh into 0.05 per dollar the exchange difference. So therefore 5,000 rupees is my gain. This I will transfer to P&L account. Now next what happens, sir? Actually 31st January, next year 31st January, I sold the contract at 47.18. So therefore already I brought the contract at 47.15. Then I sold it for 47.18. So 47.18 minus 47.15. Again there is a gain on sale of 0.03 into 1 lakh US dollars. So therefore 3,000 will be the gain. So overall there is a gain of how much? 8,000. So therefore as a trader, see, very simple, sir. I am a trader. I entered a contract to buy American dollars. Buy American dollars. At $1, I am ready to pay 47.10. But finally I able to sell 47.18. That means 47.18 minus 47.10. Overall I got a gain of 0.08 per dollar. Na? Like that, $1 lakh na. So therefore 8,000 will be my total gain. Na? This gain if I spread, so from the date of contract to the year end, there is a difference of 0.05. So that is the gain I will book at the end. At the end of the year, 5,000. Now again I sold. So therefore sale value 47.18. At the end 47.15 last year end. So difference is 0.03. So 0.05, that is 5,000 will be the gain on 31st December. 3,000 will be the gain at the time of sale. So this is how you need to deal in case of forward contract entered for trading purpose. So very simple. If you enter for trading purpose, premium or discount is ignored. Only you need to mark the contract to its market value. That means what is marking to market value? Any gain or loss arises. Simple. What is the original forward rate you entered? What is the rate if you enter the contract for the remaining period? If you enter the forward contract for the remaining period, what will be the rate? You compare it. You will get the gain or loss on report. That's it. This is accounting standard 11, sir.